All right. So everyone in the class, please confirm. Can you all see me, hear me? Everyone. Am I audible, visible? Is everything fine? Please tell me. So welcome everyone in the class to this amazing marathon in full English language for the subject of CA Final AFM, where we are going to cover exactly what? Let me tell you. So we did an analysis where we found that there are certain topics. Let me share my screen and that I'll tell you what this video is going to be about. We did this analysis. Let me quickly share that information, what this analysis was. And we identified that there are some 33 topics we analyzed the past 17 papers actually, right? And we could identify that there are some 33 topics in your entire curriculum in practical portion which are very repetitively asked. They are so repetitive that I have given an instance. For example, dividend discount model has been asked 12 times out of 17 papers that I analyzed. Similarly, there are things which have been tested 9 times, 10 times like this. We have identified those topics and then we analyze that if someone does those 33 topics, then for what marks, right? For how many marks in the exam paper he would be able to find the practical questions from those topics. So it was around 87, 88, 30, 48, 96 marks and so on, right, in the last 17 attempts, where in the latest attempt of September 25 and Jan 26 it was 80 marks and 56 marks. Similarly, if you have less time and we have to focus only on 27 topics, 27 topics were being asked in the exam for the marks that you see here, right? In this video, which can be only the part 1 of this video, we will try to focus on these 27 highly repetitive topics which is of people at most importance in the CA final AFM exam. A detailed video on this you will find in the description of this video, right? The detailed analysis video you'll find in the description of this video. And now if you are clear what this video is going to be about, shall we, people in the class, get started? So all the live people sitting here, very good morning. Please give me your presence. Give me your present. How many of you are sitting live watching me here? People, are you ready to utilize this day to the fullest? Yes. So I can see Gayatri, very good morning. Vishal. Yes, Vishal, is that your first name? I can see you. Sneha is here, Miral is here. Then what's your first name? Sailo. Salohi, is that your first name? Then Gayatri, ready. Ramesh, are we ready? Then JEB. Jebrani, is that your first name? Jay, are you ready? Sai is your first name. So can I call you Sai? Yes. So all the live people sitting in the class here, are we ready? So what are we going to do for these 27 topics that you see here? We are going to, people in the class, first very quickly, just go through the concept so that you have some idea of how the questions will look like. And from those topics, we will choose those category A or LDR questions, right? Those LDR questions we will solve in the class. We will discuss them in the class. Now some disclaimers which are really important. Two types of books that we are going to use. So this PDF that you see here on the screen is available on the description of this video. Along with that, we are going to use two types of books. One is this OutNotes, okay, which is the concepts notes that we use in all our batches. The same book will be referred for you people to explain the concepts. And then is the question bank, right? This question bank that you see here is a great compilation of RTPs, MTPs, study material, practice manual, everything. The same book is used with the batch students. So the two books that you see here are available to you in the soft copy. You can download that. The link is there in the description. Fine. Plus this hard copy of this question bank you can purchase. Now one more thing you all need to understand, that I come up with this ABC analysis every year. So for the attempt of May 26, we have given you chapter wise, I mean to say question wise ABC, that in a particular chapter which questions are A, which questions are B and which questions are C. Yes, Yes. So that's how I want to tell you that those A category questions, which are LDRs, is what we are going to cover in this video from those highly repetitive topics or concepts that I talked about. Perfect. So Shruti is here. Hi sir, quick feedback. I attended this marathon and gave a mock yesterday. It was tough, but I found 45 marks from this topic and I'm shocked and grateful at the same time. Thanks so much, Shruti. I'm really happy to see that the analysis that we did for those exam papers got automatically applied even to mocks. So that's really great. Thank you so much. Perfect. Someone is asking me what is going to be the expected time of this marathon. I'm expecting around 10 hours. So let's see how it goes. Yes. So I want only those students to be here who are not temporarily motivated but who are rather determined and disciplined, and there they have this thing in their mind that they want to make it in the coming attempt, right? So right from this point till the end, if you are determined, disciplined to be there, I would want you to be there. Yes. So let's get started. Let's enjoy this learning. Let's make the best use of this time. Yes, everyone. So let me tell you, the video does not talk about selective studies. I have my time limitations, so we can do only to an extent in this video, but beyond those topics, you should follow your plan. I'm making you people go through these topics which are more repetitive. The other topics, I'm not asking you to skip that. You will have to do at your own first thing. Second, we are going to follow the sequence of this file. So I would request anyone who's watching it in the recorded form, guys, this is a real request. Please try if you can make a timestamp. So I want you to not timestamp the questions, just timestamp the topic. I mean, I just want you to timestamp a particular chapter and then the topics in those chapters. I mean, don't even timestamp this particular thing. Just timestamp, give the heading equity business valuation, don't timestamp, and then subtopics you have to timestamp. Then portfolio management a heading, then subtopics you have to timestamp. If you can do this, it will be of great help to everyone who's watching this video, right? Your words make you motivated. You will have to be, there throughout till the end. I want to see that determination. I want to see that discipline. And let me tell you, if you do it today till the end with everyone else sitting in the class, it is going to give you a sense of relief on that last day, right? We are doing concepts as well as questions, right? So it will take extra time, for which it may happen that we might have to cover only some, we might be able to cover only some chapters today, right? So let's proceed ahead with your learning, with my teaching. We will be able to figure out how much of it we are able to do it, but it will be worthful, that I'm sure. So starting with our first discussion, which is on the dividend discount model, which everyone in the class has been asked 12 times, right? Which the average marks for every question was 7 marks. So let me show you the concepts notes where we'll have this discussion, right? So the chapter that we are talking about is equity business valuation. You must be wondering, sir, equity business valuation is no chapter in the study material. Let me tell you. Chapter number 5 of a study material is security valuation, in which we have different type of securities like preference share, bond, money market, and equity. Cool. And then chapter number 13 is business valuation. The thought process required for equity security and the entire chapter of business valuation, people is same, which is why they have been merged as equity business valuation. The other three securities, which is preference, bond, and money market, have been merged under the chapter of fixed income security. So in our book, you will find fixed income security as a separate chapter and equity business valuation as the another chapter. Perfect. So we are starting with equity business valuation. In my outnotes, it is on page number 1. Sorry. Let me take you that particular page. In my outnotes, it is on this particular page number 17. All right. So I have a request to make to everyone sitting in the class. It might happen that you're watching this video for say November 26 or May 27. All right, sir. At that point, when you go to download these PDFs, you will get the latest PDFs. So it may happen those latest PDFs might have some different page number, which is absolutely okay. This video continue to remain relevant, and obviously you are referring to the latest material in that case, which and nothing can be great like that. All right. So please don't doubt this video or that note. Both are latest. They are fully applicable to you. Starting with the dividend discount model. Everyone in the class. Shall we? Shall we? Shall we? So you have to please have your calcies with you. You have to participate. You have to answer my question. Do you people know the fundamental principle of valuation with respect to the dividend discount model says that value of a share today is the present value of future cash flow, which means present value of future dividends that a investor would realize from that share. So if you hold a share today, whatever future dividends that share is going to distribute you, present value of those future dividends is the value of share. Do you agree with this most basic thing? Yes or no, everyone? Tell me. Come on, everyone in the class. Do you agree with this most basic thing in the dividend valuation? Yes or no? Sir, there we can have two types of possibilities in the exam. Yes, we are completely exam oriented. What are the two types of possibility? Possibility one, we might be given data for some particular number of years. For example, examiner might give us that you are holding a share for 5 years. So examiner will give me the data for the next 5 years of dividend, and at the end of fifth year, it will give me the selling price. Perfect. So you have to discount those 5 dividends in the selling price of fifth year. You have to bring them to present value, and that become the value of share. Another possibility is that examiner give us data for dividend for infinite number of years. Meaning to say, examiner give me the data of dividend for and like for till infinite number of years, which means in that case you can't do that manual discounting and you have to apply dividend discount models. Right? Point of learning here is that point of learning here is that whatever way you discount, the discounting rate is needed, which is people in the class called as cost of equity. Perfect, sir. Sir, now when you use dividend discount model, there are three possibilities or three patterns of dividend that you will have to identify. First pattern of dividend people is constant dividend model or zero growth in dividend model. As the model itself says, when the amount of dividend that you receive is same every year till infinity, when the amount of dividend that you receive is same every year till infinity, then we call it to be a constant dividend model. If the amount of dividend is growing at a constant rate till infinity, which means it grows at a particular rate till infinity, then the model applied is called as Gordon's model or constant growth model. Or third is the scenario of variable growth model, where the amount of dividend, people in the class, just give me a second, where the amount of dividend people is variably growing. In some year it grows by 10%, then in some year it grow by 5%, then by 12%. The growth rate is not constant till a particular point. Such a model is variable growth model. We won't directly jump to solve the practical question or the formulas. We will try to understand the underlying concept. I need your validation. Are you all people able to connect to whatever has been spoken? Initially, to set that rhythm, I will request your responses as much as possible. Come on, everyone in the class, are you all aligned to what I said? Come on. So everyone who's watching this video, let me tell you, the video is going to be super helpful. Now, for that, to keep me motivated, you will have to subscribe to this channel, like this video, and compulsorily at the end, at any point in this video where you feel that the experience was really good, you will have to put down your genuine feedbacks, your genuine, you know, experience in the comment section of this video. That motivates me to do more for you, right? Perfect. So are we all settled, live people, with this? Perfect. Sir, if the dividends are constant every year, then the way to calculate their present value is really simple. Think annuity point of view, right? Annuity, which is forever, is perpetuity. So I will say the amount of dividend, which is D1 divided by K, become the value of the share. However, if it is Gordon's model, constant growth model, it is D1 divided by K minus G. The formula is really simple, but there are some detailings with respect to this formula that you all need to understand. Do you agree the first dividend which is being discounted in both of these scenarios is D1? D0 is not the future cash flow, it is the present cash flow which is not discounted in this formula. The formula discounts the first cash flow as your D1 and bring it to 0 point. From D1 to D infinity, everything gets discounted through both of these formulas. Perfect, sir. Second, if D1 is missing, then as a backup formula, you can use D0 into 1 plus G. But primarily what you have to use is D1. Second, when you talk about KE, we know it is a discounting rate. You can calculate it using CAPM. For example, beta plus beta into Rm minus Rf plus Rf, right? That is one way. Another way to calculate K, I will show you. So there are three ways for you to calculate K. First is Rf plus beta into Rm minus Rf, sorted, sir. Where Rm minus Rf is market risk premium and beta into Rm minus Rf is called as security risk premium. Second, this is priority one. In your entire AFM, as the first priority, you will use this formula to calculate K. Second priority, if the RMRF beta is not available, then the second way to calculate the formula, the second way to calculate the cost of equity has this really simple formula, D1 divided by P0 plus G. Perfect. Second. And third one, everyone, is the earnings yield. Like dividend yield is DPS divided by MPS. Similarly, earnings yield is EPS divided by MPS. That becomes the last option to calculate K if no other option is applicable, which is nothing but inverse of 1 divided by P ratio. Perfect. So, sir, cost of equity is also clear to us. That is what you have to use for discounting. And the last and the most important is growth. Sir, growth of what do we need? Is it the growth of EPS or the growth of DPS that we need? Sir, we are discounting dividends, so we need the growth of DPS. But sir, growth from which point to which point? The first dividend is discounted as dividend of first year, and the last dividend discounted as dividend of infinite year. So what matters to me is the growth of dividend from year 1 till year infinity, which means, do you mean to say that 0 to 1 dividend can have some other growth? The answer is yes, because to me, my first cash flow is D1. The first cash flow is not D0. Perfect, sir. Sir, last thing. Is the EPS and DPS growth the same or they are different? Because it will happen that examiner will give you the growth of EPS, but what you need is the growth of DPS. So there is an important point of conceptual clarity here. I'm starting to speak, pay your attention, and once you feel that, sir, you're clear with it, you will have to let me know in the chat box. Perfect. Shall I start? Sir, growth is always between 2 points. So 0 year and first year. I want to calculate the growth between 2 points. So you'll have to check the payout ratio of these 2 points, the dividend payout ratio. If the payout ratio of both of these points are same, then I can say whatever has been the growth in EPS will continue to be the growth of dividend. If EPS grow by 10, then dividend also grow by 10. Don't focus on the numbers, focus on the flow, right? We can't take each and every number to understand the things. Focus on the flow however, suppose between these 2 points, from year 1 to year 2, between these 2 points, if I want to calculate the growth, let me look at the payout ratio. The payout here was 50 and the payout here was 60. Due to change in payout, I can tell you that earnings and dividends growth will be different. If EPS grows by 10%, then dividends will grow with a different rate, not 10%. So in conclusion, when the payout ratio changes, the DPS growth is not same as EPS growth. However, if the payout ratio between the 2 points is same, then the DPS growth is equal to the EPS growth. Could you all, people in the class requesting your responses, understand what I just spoke? Come on, everyone in the class. Could you all please understand what I just said? Everyone, please tell me. I will also pin a particular video in the comment section so that everyone is able to understand. Wait, have you all replied to me on this? So I've pinned a particular message so that whosoever joins live is able to understand what's going on. Perfect. Perfect. Sorted. Great, sir. Now, sir, let me tell you, have you heard the formula of growth to be retention ratio into ROE? Adding you to you people another points of conceptual clarity that retention ratio into ROE is the formula of growth, but not the growth that we need. Sir, the growth that we need is the growth of DPS, but this formula gives you the growth of EPS. Let me make it specifically clear. This formula is a growth of earnings. But what I need is the growth of the EPS, which is why you need this particular thought process. If you get the growth of earnings to this formula, then you will have to check if there is a change in payout. If yes, then the growth of dividend will be different. And if there is no change in payout, then the growth of earnings and dividend will be same. But now, sir, there is a catch. Imagine that there is a change in payout ratio. So in that case, how do I calculate the next dividend since I don't know the growth number? In that case, the trick is really simple. Let me tell you, imagine that 0 point dividend was 50. Earnings growth was 10%, so I knew dividend will also grow by 10. So 50 plus 10% become 55. Now the same situation from year 1 to 2, if I have to find the dividend from of year 2, if I have to find this, how do I calculate it? Because the growth is not available. The way to calculate it is really simple. People in the class, pay attention. You have to go by way of earnings. This path you cannot follow because you do not know growth. Then, sir, what do we do? Do you know the growth of earnings? Yes, sir, given in the question. In that case, please pay attention. If the growth of earnings are given, you have to first find the earnings of year 2. Once you have found that, then you multiplied the payout ratio of year 2, so that by way of earnings and payout ratio, you can find the dividend of year 2 rather than directly finding it using the dividend of year 1. This particular point could I explain? Everyone in the class requesting your responses. From D1 to D2, you cannot go. But from E1 to E2, and then from E2 to D2, you can go because you have the payout ratio here available with you. And that is how you will have to proceed ahead. All these learnings that you're having right now, we are going to compile it and we are going to apply it in the practical questions that you're going to face ahead. Are we all ready? Perfect. So, sir, with that, I guess we are all set. Let us now go to the practical questions. Let me take you to that ABC analysis file. As I say again, please pay attention. This video you may watch for November 26 or May 27. All right. But the book that you will download from the given link in the description will be the latest book. So it may happen that the question that I am making you solve, for example, is question number 5th. But in your book, you may find this to be question number 4 or 6 or 7. So please consider it. The number might vary here and there, but you will have to ensure that you are watching up this particular question in your book, which you have downloaded or you have purchased, which is going to be the latest one, right? So are we all ready to solve the practical questions? Do you have your calcs with you? Come on, people in the class. Ready are we all? At this point, at this exact point, who all do we have live watching me up? Come on, tell me. It is 9:35 in my, is the time that I see right now. At this point, who all are watching me? Come on. Live people, please tell me. Christy is here, Gayatri is here, Sai is here, sorry. Namita is here, Vishal is here, Jay is here. Sanita, is that the name? You are here. Miral is here. So great, guys. That's really brilliant. Let's. Okay, a lot of you are here. Great people. Perfect. So let's start to read the question. The shares of Voyage Limited are being quoted at a P ratio of 8 times, meaning to say P ratio given to us as 8. The company retains 5 rupee, which is equal to 50% of its EPS. Please apply common sense. Retain earning, which is 5 rupees, equal to 50% of EPS, which means EPS will be entire 100%, which is 10 rupee. So out of 10 rupees, 5 rupees retain earning, then rest of the 5 is dividend. Do you people understand? I did not speak it in the concepts notes, but do you people realize in the absence of information, we have observed that the institute assumes the given dividend to be D1. If the language is clear, it's fine. If the language is silent, then we assume the given dividend to be D1. Institute does not guide us for that, but we have observed the practical questions of institute. In most of the assumptions, right, except for 1 or 2 questions, the assumption has been D1 only, which is why we will continue to follow it. Perfect. So bringing you back to this question. So 5 rupees the amount of D1 that we know. You are required to determine the cost of equity of the company if the market is expect the growth rate of 15% per annum. The calculation of K, first priority is CAPM, which is RMRF beta. Do you see that information? No. Second priority is Gordon's model, which is D1 divided by P0 plus G. Do you have that information? Dividend of 5 rupees there? Yes, sir. Divided by divided by, is the price there? Sir, if dividend was 5, we realized EPS is 10. And to the EPS, if I multiply the P ratio, I get MPS, which is rupee 80. So D1 is 5 divided by P0 is 80 plus the 15% of growth rate is given the question. Do you agree to what I said? D1 is 5 rupee. Price 80 we calculated using EPS and P. Growth rate is 15%. If I do 5 divided by 80 plus 0.15, it gives me 21.25 as the cost of equity as the first part of this question. Yes, someone is asking, will it be covering all practical chapters? No. From all the practical chapters, it will cover those particular highly repetitive topics which on an average has been for 25 marks. Sorry, on an average has been for 65 marks in the exam in the past 15-17 attempts. All right. Cool. Perfect. Is the first answer there with you all? People, please validate it to me in the chat box. Come on, everyone. You all have your first answer ready. What do you all say? People? Perfect. Second, the indicative market price for the same cost of capital if the growth rate changes to 16. You have to find the indicative market price, which means the implied or the intrinsic value, implied price, fair price, equilibrium price, everything mean the same. So you have the growth rate, which means you have to apply Gordon model, which is nothing but D1 divided by K minus G. The D1 continue to remain 15%. They are expecting us to use the same KE of 21.25%. But the growth now changes to 16%. What do you get as the intrinsic value? Please tell me. 0.2125 minus 0.16. 0.2125 0.2125 minus 0.16 divide equal to into 5 give me 95.24 on a rounded off basis is the market price. That was your second question. The third question is similar nature, easy question, does not make sense. Sir, I will also guide you. Not just the questions that we have to do, but if any other question has any other point of learning, that I will guide you. For example, question number 6 has a point of learning. Everyone, do you people know in the basics that any rate of return, where that is a risk-free rate, whether that is the return of market, where that is a return on any particular share, or it is your required rate of return, any rate of return, people in the class, has inflation premium included in it? Unless a return is a real return means something which does not has inflation. So unless it is a real return, we always assume the given return to be nominal, and nominal return always has the inflation premium included in it. Sir, what do you want to say? I want to say that initially examiner give you that RF is 9%, RM is 13, and so on. Then in a B part of this question, it says, what if the inflation premium increases by 2%? Let me tell you, due to increase in inflation premium by 2, RF will increase by 2 and RM will also increase by 2. RF from 9 will become 11, RM from 13 will become 15. Do you understand what is the specific point of learning here? Both your RF RM will change and accordingly your K will change. And due to change in K, the intrinsic value at 0 point that you calculate will also change. The purpose of this particular question is to not to solve it entirely in the class, but give you a sense of the point of learning that is there in this particular question. Do you all please get me on this? It is possible that you may not get the entire question at this moment, but when you revise these things at home, you'll be able to connect to what I explained. Yes, sir, you will have to guide me. Does this approach of telling you only the point of learning of other question working out in this video? Not necessarily now you have to answer. Maybe in the next question when we do, you can guide me, sir, if that particular thing is working out or not. Right? Then the question that we have to do in the class is question number 10. Yes, question number 10. I'm going to explain this question to you on the timeline, right? The timeline that we do to our regular batch students. So this timeline belongs to the latest English, full English regular batch. These are the handmade notes of our latest full English regular batch where we made this particular timeline. Where is that? Here it is. Perfect. Right? Sir, the question says in December 2011, AB company was sold for rupees 146 per share. So at 0 point, what is the price per share? 146. The long-term earning growth is 7.5%. What is the rate of growth given? The growth of earnings has been given. What do I need is the growth of dividend. So 7.5% is the growth of earning, which is anticipated, right? And it is expected to pay 3.36 dividend per share. Fine, sir, sorted. What is the rate of return then investor can expect to earn? So expected rate of return, the word can be interchangeably used with the required rate of return. Actually, the two are different things, but sometimes it does happen that the institute uses these word interchangeably. Perfect, cool. Sir, what is the exact logic? I will tell you the logic when we go to the chapter of portfolio management. I will tell you why the institute using the two words interchangeably. Perfect. Sir, what is the rate of return if they expect the dividends also to grow at the rate of 7.5% per annum? In perpetuity means earnings and dividend, both of them grow at the same rate. Do I have the RF beta given? No. So can you find the expected using RF beta? No. What is the next priority? Gordon's model, which is D1 divided by P0 plus G. Sir, company expected to pay dividend of 3.36. So I will say 3.36 dividend divided by price of 0 point of 146 has been given, and the growth is expected to be 7.5%. When you calculate 3.36 divided by 146 plus 0.075 give me 9.80% as the cost of equity. Everyone, how much out of 10 to the basic part of this particular question, part number A? How much out of 10? Every single student sitting here is clear. Pause. Requesting your responses. Everyone, what do you say? 10 on 10 are we all? 10 on 10 are we all? After solving this question, I'm going to ask you one of the most important questions. After this question, okay? Now be part of this question. Let's start to it, because after this question, I'm going to take a feedback from you all. That is this approach of learning where we quickly go through the concept, read the question, understand, figure out the timeline and then solve it. Is this approach good or bad? Like, are you people satisfied with that approach? That's something we will learn I'll ask you after this question. It is expected that AB company will earn about 10% on the book equity. What does it mean? You will earn 10% on book equity. It is called as return on equity. So if your return on equity is going to be 10% and if you retain 60% of the earnings, which means the retention ratio is going to be 60%. In this case, whether the growth rate and the cost of equity will change, I will say obviously change. Growth rate is ROE into the retention ratio. So ROE is 10%, retention ratio is 60%, 10 into 60% give me 6% as the change in growth rate. People, is this clear? Obviously, yes. Sir, next, is there a change in the cost of equity? Now there is a particular point of learning involved. You might think that due to change in growth, cost of equity will change, meaning to say D1 divided by P0 plus G is the cost of equity. Yes, sir. Earlier, the cost of equity was 7.5%. But now due to the change in, earlier the growth was 7.5% as given to me. But now when the growth rate changes to 6%, obviously my KE will change. This much if you think you're thinking it correctly, but you are thinking it incomplete. Sir, why do you say it is incomplete? Let me tell you, even your D1 will change due to change in the growth rate. Right? Let me now proceed ahead and decode it for you. Do you people agree that initially my growth was 7.5? Growth is made up of two things, sir. ROE multiplied by retention ratio. Now ROE is 10 and retention ratio is 60, which is why the growth is 6%. Previously, when the growth was 7.5, either ROE would have been different or the retention ratio would have been different. Right? In the absence of information, we assume that ROE is generally constant in nature. It is not an R hand to change. What's an R hand to change is the retention ratio. So we will assume that ROE previously was 10% only, but retention ratio was something else. Correct? If we try to back calculate the retention ratio which was there previously or which is right now there, right? Because expected is going to be 60. Retention ratio previously or right now, everyone is 7.5 divided by 10, which is 75%. Do you understand? How did I calculate it? Taking ROE to the denominator. So 7.5 divided by the ROE of 10% give me retention of 75. Now you have to please tell me one thing. Do you people agree? 7.5 and 6, 7.5 in the 6 is the growth of EPS, not the growth of DPS. This is where exactly the clarity of concepts gets applied. 7.5 and 6, right, is originally the growth of EPS and not the growth of DPS. Yes, sir. So due to change in growth rate, will my EPS change? Perfect. Previously, EPS would have been something, but now it will be something else. More importantly, despite the change in the growth rate, is there also a change in the payout ratio? Previously, the payout was 25% because retention was 75, but now the payout is 40. So on that whatever EPS amount, will the dividend amount be also different due to change in payout? The answer is yes. Which means, do you mean to say when you say D1 divided by P0 plus G, not that only your growth will change to 6%, it is also your D1 that will change. It is the hidden adjustment. That is what I'm trying to explain in this question. People, you will have to please validate it to me. Could you process the thought that I was trying to explain? Come on, yes or no? Come on, yes or no? Do you understand that it is not only the growth that will change, but also the dividend that will change, because EPS has changed due to change in growth, and the dividend will also change due to the change in payout? Yes or no? I need a validation before I can proceed ahead. Come on, everyone in the class. So what do you mean to exactly say, sir? Let me try to explain here. Let me try to explain here. Sir, suppose this is EPS of 0 point. Although it's not given to me in the question, but suppose it is EPS of 0 point. Perfect. Sir, will this EPS, according to the older situation, that EPS must have grown by 7.5%? Yes, sir. And that whatever is even EPS at the end of first year, of that 25% would have been the dividend, because that's would have been the payout ratio previously. If I have the previous D1, can you reverse calculate previous even, and can you reverse calculate previous E0 based on older estimates? So my dividend was expected to be 3.36, which I knew was equal to 25%. So what would have been the EPS? 3.36 divided by 25% give you EPS at the end of first year as estimated to be 13.44. Do you people agree? This 13.44 would have been after a growth of 7.5. This 13.44 would have been estimated using a growth estimate of 7.55. So if I try to eliminate the growth estimate, 13.44 divided by 1.05 give me 12.50 as the actual EPS 0, right, that company had. This estimate of 7.5% growth and 25% payout ratio has now changed. Now the growth has become 6 and the payout has become 40. In that case, will the EPS and DPS be different? Yes. Let's revise the estimate. From existing D1, I first came to existing E1. I came to existing even and then E0. Now using this E0, I will calculate the revised even and then revised D1. 12.50 plus 6%. People in the class give me 13.25 multiplied by 40% give me 5.3 as the revised amount of dividend as compared to 3.36. I need a validation from every single student sitting here. Could I explain that due to change in the retention payout ratio and the growth, not that only your growth that you use in this formula here will change, it is also the D1 that will change. Boss, could I explain this particular question to you? Please tell me. So I will now say the dividend has become 5.3. So D1 divided by P0 of 146 remain the same. Plus the revised growth rate of 0.06. When you solve it, you get the revised KE of 9.63% per annum. Yes, 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 yes. All the live people sitting here, all the recorded people watching of this lecture, could I explain this particular question to you? So what is the point of learning in this question particularly? The point of learning, people in the class, was that due to change in the retention ratio from 75 to 60, it is not only the growth that will change and ultimately K will change. It is along with the growth, the expected amount of D1 will change. Yes. Second, you will have to assume that okay, ROE of 10% remains same even in the previous case, which means previously the retention ratio must be something else, which we calculated to be 75% using the ROE and growth number. Perfect. That was the point of learning question number 10 had. Now I need a very important validation from every single student sitting here watching me live. Right? Guys, that is just the start of this video. You have to please validate if this way, is this approach of learning where we quickly go through the concept and then we solve the practical questions, right? On the timeline or in this manner. Is this working out? Is there anything you want to share or you want me to do, add something? Then it can be implemented now. After 3 hours, if you feel something, then it won't be of sense. Are you people completely set with whatever is going on? Are you finding this approach worthful? Every life student sitting here will have to respond. Priyanka, very good morning. Perfect. That is fine. Great. So question number 10th we have done. Then we have this particular question. Question number 8, which require you to reverse calculate something. Okay. Okay. Saloni says for the hidden adjustment, if possible, can you give a note after explaining? Cool, cool, cool. I will. For example, Saloni, in this question towards the end, I summarized it for you what exactly were the point of learning. So if there is a hidden adjustment or a point of learning, I'll give that, I'll give the reference once more to that. Okay. Question number 8 is a reverse calculation question, right? You will have to please try to look at this question at your own. What exactly the reverse calculation is involved is calculating D0. Generally, the dividends are given and discounting those dividends give you the present value. But in this question, particularly question number 8, the question on NM Limited, right? The present value, the price is given, and you have to reverse calculate the dividend. So, this is the question asked once in the attempt of May 21. You should check it out once. Okay, other than that, I think we are all set, all fine in whatever we have learned so far. Perfect. The next question that we should do in the class is particularly this question, which we'll be able to do only after doing the next concept, which is the concept of variable growth model. In the dividend discount model, we are done with zero growth, constant growth. The next one, people in the class, is variable growth model. You have to pay attention how logical, right? The thing is fine. Sir, variable growth model says that every year there is a different growth rate in the dividend. But after a point, dividend become constantly growing, right? For example, in the first year, growth is 10, in the second year, growth is 15, third year 9 is 9, fourth year is 8. But for fifth year and onwards year, it become forever 7%. So my strict recommendation, whenever you face any question on the variable growth model, immediately draw a timeline. It will take 15 seconds extra to solve this question, but you will never make a mistake in that question. Sir, first year growth is 10, second is 15, third is 9, 4 is 8. And then fifth and onward is 7, 7. Can you all please tell me at the end of which year, if I stand and look at the future, I'll have a forever same growth rate of everyone in the class, 7%. It is that which particular year where if I stand and look at the future, the growth rate is constant forever. Sir, it is fourth year end. So that is the point where you will have to calculate terminal value. To calculate terminal value, you'll have to apply Gordon's model, meaning to say at the end of fourth year, if I stand and calculate TV4, the Gordon's model will involve D5 divided by K minus G. More than formalize the interpretation of this formula, right? Please pay attention. Bia, it is not the fifth year where you calculate terminal value. It is the fourth year where you calculate terminal value, because growth from 4 onwards every year is 7 only. Could I make it clear, Bia, to you, if that's your first name? Next, people in the class, pay attention, right? And please like this video if you feel that what I just spoke is a point of clarity to you. Let me start speaking. Sir, fourth year terminal value has the formula of d5 minus d5 divided by k minus g. The more logical part is to understand that what is this terminal value of t4 giving to me. Sir, terminal value of fourth year is giving to me the present value of all the dividends from d5 till infinity. Everything from d5 till infinity has been there in this terminal value 4. Sir, has d4 not been there? Yes, it's not there. It is only from d5 till infinity is there, which means now for the basic underlying rule remain the same, present value of future cash flow. So what are the future cash flows to be considered? Dividend of 1, 2, 3 and 4 years plus the terminal value of 4 year. Everything is to be discounted and brought to 0.0 manually, so that everything from d1 till then infinity can be discounted to 0 point. Do you people understand the present value of future cash flow? The underlying logic remains the same, just that we are doing it in parts. 5 to infinity has been considered in TV4. Then you manually do 1, 2, 3, 4 and TV4. Yes or no? Quick validation on the concept. This was alternative 1 of solving it. You will be shocked to see alternative 2 of it. You'll be shocked to see. Yes, alternative 2 people in the class says what? Alternative 2 says that it is the same timeline. At the end of which year, if you stand and look at the future, you have a forever same growth rate. Sir, it is 4th year end, because after that the growth rate is 7.7. You know what? I won't explain you the logic, but I'll tell you directly the rule. The rule says that, right, which is based on obviously a logic. The rule says that not only that you can calculate the terminal value at 4 year, you can also calculate the terminal value 1 year before of that 1 year previous to that year, and that will also give me the correct answer, that is alternative 2. Which means you mean to say that, sir, growth forever is same from 4th year, but you want to calculate the terminal value at the end of 3rd year. Is it possible? The answer is yes. But sir, growth from year 3 to 4 will be different, and 4 onwards still forever is different. Yes, agreed. Despite that, you can apply TV3. What will TV3 do? Sir, it will discount all the future cash flow from 4 to infinity. So everything from 4 to infinity has been discounted to TV3. So what you have to now do, manually discount 1, 2, 3, the dividend of 3 years and the terminal value of 3 year to bring everything to 0 point, which will give me the value of share. Perfect. Requesting your responses. Could I explain to you what are the two alternatives using which we might have to value the share? Come on, come on. Alternative 1, calculating terminal value at the exact point where the growth rate forever become constant. Alternative 2 involves coming a year back and then calculating terminal value. The point is, sir, if the both give you the same answer, why do we have to learn alternative 2? Because institute does apply alternative 2 in certain scenarios. I will tell you exactly what are the scenarios where alternative 2 gets applied. For now, we will learn and solve the practical question of alternative 1. Come on. At every point, you have to please validate if you're understanding me or not. Bia says, please explain once again showing calculation. Bia, in concepts, we cannot do the calculation, but as we go to the practical question, I will show you the calculation. For now, Bia, I can repeat the concept. Do you identify, Bia, that growth is 10, 15, 9, 8, 7, 7? If I ask you, Bia, what is the point from where the growth is forever constant? You will say, sir, 4th year end, because after that it is 7, 7. Is the growth constant from 3rd year end? No, it's from 4 year end. So alternative 2 says that even if the growth is constant from 4th year end, you can calculate the terminal value at 3rd year end. Is it? The answer is yes. And that's what even the institute does. That's what even the institute does, right? So I will say, in that case, sir, how do you do terminal value 3? TV3 is simply D4 divided by K minus G. What is the first dividend? D4. What is the last dividend? D infinity. All that has been discounted and brought back to point 3. Yes, sir, the answer is yes. What is the growth rate to be used in the formula? The forever growth rate of 7%. So D4 divided by K minus G will use 7% of growth rate. That will give you terminal value 3. Now 1, 2 and 3, these 3 dividends are yet to be discounted along with the terminal value 3. That's what you will have to discount and calculate. Intrinsic value 0. I repeated the entire thing. Was I now more clear to you? Gayatri, that automatically answer your questions. We have explained it one again. Are you people set and sorted with it? There's a point of learning left, sir, where exactly to apply alternative 2, that I will teach you. But let's first, people in the class, pay attention to alternative 1, solve practical question of alternative 1. Again, I'll take you to my regular batch notes. The full English regular batch notes, people in the class, are here, in which we would want to see a timeline where this particular question has been presented. Yes, so please pay attention. Please pay attention. An investor, clear? An investor, people in the class, is considering to purchase an equity share of LX Limited, whose current market price is 112. The company is proposing a dividend of rupee 4 for the next year. Do you agree? Proposing a dividend obviously means it is D1. So D1 is expected to be 4. LX is expected to grow 20% for the next 4 years, which means from year 0 to 1, Then from 1 to 2, 2, 3 to 4, the growth for the next 4 years is going to be 20% per annum. The growth will decline linearly to 16% thereafter, after percent after the first 4 year. Sir, till the first 4 year, the growth people in the class is 20%. After the first 4 year, the growth will linearly decline to 16. It means it will decline by 1% every year, or 2% every year, or 0.5% every year, but it will gradually in a linear pattern come down. Agreed, sir? Sir, in how many years will it come down? That is the ambiguity of this question. Examiner missed to specify that what is the percentage decrease in growth every year. From 20, will it be 19, 18, 17, 16, or will it be from 20 directly 18 and 16? We don't know. Cool. Thereafter, it will stabilize at 16%. Once over the year it comes to 16, it will continue to remain 16 indefinitely forever. The required rate of return is 20%. You are required to calculate the intrinsic value of the share. Sir, without having the growth, how do I calculate the something? How do I calculate the value? The answer is really simple. Whenever examiner gives you some additional information like present value factor, future value factor, e raised to rt, the value of log natural, or the value of z probability distribution table, something like this has been given to you, you have to make use of it. Sir, how exactly? Let me tell you. The clarity of concept will automatically make the things clear to you, and applicability in the question you will have to please validate after this question. Sir, one of the assumptions can be to assume 1% fall every year, which means can I say 20, next 4 year is 2020, 2020. Fifth year will be 19, sixth year 18, 17th, seventh year 17, and eighth year 16, and then forever 16. That is 1% decline every year. Can you identify the exact point at which, if I stand and look at the future, the growth rate is forever constant? Help me to identify that point. Which year end? 6, 7, 8, 9. Which year end, if I stand and look at the future, the growth is forever constant, people? If you participate, if you think along with me, you learn. I don't want you to passively watch it. We are close to the exam and we want to make it, we want to watch it actively, applying all our brains to it. Sir, it is the seventh year end from where the growth is forever constant, which means can I calculate terminal value 7 as per alternative 1? Yes, sir. In which case, can I say, I will have to manually discount the dividend of the next 7 years, and I will have to discount the terminal value of seventh year, which means I need the present value factor for the next 7 years. Do you understand this particular conclusion, people in class? Yes or no? So based on that, can I say people in the class that, sir, if 7 years cash flow is what I need to discount, and I have been given the present value factor of 7 years, which my assumption of 1% decline in the growth of every year is correct. Are you all understanding me? Are you all aligned to whatever I'm saying? Yes or no? That's how I confirm that my assumption is correct. And now it is all easy. In this question, I'll tell you a particular calculated trick, or maybe the way you have to solve this practical question. So from year 1 to 7, you have dividend, and then seventh year, you have a terminal value. Growth is 20, 20, 20, 18, 19. Now, I'll tell you how exactly the cash flows you have to solve. First year cash flow is 4, that's given. Plus 20% if you do, on your calc is 4.8. Plus 20% if you do, it is 5.76. Now, you have to pay attention. When you do plus 20%, the answer on my calc is 6.912. On your calc, let it be 6.912, but what you write here is only 6.91. Then you do plus 19%. The answer on my calc is 8.22528. Let that remain on the calc. Here you write the rounded off number 8.23. Now, whatever is the number of your calc, you continue to add growth to that number and not the number which is here. The growth is continuously added. Like 18% will now be added to the number on my calc, which is 8.22528. So plus 18% give me 9 point, people, 705, which is 71. That's how you have all these cash flows. You have the present value factor, multiplying it will give you the DCF, which is 114.96. I need a validation from every single student watching on this question. How much out of 10 could I explain this question number 18 to you? Come on, requesting your response, including the calculator trick. Please, what do you all say? What do you all say? Please. I will open one more thing for you. Please, 10 on 10. Are you all? Question number 18th, which means this particular question we have just done. Question number 19th is a modified version of the previous question. We won't do this entire question, just give you the point of learning. What's there in this question is that examiner says that you will grow at the rate of 20% for the next 4 years. Cool. Then the examiner says the growth rate will decline by 1% every year. This time it is saying it will decline by 100 basis point, which is 1% every year. Every ambiguity has been removed. So it will decline by 1% every year, right? And then it says it will stabilize at a certain growth rate. What will that growth rate be? They are not clear. In the previous question, they said that it will stabilize at 16%. But in this question, they are not saying what is the growth rate at which the growth will stabilize. Perfect. Then this question say the present value of all these future cash flows. Using the variable growth model, first you calculate terminal value and then you discount everything. The present value so arrived is 172.45 given in the question. This time you don't have to calculate the price. This time you have to back calculate, people in the class, the growth rate which will continue to be there. I'm not giving you the exact formula to calculate, but I'm just trying to explain this particular question to you. What's missing, what was there in the previous question is that this growth was given and we used this infinite growth in the terminal value and then discounted those terminal value along with the initial dividends to find the present value. This time this present value is given, using which we have to back calculate the growth which is used in this terminal value, which is this particular number, which is the growth till infinity. Could I give you a sense of what this question is asking? Question number 19, people in the class. Requesting your responses, please everyone. Just wanted to give you a sense of what this question is, not there to solve it. Hello? So you simply have an equation ready, right, in which this G will be missing, but the present value of future cash flow, which is the value of share, will be there, which you will have to back calculate. Was just trying to give you a sense of question number 19. The rest of it you'll have to solve it at your own. Then people in the classes, question number 21, which you solve now. Question number 21, the timeline, people in the classes here, and this is the question which will belong to alternative 2. Let me explain the question through which I will tell you how exactly and where exactly you apply alternative. Ansh, you want that me to explain again? I can do it for you. Just give me a second. Ansh, were you there in the previous question that we did? Where the question was ambiguous, we had to assume the 1% decline every year and solve the question. Hello, Ansh, this one. So you have to, yes, realize, Ansh, in the previous question we had all these dividends. We had the things needed to calculate terminal value. Terminal value was your D8 divided by K minus G. This G of forever 16% was there. So you calculate TV and you discounted everything to bring it to present value. Now in this question, the next question, question number the next one, which is this particular question. In this particular question, right? What has happened is this particular growth rate is missing. So in that case, sir, how do I calculate terminal value? You do D8 divided by K minus G. You have D8, you have K, but you don't have G. All right, fine. But at least you have the terminal value. Cool. You discount all these future dividends which are there with you and you discount the terminal value. At least put it in an equation and the present value of those future cash flows given to you, given in the question as 172.45. So if you have the present value given in this entire equation, the only number that would be missing is the growth rate, which you will have to back calculate or do the reverse calculation. Could I, Ansh, give you a sense of it? How exactly to do it, you will be able to know only by looking at the solution. Could I successfully do that for you? Please tell me. Come on. Give me a minute. Let me have water. Then we'll proceed ahead with the next question. There, people, back please. Shall we all proceed? You have not responded to me, Ansh, if you are clear with this question or not. I was waiting for your response. Question number 19th is what we are done with. Now, the next one you have to look at is question number 21. People, please pay attention. Yes, sir. Sewell Corporation, a manufacturer of do-it-yourself hardware, right, reported a earnings per share of 2.1 in 2003. The company reported, right? So let me find out that particular this thing. Perfect. Here it is. Cool. So let me rather open another note for you. Perfect, sir. Here it is. So in 2003, company reported an earnings per share of rupees 2.1. So reported means it belongs to point 0. It has happened. It does not belong to future. Fine, sir. On which it paid a dividend of 0.69. It paid a dividend of 0.9. Earnings are expected to grow at 15% per year from year 2004 to 2008. So for year 2004 and onwards till 2008, what is going to be the growth rate of earnings, right? 15%. And the dividend payout ratio is expected to remain unchanged for this period. The dividend payout ratio, whatever it is right now, will continue to remain every year till 2008. Can anyone in the class tell me the implication? People in the class, can you all please, everyone in the class, tell me the implication that if the payout ratio remains same for the next whatever number of years, then can I say the growth of earnings will continue to be the growth of dividends, which means even my dividend will grow at the rate of 15% till the end of year 2008? Requesting your quick responses, yes or no, everyone in the class. Aligned to me, agreed to me. That's really great, everyone. Appreciable people. The presence of mind was needed. That's great. After 2008, the earnings rate will expected to drop to a stable rate of 6%. So this was 2008. After it, the earnings will grow at the rate of 6% only, which it was previously growing at 15. Fine. And the amount of ratio is expected to increase to 65% of the earnings. The dividend payout ratio from after 2008, which means from 2009 and onwards, it will continue to remain 65%. Can you tell me, can you first of all feel that the payout has changed? Let's check. Sir, at year 0, the payout was 0.69 divided by 2.1. It was around 32.8, 32.86 something. But now it will change to 65%. Can anyone in the class tell me, due to change in the payout ratio, what is the implication? The implication is that, sir, between these 2 points where the payout has changed, the growth of earnings and the growth of dividend will not be same, it will be different. All right, sir, fine. But please observe the point of clarity which I want to tell you here is that after 2008, which means from 2009 and onwards, will the payout ratio be same every year? Yes, sir, it continue to remain 65 every year. Fine. So in that case, will the earnings and dividends growth be same every year? The answer is yes, which means after 2000 dividend of 2009, the growth forever is 6% per annum. This is a point of clarity. Please, everyone in the class, validate to me. Could I communicate it to you? Come on. So till 2008, the dividend is 15 because payout is same. From year 8 to year 9, the payout is, the dividend growth is something else only which we don't know because the payout is changing. But after 2009, the growth of dividend, people in the class, is forever 6%. Please, please, please tell me. You will have to validate it to me. Could I convey this to you? Requesting people in the class your responses. Hello, everyone, everyone, everyone. Come on. But I just explained it once more, saying that if the growth rate is, the payout ratio changes from 32.8 to 65, the earnings and the dividends growth are not same, they are different. Cool. But after that, the growth forever continue to remain 6% because then the payout ratio is every year same. So EPS growth of 6 become DPS growth of 6. And you know what is the point of clarity of concepts? You remember I said that what matters to you is not the growth of earnings but the growth of dividends. Hello, what is D1 divided by K minus G? G is the growth of dividend. So you will never have to look at the growth of earnings, boss. What ultimately matters to you is the growth of dividend. Perfect, sir. Fine, sir. Aligned. Can you all tell me what is the exact point? Look at the growth of dividend timeline, not the earnings timeline. What is the exact point at which if I stand and look at the future, I will have a forever same growth rate? People, please comment down. What is that point where you feel the growth is forever same at the rate of 6%, sir? That is at the end of 2009. Are you all aligned to me? And that is exactly where you have to apply alternative 2. Sir, you stand at 0 point doing the valuation. Wherever you see that in the future year, the payout ratio is changing. Whenever in the coming year, the payout ratio changes, then that is the point where you apply alternative 2. Sir, I identify the growth to be forever constant from 2009 onwards, but alternative says that you have to go a year back and calculate the terminal value there. You have to calculate terminal value 2008. Calculation is easy. Coming to this conclusion that you have to calculate terminal value 2008 was difficult. I mean, difficult as in very conceptual. Easy for us, but conceptual. Could I explain that why do you have to calculate terminal value 2008? So calculating terminal value of 2008 involves taking the dividend of 2009. Yes, sir. TV8 will discount all the dividends from D9 till D infinity, bringing all the dividends from D9 till infinity to terminal value 2008. Fine, sir. And after that, I will manually discount the dividend from 2004, 5, 6, 7, 8, 9 and the sorry 4, 5, 6, 7, 8 and the terminal value of 2008. I will manually discount from D4 to D8 and bring them to 0 point along with the terminal value of 2008. That simple is the flow of the question. Now I'll tell you, the examiner says the firm has beta of 1.4 correctly. After 2008, it will have a beta of 1.1. So this particular phase, the point where we calculate terminal value, after that the beta is 1.1. Before that the beta is 1.4. Due to change in beta, what will change? The cost of equity. Sir, we have been given the market risk premium, matlab RM minus RF has been given, and the risk-free rate of 6.25 has been given. I'm not showing you the KE calculation. Beta into RM minus RF plus RF give you the KE. So here beta is less, which is why K is less. Here the beta is more, which is why the K is more. Now I have to guide you the practical implication. Sir, how does your table look like? You have to please pay attention. Now I'm giving you a practical question solution tip. An alternative 2, wherever you apply alternative 2, listen to me carefully. Wherever you apply alternative 2, you have to make sure that you don't make directly DPS column, but you have to also make the EPS column. But sir, why do we need EPS column? What is the need of EPS? Because if I ask you to calculate terminal value 2008, you need the dividend of 2009, aligned, sir. Can you calculate the dividend of 2009 directly from dividend of 2008? No, sir, this growth is missing. We don't know this growth. So in that case, what do? You have to take the earnings of 2008, calculate the earnings of 2009, multiply 65% of payout ratio so that you can calculate the dividend of 2009, which means, do you understand my point? You need the number of EPS for the next years till 2009 so that you can calculate the dividend of 2009, which can be used in the terminal value of 2008. In conclusion, you have to also make an EPS column here, right, to be able to find the DPS which will be used in terminal value. Boss, the detailings that I'm trying to give you from exam point of view is making your life knowledgeable, or it is making your life, very effort taking, or rather you are finding it burdenful, like you're finding it burdensome to have so much of things known in a particular question. Please. And answer to question is yes. People, I need a validation. The things that I'm sharing, that is adding value or that is adding burden to your brain. What it's adding? Come on, recorded people, you'll have to respond to me on this. Live people sitting here, what do you all say? Are you getting the point that I'm trying to tell you? It's not adding confusion, right? Yes. So shall we all proceed with that mindset? Perfect, sir. So we all realize that wherever change in a payout, we have to apply alternative to, and wherever we apply alternative to, we have to make a column of EPS as well, right? Ansh says, exactly. Ansh, answer to your question is yes. Sir, let's proceed ahead. We will say, sir, the EPS at 0.2003 was 2.1. So let's grow the EPS by 15%. Let's grow the DPS by 15%. So DPS was 0.69. Adding 15% of growth, people in the class, for the next 5 years, give me the EPS and DPS for 2008. The EPS of 2008, I have the EPS is there, the DPS is there, but I couldn't have this growth directly to be added, right? Please observe, there is nothing here, it is rather missing. It is rather people in the class missing here. So what do I do now? Sir, now to the EPS of 8th year, if I add 6% of growth and multiply it with the 65% of payout ratio, will I get dividend 9 to be used in terminal value? Yes. Sir, this is the EPS of 8th year, 4.22. Adding 1.0, multiplying 1.06 to it and multiplying 65% to it directly give me D9. D9 divided by K minus G will give me the price or terminal value at the end of 8th year, which is 4.224 multiplied by 1.06 into 65% divided by 0.063, which is 12 minus 6%, giving me 46.19 euro, people in the class, as the price at the end of 2008, which is the terminal value at the end of 2008. Now there is a catches. After 2008, the beta was 1.1, which is why K was 12.3. Point of learning, I'm repeating the point of learning, right? Which is why everyone in the class, please pay attention. To discount all these future cash flows using Gordon's model, what does Gordon model to discount these future cash flow? What is the rate you will use? You will use a rate of 12.3. Done, sir. Once this is done, you have the terminal value at 2008. Now is the turn to manually discount the dividend from 4 to 8, 2004 to 2008, and manually discount the terminal value of 2008, for which the discounting rate to be used in the solution is 13.95. So I will say now the discounting rate to discount these dividends manually is 13.95. In fact, the terminal value of 2008, 46.19, this will also be discounted using 0.521, which is the present value factor at the rate of 13.95. When you discount them manually, the price, people in the class, turns out to be 27.61. Everyone requesting your responses. How do you manually do it? Now you can afford to do it. My point was to explain the discounting rate to be used in the respective parts and application of alternative to, right? You must be wondering, sir, how do we remember such things? But let me tell you, the OutNotes, the link of which I told you, is very specific. See, if the question is of payout ratio, sorry, alternative one is preferred, however, two is to be applied whenever the payout ratio is changing in the future year. That is one thing. Second, whenever the payout ratio is changing, the growth cannot be applied directly to DPS. Such growth is rather applied on EPS, and then the DPS is calculated using payout ratio. In that case, the presentation will have one additional column of EPS before DPS. Could you all understand? The things have already been all there in your OutNotes, the concepts notes that you're referring to. Perfect. Sorted, everyone in the class. Question number 21 here gets done. Question number 24. So let me check before that what's so important. So 21 is there. Previous question is 20, which does not have anything great beyond what we have learned. 19th and all I talked about. Before that, we are all sorted. Cool. So the next question that you have to learn is this particular question, question number, people in the class, 24. Right? 24th is what you have to learn. Come on. Come on. Ready are we all? Ready are we all? Please tell me. The LDR PDF has already been shared. The link in the description has everything. People requesting your responses. Are you all ready for the next question? This may be the last question for this entire topic of dividend discount model. I'm not going to solve this entire question, but only trying to give you a sense of what is to be done just after explaining the question. Yes. And now you will realize that learning in a way which is really logical sorts out everything. Do you remember I said whenever the change in payout ratio is there, you have to apply alternative to? You will see one more example of it happening in question number 24. I just need your response on this particular thing. How many of you have been applying alternative to anyways in this particular situation? How many of you knew that this is alternative to and this is what you have to apply when there is a change in the payout ratio? Just need a response so that I can get to know how much of your learnings have been new, or is it just the revision of things that you already knew? People, shall we all? In the meantime, by the time you're responding, proceed ahead. So, if no new learning, right? If you knew this, then should not be. Oh, for you it was a new learning. For the batch students, for the students who have taken the batch from me, it should not be a new learning at all. For you, it should be revision. And in which case, you should not be finding anything hard so far. Perfect. Other live people sitting here, we are proceeding ahead and let's learn what it says that Sam has just paid a dividend of rupees 2 per share. Just paid a dividend of rupees 2 per share, which means it's zero. It is expected to grow at the rate of 6%. After paying the dividend, the board declares to take up the project by retaining the next 3 annual dividend. They need to start a project for which they will need money. So they have planned that they will retain the next 3 dividends. They won't distribute it to the shareholder. It is expected that project is of the same risk as the existing project. Since the risk is same, therefore the required rate of return means the KE will be same even in the new case. The result of this project will start to come from the fourth year from now, and the dividend will then be 2.5 per share, which will grow at the rate of 7%. Please understand the two situation. Previously, it was 2 rupee of dividend distributed in year 0, which was expected to grow at the rate of 6% forever. But now, in the revised case, after taking up the project, there is some earning which I don't know. But those earnings will be entirely retained and the dividend will be zero. But from year 4 onwards, I will distribute my first dividend to be of rupee 2.5, which will then forever grow at the rate of 7%. Do you understand the question has been, decoded into the timeline? Come on, requesting your responses. Fine, sir. An investor who has 1,000 share in Sam Limited. So let's ignore this particular line for now. They're asking evaluate whether the market value of the share is affected by the decision of the board or not. Will the market value change? Yes, sir. In this case, where the 6% growth was forever there, the market value would have been D0 into 1 plus G, which is 2 rupee of dividend plus 6% growth rate forever, divided by K given in the question is 8% minus 6. So 2 plus 6%. 2 plus 6% divided by 0.02 give me a value of 106. However, when the things change, my EPS will continue to remain forever, but the dividends people in the class will be zero, and after a point it will become 2.5, which will then grow by 7%. I want to ask my first question to you all. People in the class, if you're sitting here, please participate. This is everyone. This is people in the class. Which model? Gordon's model, constant dividend model, or variable growth model? Please. I need a validation, people, if you're sitting here looking at me, listening to me. Which model this one particularly is? Please tell me. Come on. Which model particularly this one is? Bia says constant growth model. Sai says it's variable growth model. Others in the class, you participate, you learn. Is it that the dividend is growing forever at a constant rate? Look at the dividend line, not at the earnings line. Can I say dividend for the first 3 years is 0? Then the dividend become 2.5. Then it become constant like 7% growing forever. So it is a variable growth model forever, not a constant growth model at all. Gayatri, BR, do you have this point of learning clear to you? Dividends in the first 3 years are growing at a 0 rate. Then it grows at a particular rate. Then it grows at the rate of 7% forever. Is it a constant growth model? No, sir, not at all. It is variable. Question 2 is alternative 1 or alternative 2. Which model, which alternative will you apply to this particular question of variable growth model? Sir, you said wherever there is a change in payout ratio, you apply alternative 2. Do you people agree? The payout ratio, everyone in the class is changing. Initially, the earnings were there, but company decided to retain those earnings and distribute 0. Distribute 0, which is why the payout ratio was 0%. Then again it was 0, then again it was 0. But then, sir, after a point, it has started to distribute some dividend, which means it would be some payout ratio, but not 0. So is there a change in payout? Yes, sir. Will you apply alternative 2 in that case? Yes. Can you all please identify for me the point from where the growth is forever constant? Sir, that is fourth year end, after which the growth is 7% every year. Fine. So as per alternative 2, I should calculate the terminal value 4 or terminal value 3. Sir, I will calculate terminal value 3, which will be D4 divided by K minus G. Terminal value 3 will be what? D4 divided by K minus G. So do you agree D4 has directly been given? K minus G, K has been given as 8% and the new growth has been 7%. So D4 does 2.5 divided by K minus G give you the terminal value at the end of third year. To calculate the value here, I have to discount the manual 3 dividends manually and this terminal value. The 3 dividends people in the class are 0, so I have to just discount the terminal value of third year end, and then I will say present value factor, this terminal value is to be multiplied at the rate of present value factor of 3 or 8%, gives me the value of share to be today as 198.5 as per alternative 2. Come on. Come on, come on, come on. Is third Rani? Rani, is that your first name? Rani, is that your first name? Vishal, you're answering the question, but it seems that you're lagging a few seconds behind. Same seems to be the case with Ansh. People in the class, I need a validation. Could I explain this entire question to you all? Please tell me. Come on, come on, come on. Please tell me. Sai, I am doubtful. Examiner should give you marks, but in some cases it happens that institute is not able to give you marks because at the end of every step the answer will not match. In this case it is fine, but in the previous question that we did, that 2003-2008 question, they first ask you to calculate the value for at the end of 2008. If you check the previous question, you will realize that you are bound to apply alternative 2. Miral, it's clear. Everyone else, please validate so that I have a comfort that I can proceed ahead. So they are asking, does the share price affected? We will say yes, the share price changed from 106 to people in the class 198. That's done. That's done. Perfectly fine, sir. Great. Second part of this question is a common sense, right? You will have to do it at your own, just trying to give you an idea of it. It is saying that there is an investor who has 1000 share of SAM Limited. 1000 share of SAM Limited in the sense that company, I am holding 1000 share of the company, right? Where the company was paying 2 rupee of dividend initially, sir, I was having a 2000 rupees per annum of inflow to me as an investor. Cool. But now when company decides to retain the next 3 annual dividend, how do I get my cash flow? How an investor can maintain the target receipt, right, after the first 3 years? So common sense is really simple. If the company does not give you dividend, you can decide or choose to sell the shares of the company in the market such that you can receive 2000 rupee. Fine, sir. So you have to find out at the end of year 1 and year 2 and year 3 what are going to be the share prices at which you will sell those share. So common sense is really simple. Sir, I discounted the terminal value back to year 0 using 8%. Correct? Fine, sir. If I have to find out the value here or here or here, can I compound it back at the rate of 8%? When I discounted it at the rate of 8%, I can compound it back at the rate of 8% to find the price at the end of year 1, 2 and 3. correct? So I compounded it back. I say 198 is the 198.5 is the price. Let's compound it at the rate of 8%, then for 2 years, then for 3 years to find the price at the end of respective year end. And then is common sense. I want to receive 2000 rupee. Price at the end of first year is 214.38. Simply divide 2000 with this number to find the number of share you will have to sell. It is 9.32 shares that you will have to sell. Correct? That is, you cannot sell the share in fraction, meaning to say you will have to sell 10 shares. Similarly, next year, if you want to receive 2000, the price become 231. Dividing it will give you selling of 9 share. In the third year, you will have to sell 8 shares. That is how people in the class, the B part of this question is to be solved. Come on, requesting your responses. Second part of this question, I was just trying to give you a sense of it, not explain it entirely, right? Could you otherwise understand this entire question, question number 24? Please tell me. I need your validation. I will then give you a sense of what question number 27 is. Esther, you are lagging behind, I think. Can you come to the latest point where this class is going on? Question 27 has this particular doubt which a lot of students ask me, right? The question says that you are initially buying a share. In the fourth year, share is going to give you a bonus of 1:5. Meaning to say, if you are having one share today, at the end of during the fourth year, you will have 1.2 shares. Against 5 share, if you get one as bonus, then against one share, how many shares do you get as bonus? Sir, 0.2 shares. Correct. So in total, you will have how many shares after 4 year and onwards? Sir, 1.2 share. Which means you are going to receive the dividend on how many shares? Sir, 1.2 shares. Initially dividend was, people in the class, how much? 20%. Right? So if 100 is the face value, 20% give me 20 rupee of dividend. But on that 1.2 shares, then I'll start to receive the dividend of 24 rupee. And most important, at the end of 7th year, when I go to the market to sell that share, I will have price of 900 rupee multiplied by 1.2 shares, which I'll be able to sell in the market, right? Ignore this 0.95 for now. Could you only understand my point that when there is a bonus ratio given to me in the question, it means that my number of share will increase, and accordingly on those increased shares I will receive dividend. I will be able to sell those shares in the market, and so on. Requesting people in the class your responses, please. Requesting people in the class your responses, please. Tell me. So else we are fine, else we are set, we are done with this particular question, right? And now we have to move to the next model. So the first model, dividend discount model, which has the maximum number of questions asked in the past 17 attempts, has been done. All the people who are planning to do the timestamping, a reminder to you, we are starting with the next model. Please timestamp. We are starting with FCFE, FCFF. पंकज, कर दो भाई, कर दो। कर दिया एफआर स्टार्ट कर दिया क्या पंकज, कि अभी भी एएफएम पर हो? So others must be wondering what the hell suddenly has started going on. So there's a student who did this Hinglish revision, who attended the similar marathon in English language, is now here just to like the video. That is the level of commitment and dedication students have here towards the teacher. That's really great. So bye Pankaj. I'll see you, all the very best for your FR preparation and for your exam. Yes. So guys, bringing you all back to the next model, which is FCFE and FCFF model. Shall we all with that proceed? Yes, everyone? Sir, really simple and really easy. Let me take you all to the concept notes. Do you people, first of all, realize the underlying logic of this method is again the same? FCFE, FCFF valuation method says that present value of future cash flow is the value of share. But this time the cash flows are not the future dividends, but the cash flows are the cash flows generated by the company for the equity shareholders or for the capital providers. We will do in this topic we will learn this concept from two perspectives. First, where you have to think only from the point of view of equity. Second perspective is that you have to think from the point of view of all the capital provider, which is equity plus debt plus preference, which is from the perspective of entire firm, right? The point is these people value the company on the basis of present value of future cash flows which these people generate. So we will have to find out the future cash flows generated by all of them, called as FCFF, free cash flow to firm, and then we have to find the free cash flow generated only by equity, called as FCFE, right? So you have to understand that company while doing operation generates the cash flow. Those cash flows have been passed on to the capital providers, from which if the equity and from which if the debt and preference shareholders have been paid, the rest of the cash flow will be passed on to the equity. The total cash flow passed on by the company to all three of them, it is FCFF, and then the net cash flows passed on to only equity after making the payment to debt and preference is called as FCFE. So let's first learn pay attention to FCFF. Sir, the profit that company generates is EBIT into 1 minus T, which is NOPAT, net operating profit after tax. This is profit, this is accrual, to which you add back depreciation, from which you deduct working capital, from which you deduct capex. Once you do these things, that is the amount of cash which company says that this is available to be distributed to the capital providers. We call it FCFF. As compared to this, when we talk about FCFE, we start with the profit, but the profit that belongs to PAT. Remember common sense. FCFF, you start with the PAT that belongs to everyone, which is EBIT. In case of FCFE, you start with the profit that belongs only to equity, which is PAT. So to the PAT, when you add back depreciation, to the PAT, when you deduct working capital, and from the PAT, when you deduct capex, you get the amount which is available to the capital providers, from which you have to deduct the payments related to debt and preference. What you pay to debt is interest or the principal repayment or borrowing. Do you agree while calculating PAT, the interest has already been deducted? People in the class, pay attention. While calculating PAT, the interest has already been deducted. So after making the deduction of interest from the PAT, now we need to only deduct if there is a repayment to them or if there is borrowing from them, have to add it. Similarly, if there is a preference dividend paid to the preference shareholder, it is to be deducted. If there is a repayment to the preference shareholder or issue of share, raising of money from them, it is to be added. Everything else has been done, and that's how you get the cash flows, which is ultimately available to the equity shareholder, FCFE. So the first thing that you should be 100% clear about in this concept is the calculation of FCFF and calculation of FCFE. Once you validate it to me, I'll take you to the next level. Come on, people in the class. Are you all aligned to me on this? Are you all settled? Come on. Come on. Please come to the latest live point where the class is going on. Perfect. Aligned to me, settled to me, with me. Perfect. Sir, I know these are the future FCFF that will be generated over the years till infinity. If I discount all these FCFF, I will get the value that belongs to everyone, which is called as value to firm. Let me tell you, if cash flow belong to everyone, the value that you get will also belong to everyone. It is called as value of firm. And the discounting rate used to discount the FCFF is the KO, which is the rate of return of everyone. So KO, which is the weighted average cost of capital, is simply cost of equity into weight of equity plus cost of debt into weight of debt plus cost of preference into the weight of preference. You have to realize one important thing, the weights to be used. See, KE calculation you have learned in dividend discount model. KD calculation is nothing but interest rate into 1 minus T. The rate of interest on the debt multiplied by 1 minus T. The weights, people in the class, has to be, in the first priority, it should be the target capital structure. If the examiner give you any target capital structure, that should be your first preference. Then the second preference will be should be people in the class the market value, and the third preference should be the book value of equity and debt if the market values are missing. That is how you'll have to do it. Now when it comes to KE, everyone in the class, you will have to use the dividend discount models, because FCFE is the cash flow, then you will have to use KE. Now is the common sense. All these future FCFF, if you discount, means if you calculate the present value at the KO, you get the value of the firm. Similarly, all these FCFEs, if you discount them at the rate of K, you get the value of equity. Now again, there can be three possibilities of discounting: the same cash flow every year, constantly growing cash flow every year, or variably growing cash flow every year. Right? If the cash flows are constant every year, it is FCFF1 divided by Q, or FCFE1 divided by K, directly give you the value of equity or firm. Similarly, if the cash flows are constantly growing, then you have to apply Gordon's model. FCFF1 divided by KO minus G, FCFE1 divided by K minus G. However, if the growth is variable, then you have to apply the terminal value approach. You have to identify the point from where the growth is forever constant. That is the point where you apply terminal value. So you have to do the present value of terminal value plus manually discount the cash flows till the terminal value point. For example, you'll have to manually discount the cash flows for the 4 year and the terminal value of fourth year to arrive the value of the firm or the value of equity, as the case may be, right? And at last, suppose you have the value of the firm. Then if you deduct the market value of debt and preference, you'll be able to calculate the market value of equity from the value of the firm. And it can work otherwise as well. If you calculate the value of equity using FCFE approach, then you can add the value of debt and preference to it, the market value of them, and get the value of the firm. That simple is everyone in the class doing the valuation of a company, of like equity of a company or the firm, entire firm itself, using FCFE FCFF model. Requesting your responses, another very repeatedly asked topic. Could I make it clear? So possibility one, we may be needed to calculate FCFE FCFF. Possibility two, we may be needed to calculate the discounting rate. Possibility three, which has to be there, which is we have to discount the cash flows. Done using one of the three models. If you are clear with the concept, I'll immediately take you to the practical question and then proceed ahead. If the examiner was not clear in case of dividend discount model, we assume the dividend to be D1. However, in this case, if the examiner is not clear, we always assume the cash flow to be of year 0, FCFE or FCFF 0. Let me take you all to the practical question, and that's where you learn the thing is really so easy to execute. Question number 30 is a category B question actually, which has a small point of ambiguity. You'll have to look at your own. Question number 31 is the question from September 25 attempt, which we are going to do right now in the class. Ready are we all for the solution of this question? Ready? Yes. So let's people in the class proceed ahead with this amazing question asked in the attempt of September 25, and let's check if you're able to crack it at your own or not. Yes. ABC Limited share is currently trading at a price of 192.5. Alright, sir. Ronnie is planning to purchase the share of the company. For this purpose, it has taken the services of financial analyst to know whether the price of ABC is fairly priced or not. Sir, in short, the share is trading at 192.5. You want to value the share. The analyst has assembled the following information. The before tax required rate of return of ABC, debt, preference, and equity is 8.6, 11, and 13. Three things in my capital structure: debt, preference, and equity. All three of them has the pre-tax required rate of return of 8.6, 11, and 13.6. Sorry, only 13. The target capital structure is 20% debt, 30% preference, 50% equity. The market value of company's debt is 275 and its preference share is 120 million. Sir, the free cash flow of the firm for the year just ended is 125 million. Sir, what a luck. The FCFF has been given to you. We are lucky enough that you don't have to calculate it. Do you understand the point I just made? You don't have to think about EBIT, 1 minus T, deducting depreciation, sorry, adding depreciation, deducting capex, deducting working capital. No, the final FCFF for 0 point for the year just ended has been given to 125. FCFF expected to grow at the rate of 8% for foreseeable future. Please tell me which model. Constant cash flow, constant growth, or variable growth model? Please, waiting for your responses, everyone. Sir, tax rate is 30%, though 20 million shares are outstanding. As a financial analyst, on the basis of value per share, advise Ronnie whether he should purchase the share of the company or not. We have to summarize the things now. What do you have to summarize? The growth people in the class as constant, right? That's great, which means you realize we have to apply Gordon's model. Sir, one thing I'm not clear about. I have to find the value per share, because I will then be needed to compare the value so calculated with the CMP, which is already there at 192.5. Then you comment on the CMP. If the price in the market is overvalued, you say don't buy the share. If the price in the market is undervalued, you say buy the share. And that's how you have to do it. Perfect. But sir, I'm not able to understand, if I have to calculate the value of share, why am I using the details of FCFF and KO? I can directly use FCFE to find the value of share, right? But sir, if they have given the information regarding FCFF, you will have to use them. But sir, in that case, I'll get the value of firm. And I need ultimately the value of share. Do you get my point? What is the next step you will have to do? From the value of firm, everyone in the class, if you deduct the value of preference share and the value of debt, the market value of them, then you will get the value of equity, which if divided by the number of equity shares, you get the value per share of equity. Did you all could imagine this? Perfect, sir. Fine. So let's handle it one by one. It's a Gordon's model. So I need FCFF1, I need KE, KO, and I need G. Is the FCFF1 is there? Yes, sir. FCFF0 is there. Is the growth rate there? Yes. So all I need is KO. Sir, if I have the pre-tax KD, can I make it post-tax? Yes, sir. Multiply it with 1 minus T. For cost of reference and cost of equity, there is no tax benefit. So let's focus on KO. Cost of debt into 1 minus T into its weight of 20%. Cost of reference into weight of reference. Cost of equity into weight of equity. You get the KE of 11%. KO of 11%. So FCFE, people, FCFF 0 into 1 plus G divided by KO minus G. When you solve it, you get the value of firm to be 4500. From 4500, if you deduct the market value of debt given in the question, market value of debt 275, equity preference is 120. If you deduct the two market values, you get the value of equity to be 1405 divided by 20 million number of share give you the value per share to be 205.25. According to me, value should be rupee 205. The price in the market is 192. I will say the share is overvalued. It should purchased. Sorry, share is undervalued, underpriced in the market. It should purchase the share. Yes or no? Everyone in the class requesting your responses. Yes or no? Quick, people. Everyone requesting your responses. Could you connect to the flow of the solution? Done. Align to me on this. So the next thing is really brilliant. Out of the box, people, it says that assume that we are able to get same value of equity as calculated in part 1 using FCFE approach. Suppose the value of equity that you have got 4105, the total value of equity of 4105 that you have just calculated. If you have to get the same value of equity using FCFE approach, calculate FCFE for the year just ended. What will FCFE be if expected to grow at the rate of constant growth rate of 8.5%? Meaning to say, now my discounting rate will be, people in the class, what K? For FCFE, what is the discounting rate K? So if the discounting rate is 13%, if the growth is 8.5%, right, given in the question, then what should FCFE0 be for me to get the same value as I have got in the first part of this question is the question. I don't need an answer, I just need a validation. Could I explain the question? I don't need an answer. But tell me, could I explain the question? That what should that FCFE0 be that at the rate of 8.5%, if it grows where the discounting rate is 13, I get the same value as I've got in part 1 of the question. And in this entire equation, only one number is missing, which you can somehow calculate. I don't want to teach you the solution of I don't want you to teach you how to solve it, but second part of the question is really that simple, where we say in this entire equation only FCFE is missing. If you calculate it, become 170.25. That was such a brilliant question, question number 31 that we have done. Another question that you're gonna solve is question number 33. People. In this question 33, this part belongs to dividend discount model, which I'm not interested to teach you. What I'm trying to teach you is the FCF or FCFE model or F model here. We are proceeding ahead and you are going to, people in the class like it. Yes, let's proceed ahead. On the basis of following information, calculate the value of share. What is the information given? PAT of the company given 290 crore. Equity capital is 1300 crore. Value per share is 40. So using equity capital and value per share, can you find the number of shares? So 1300 divided by 40 give me the value per share to be 32.5. Aligned? Sorry, the number of share to be 32.5. Fine, sir. This much we are sorted. Cool. Debt ratio of the company is 27%. You have to realize one particular thing. When you say debt ratio, everyone, it is not debt to equity ratio. It is debt as a percentage of total capital employed. It is debt divided by debt plus equity. The total capital employed denominator is 100, then 27% of it has to be debt. Cool. Long-term growth rate of the company is 8%, beta is 0.1, risk-free rate 8.7. The market rate of return RM is 10.3, capex per share is 47, depreciation per share is 39, working capital change is 3.45. The value of share, people in the class we have to find. Take 30 seconds, read the entire question. I mean, read this question from this point to this point again, and then I'll ask you some questions. Take your time, read the questions. Thank you so much for taking the likes of this video to 50. But anyone who's watching this video later on, I would want that we can make this likes to reach to 500. Yes, so that I get enough motivation to record in the coming attempt a fresh marathon again for you guys. So anyways, read the question again, giving you a minute. Do you people first of all realize that to find the value of share, people in the class, to find the value of share, everyone, we have to use the cash flow based valuation model, not the dividend discount model, obviously, because capex, depreciation, etc. things have been in. My question to you is whether you'll use FCFE or FCFF. That's the biggest question. That always depends on the data of the question. In the previous case, FCFF was given. Things needed to calculate KO were given. So we didn't have a choice rather than to apply FCFF. But now here in this case, do you agree PAT has been given? Not EBIT. And we don't have the information to calculate EBIT. Second. Do you have the information of cost of debt using which you can find KO? No, sir. Information regarding beta RMRF is there, which means KE can be done. So if PAT is given, KE is given, isn't it an FCFE approach you have to follow? First, conclusion appreciable. The second one, people in the class, please tell me, which model is this? FCFE I will find, discounting rate KE I will find. What model is this? Is it a constant growth model or constant cash flow model or variable growth model? What do you think? Do you know what? A very important point here. When I ask you these questions, the objective, the inner objective that I have, that I've never told you, is not to get answer to those questions. But the inner objective that I have is with these questions, you will learn to think, boss. You will learn that when you're solving these questions at your own, this is how you'll have to think. Figure out the model applicable, figure out whether it's FCFE, FCFF, figuring out whether it is this constant growth or constant cash flow or variable growth model. The point here is learning to think the way we are learning in the class. Are you all aligned to my thought process, people? This answer you give me is fine. But more than that, you should feel that we are not just barely solving the questions, we are first learning the concepts conceptually and then applying those concepts in these practical questions. Can you all feel that applicability? That is the main point we need to connect on. Let me tell you on that. For a lot of years, we talked about conceptual clarity. So everyone started talking about conceptual clarity, which is fine because exam pattern turned out that way. But now we have gone beyond it. For us, the conceptual clarity is obvious, but application of those concepts in the practical question is the another area where the students feel lack. They are not able to apply them in the questions, which is what my focus in this marathon is. Requesting your responses, can you feel the application of things that you learn in the OutNotes out here in these practical questions in the OutScanner? Yes. Your thought process should be same as what you've learned in the OutNotes. So I will now say, people, I need a response on this. I will now say, sir, I know it is a constant growth model. Why? Because growth has been given to me. Has any variable growth been given? No, which means in the absence of information, it is constant growth. So let's people in the class proceed ahead. Let's first find FCFE. Now there is a point of learning in this question. CAPEX has been given per share, depreciation is per share, working capital is per share. Do you people agree? In that case, it makes sense to start with the PAT per share. If I have been given the total PAT of the company, let me divide it with the number of share we found. Let's divide it with the number of share we found to find the per share PAT. So it's like 290 divided by 32.5 give me 8.92 crore as the PAT per share, which is your EPS. So to the PAT, you add depreciation, you deduct working capital, you deduct capex. So adding 39, deducting 3.45, deducting 47. Do you agree the initial addition deductions have been done? Now, if there is an interest paid to the borrowing, that's already deducted in EPS. If there is a repayment of debt or borrowing from debt, then it is to be adjusted. In the question anywhere, do you see any borrowing from here to here? Do you see any borrowing or repayment which has happened? The answer is no. No information given, and that is the hidden adjustment that I'm trying to teach you now. Very important in this question. You can say this is the adjustment for which we are solving a question. You have to please imagine the balance sheet of the company. Do you agree in the balance sheet of the company? Company is planning to make two new investment. 47 in the fixed assets of the company. 47 in the fixed assets of the company and 3.45 in the working capital of the company. So company needs total of 50.45 rupees to make the investment. Out of this investment of 50.45 to be made, sir, amount of 39 rupees is available in terms of cash. Do you agree depreciation is a non-cash expense? Which means when the depreciation is deducted in the income statement, the profit gets reduced, but the cash does not go out. Requesting your responses, could you connect to my point here? Profit gets reduced, the cash does not go out. Even if that entire profit you distribute in the form of dividend to the shareholder, listen to my point, that profit which comes after deduction of depreciation, even if that entire profit you distribute to the shareholder in the form of dividend, but the amount of depreciation, right, remains in the form of cash in my balance sheet. Could you connect to this, yes or no? Yes. Which means, can I say out of this total investment of 50.45 to be made additionally in the fixed assets and the working capital, 39 is available rupee in terms of cash. So from 50.45, if you deduct 39, 50.45 minus 39 give you 11.45 rupee is the additional capital needed, which is to be raised from debt and equity. Yes. Can we raise it in random manner? No, sir. 27% of your capital should always be debt. So 11.45 that you need to raise, 27% of it from me should be from the debt, which is why I will have to borrow that much of an amount. That is what we have done. 27% of 11.45. Give me 3.09 as the borrowing, which is your hidden adjustment here. which is your hidden adjustment here. So I will say examiner will be silent about it, but you will have two people in the class. Please do it. Examiner will be silent about it, but you will have two people in the class. Please do it. And now I will say after borrowing the FCFE is 0.56. Now it's all easy. You can calculate K, doable. FCFE, in the absence of information, you assume it 0. So 0.56 FCFE 0 plus 8% growth rate divided by K minus G give the value of share to be 70.33, which was the question institute was trying to ask. Am I? Everyone in the class. Question number 33, making sense. Yes, boss. There's a great question here by Sai who says that how do you know changes increase or decrease in the working capital? Sai, do you agree company is a growing company? 8% growth, which means my current assets, my stock, my debtor, my everything will increase over the time due to growth in the company, right? An increase in working capital, increase in debtor, increase in the stock, increase in cash, sorry, not cash, every increase in debtor, stock, everything is considered as an outflow, which is why we have deducted the working capital as an outflow, as an investment. Could I answer your question, Sai? Everyone else, please validate to me on this. Are you people 10 out of 10 clear with this particular question 33? Another brilliant question, people, that we are going to solve in the class is this particular question. Let's do question number 34. 30, no, let's do question number 35. Boss, I need your validation for me to be able to go ahead. Are you people aligned to me on this? Can I take you to the next question? Yes, please tell me. Let's do two more questions. I mean, this one and the next one. Or maybe let's do at least this question and then we'll take a 5-minute break. And then again study at a stretch and then we'll take a lunch break. Done, people? So let's now proceed ahead with this another brilliant question. A similar question, if you observe, is 35 and 34, asked by the institute a lot of times. Now let's proceed ahead. Following information is available with respect to XYZ Limited, which is expected to grow at a higher rate for 4 years. Thereafter, the growth will stabilize at a lower rate. Reading the first line, what comes to your mind? Reading the first line, people in the class, what comes to your mind? The growth, everyone is changing. What does it imply? It implies the variable growth model. Divya, happy to see you live. I didn't know you're here. The variable growth model should come to your mind. Fine, sir. Base year information means 0-year information. They say the revenue is 2000 crore. They say the EBIT is 300. The capex people in the class is 200. Depreciation is 200. 218, 200. This information make you people realize that ultimately, if you have to find value of a share, it has to be a cash flow based model and not any other model. Right? Fine, sir. Information of high growth and the stable growth. High growth, which is for a period of 4 years. The information says EBIT revenue will grow by 20%, but once everything becomes stable, right, the EBIT and revenue will grow by 10%. Initially, capex depreciation will grow by 20, but after a point, capex will be offset by depreciation. What do you mean? Do you agree while calculating FCFE, FCF, you start with whatever profit, you add depreciation, you deduct capex, you deduct working capital. So amount of depreciation will be offset by the amount of capex. What you add, the same gets deducted, which is why the net effect is 0 is what they are trying to tell you. Sir, risk-free rate, the equity beta, market risk premium, pre-tax KD and cost of pre-tax KD and debt to equity ratio. These things have been given to me. Do you agree if cost of debt, cost of equity has been given, ultimately KO can be calculated and I will have to use FCFF approach and I have to using that approach find the value of the firm. Boss, requesting your responses. Cool. All time, for all time, working capital is 25% of the revenue, tax rate is 30%. Let's crack the things one by one. I need variable growth model FCFF approach. I need variable growth model FCFF approach. Do you need that I need to calculate the FCFF for the future years? But first of all, can you identify the 0.56 From where if you stand and look at the future, you will say the growth rate is forever constant. People, can you please identify the point based on the data given in the question, from where if you stand, at which if you stand and look at the future, you will say the growth rate is forever constant? Sir, can I say till 4 year the growth rate is higher, after 4 year the growth rate is then constant, which means I have to calculate the terminal value at 4 year. And boss, please like this video, not just like it by pressing like, let me know if you like this explanation or not. People, this is the detailing, this is your imagination of the concept which will give you the clarity to calculate TV4. The cash flow for which year do you need? The cash flow for which year do you need? I need the cash flow of 5th year, which means, do you people agree that I need to calculate the FCFF for 5 year, year 1, 2, 3, 4 to be manually discounted, and the cash flow of 5th year to be used in the calculation of TV4? Requesting your responses, people. That is how with this thought process you get to know that, okay, I need to individually calculate the cash flows for how many years? 5 years. I need to individually calculate first the EBIT into 1 minus T for the next 5 years, depreciation to be added for the next 5 years, capex to be deducted for the next 5 years, and so on. Do you understand? Do you understand? Thought process has to be first built, boss. Then you need to solve the question. Before solving the question, we are trying to learn in this class the imagination of the solution. Sir, what all do you need for FCFF? Let's start. I need EBIT into 1 minus T. Sir, directly available, no problem. I need depreciation capex directly available, no problem. Is the working capital directly available? No. Which means my first working note, people in the class pay attention, has to be to find the working capital change. Working capital requirement is 25% of my revenue. At 0 point, revenue was 2000. Aligned, sir. 0 point revenue was 2000, 25% of it is 500. Year 1, 2, 3, 4, revenue will grow at the rate of 20%. Right, which is why 25% of it is working capital. In the 5th year, revenue will grow only by 10%, so working capital requirement of it will be 25% of the revenue. I don't need the total working capital requirement, I need the change in the working capital requirement. If you realize, for first year from 500 to 600 it is 100 rupee, for second year from 6 to 720 it is 120, and so on. Unless a student unless the student knows that I need FCFE, FCFF for 5 years, he cannot figure out the working capital working notice to be made for how many years. Do you connect what I said? How many of you could understood what I just said? You have to first figure out that, okay, I need FCFE, FCFF for 5 years, for which you have to identify where my terminal value should be. Then only you can figure out the working note for working capital is to be made for how many years, right? Do you get the clarity of applicability of the concepts needed in the practical questions? Yes. So first, sir, first thing, working capital is done. Now let's proceed ahead with calculating FCFF for the next 5 years. Yes. What it says, sir, EBIT given to me as 0 year as 300. So plus 20%, 360, plus 20, plus 20, plus 20. But then it is plus 10%. Fine, sir. Next, multiplying 30% of tax rate, so I get NOPAT, which is EBIT into 1 minus T, which is there with me. Now, sir, depreciation. Initial depreciation that I added was 20. Now I have to add plus 20%. So 240 plus 20%, 288 plus this. Then at the end, it is compensated in the 5th year by CAPEX. Then CAPEX, in the first year, what we deducted was 280. So now you deduct 280 plus 20% was 336 plus 20 plus 20 plus 20, then it is 0. Working capital change you can take from this working note 100, 120, 144, 172. So the working capital change is here. And ultimately, I can find the final FCFF for the next 5 years. If you give me the permission, I know I have FCFF, no, I need to now discount which, for which I need KO. Is it fine if we don't proceed to calculate KO using this information? Boss, please. I can calculate K using CAPM, then I can calculate KD, then I can calculate KO using the weights. So I know for the first 4 year, KO will be different, then for the next 4 year, KO will be different. It is similar to a previous sum we had done. From 2003 to 2008, discounting rate was different. From 2008 and onwards, discounting rate was different. So I'm not calculating the KO, just directly using those numbers. So let's say the KO I have is 13 and 12%. So please pay attention. I need to manually discount the cash flows for the first 4 years. So 56, 67, 80, and 96 to be manually discounted. And fifth year's cash flow of 375 to be used in the terminal value calculation of fourth year. So FCFF 5 divided by K minus G. Now is the point you have to pay attention. Terminal value represents the cash flow from fifth year till infinity, from 4 to infinity, where the discounting rate of 12 is applicable. But once I have the terminal value of fourth year, so the cash flow of 4 year along with the terminal value of fourth year is to be discounted at the initial discounting rate of 13. DCF will give me the value of the firm. Boss, requesting your responses. Could I, people in the class, make you really understand in a proper way what this exact question was? How much out of 10 for this question is what you need to validate? Please, please, please. Every single student sitting here. Question 35th. Done? Are we really 10 out of 10 on it? I want to make sure that every possible minute that you have in this video is worth. I can tell you everything that I could through this marathon. 35th gets done. The one more question that we need to do on this is question number 37, before which I feel if we can take a quick, people in the class, 5-minute break. Yes. So it is 11:20 right now. We are going to meet back at 11:25 and then complete this question and complete FCFE, FCFE model. And I think the next model then we have to take will be the economic value added. Sorted. So let's take a quick 5-minute break. We are meeting back at 11:20. Sorry, 11:25. All right, guys, stay tuned, stay aligned, and that is how you are going to make this marathon really worth. So I'll see you after 5 minutes. Bye. So are we all there, everyone? Please tell me. Just a second. Yes, boss. There are we all. Shall we proceed ahead? Back, people. So, this 37th, another brilliant question. And the timeline presentation of this question will further blow your mind. Yes, what it says. Generally, everyone in the class, I'm proceeding ahead. Generally, what do you do? Generally, sir, if I have the cost of equity and debt of equity, fine, sir. And if I have their weights, I can find out the weighted average cost of capital, which is KO. Perfect, sir. Using this cost of capital, using the FCFF, suppose examiner gives you FCFF, and suppose examiner give you the growth rate of 9%. So using the FCFF and using the growth rate and using this cost of capital, can you find the value of the firm? The answer is yes. Agreed? Basic Gordon's model, which is FCFF1 divided by Q minus G. Cool. In this question, what has happened? Let me tell you. The valuation of Hensel Limited has been done by an investment analyst based on the expected free cash flow of rupees 54 lakhs. So 54 lakhs were the expected free cash flow, which is FCFF1, right? Sir, and the expected growth rate of 9%, 9% is the growth rate. The analyst has estimated the value of Hensel Limited to be rupee 1800 lakhs. How much has the value been estimated accordingly? Rupee 1800 lakhs. Sir, what was the KO being used? That has not been given to us. That is not been given to us. Fine. However, he committed a mistake of using book value of debt and equity, right? Uh, which means to calculate this KO, which has not been given to us. They say while calculating this KO, he made a mistake of using book value of debt and equity. Because logically, one should use either the target capital structure or the market value. They are saying the book value weights employed by the analyst are not known to us, but you know the Hensel Limited has a cost of equity of 20% and cost of debt has been 10. So cost of equity is 20 and cost of debt has been 10. You know that, but you don't know the book value weights employed by him. Can you people in the class, do you think we can back calculate the weights? Using the incorrect value, using the growth and using the FCFF1, can we back calculate the incorrect KO which must have been used to calculate this value? Sir, hello? Sir, once you have this incorrect KO, using this incorrect KO, can we back calculate the incorrect weights must have been used using which this KO was arrived? Are you all able to connect to my thoughts? People in the class are requesting your responses. And once you use these incorrect weights, for example, I will say value of the firm is 1800 lakhs, which is FCFF1 divided by KO minus G. When I solve this entire equation, I get the KO, which is an incorrect KO to be 12%. Now I know if 12% is the incorrect KO, that is cost of equity into weight of equity, cost of debt into weight of debt. Cost of equity is 20 and 10, weight is weight and W1 minus weight. When I calculate the weight of equity, it turns out to be 20% and weight of debt turns out to be 80%, which means this 12% of incorrect value is based on weight of equity of 20% and weight of debt of 80%. Now the question says the value of equity is 3 times its book value. The value of equity is 3 times its book value, and the market value debt is 9 by 10 times of its book value. Sir, what is the value of equity? 3 times of book value. So if book value is 0.2, 3 times of it become 0.6. And if the book value of debt is 80%, then market value is 9 by 10 book value, which is 9 by 10 into 80, which is 0.72. Which means, do you have the correct weights of equity and debt, which is based on market value? Everyone? Now, if you have the correct weights, the KE and KD were there, 20 and 10 were there. Do you have the correct KO? And if correct KO, if you have, and growth and FCFF1 is there, can you have the correct value of the firm? That simply becomes the question you have to solve. Answer finding is easy for us, but to be able to understand the question with clarity and its solution with clarity is really something I want to teach you. Could I successfully do it in this question? What has happened? People in the class requesting your responses. From the incorrect value, you found the incorrect KO from which you found the incorrect weights. Then using this pink line, you rectified the weights. Using this pink line, which pink line particularly? Using this pink line here, you did rectify these weights. So this pink line, everyone in the class here, represents this pink line here in the timeline. You rectify the weights using this pink line, and then using the correct weights, you calculate correct KO and correct value. Sir, now if you have to do the weighted average, please understand what is the way out is really simple. Sir, really simple. You will say 20% is the K, but weight of equity is what? 0.6. See, you have to understand a point of difference. Previously, 20 and 80 were percentages. 20 out of 100, 80 out of 100. 0.6 and 0.72 are not percentages. They have now become the ratio, now become the proportion. So you cannot do cost of equity. You cannot do cost of equity into 60%, cost of debt into 72%. Can the sum of two can be 60 plus 72? Is it 100? No. You have to find it on a proportionate basis, that 20 into 0.6 divided by 0.6 plus 0.72 plus 10, which is cost of debt, into the weight of debt, which is 0.72 divided by 0.6 plus 0.72. Do you understand this part here? That these are now not percentages, these are now ratios, and those people in the class, ratios, if you do, the weighted average cost of capital become 14.55%, same FCFF1, but correct KO and same growth give you the correct value, which is 972.9730. Requesting your responses. Could I successfully made you people understand this question? 37. Please tell me. Please tell me. Please tell me. 39 is a category A easy question. You will have to please do it at your own, very easy question. Then another category A question is 41, which I'm not going to entirely solve, but give you a sense. But before that, could you understand what I just explained, everyone? Come on, see, guys, you have been watching me live. If you respond to me with that, that really make my confidence boosted up. I feel like, yes, I'm going in the right direction to explain to you people the things. Yes. Sir, 41 question. Let me tell you. So as I said, let me show you that file. As I said, FCFE, FCFF is the topic in which institute has asked the question 8 number of times out of 17, where average marks was 8 marks, right? And in those FCFE, FCFF valuation, 2 questions were asked which relates to FCFE, FCFF valuation, but were belonging to NPV nature of question. See, what is FCFE, FCFF? Present value of future cash flows. What is NPV? Present value of future cash flows, which is present value of inflow minus outflow. The thing people in the class are related. Yes, Komal is also here and Vishal is also here. Guys, have you joined late? Is it? Which point are you, Komal and Vishal? Are you at this point where I'm explaining NPV versus valuation? I could see your chats, but I don't know which point are you watching me. Right? So in this question 41, this question relates to NPV. They say you buy a company today. So to buy that company, there is an initial outflow, right? And the company will give you the cash flows like this, and it will also generate a terminal value. They are saying whether you should buy the company or not. So we will say present value of future cash flow will give you the inflow minus the initial outflow, give you the NPV. So this is kind of valuing the company as well as finding out its NPV, which is present value of future cash flow, right? Question 41 is an NPV question that we have just done. We have just discussed, not even done. You will have to do it at your own. Only point of learning for question number 41 is that initial outflow for that company is not in cash. When I acquire a company, right, I have decided to pay you the purchase consideration in terms of shares. So it's like paying you the purchase consideration is considered outflow, right? And after purchasing the company will generate the future cash inflows. That is considered as present value of cash inflow for the purpose of NPV. Rest of it, 41 question you'll have to do at your own. Another A category question is this particular question, very frequently tested by the institute, question number 45. It is finding the value of sales strategy. Sales strategy. People, This question again is nothing new to implement. It is similar to the previous things we have done, the questions on FCFE, FCFF, creating the working note for working capital, then finding FCFE, FCFF, and so on. 45th question must do at your own, right? And this people in the class completes this entire discussion on FCFE, FCFF. Now we are moving to the next model, which is model of economic value added, everyone. The model of economic value added. I will request all those who were doing the time stamping, people, people, the people who were doing the time stamping, please do timestamp the next model economic value added. And before I proceed ahead, everyone, I need a response. Are we all set to go ahead with the next concept? So we are done with two concepts. Are you finding yourself comfortable with the things you have learned, everyone? Yes. Are you people liking the approach, the rhythm, the flow? Please tell me. What do you all say? Perfect. Done. So let's proceed ahead to economic value added. The concept is really small, but the variety of questions to be done are too much. To the concept of economic value added, let me tell you. Really, really, really simple. Where it is. The topic of economic value added is simple. You are equity, you are debt, you are preference share, which means you are my capital provider. You give your capital to me. I take this capital and invest it in my business. Perfect. If invested in my operations. When I invest that capital to my operation, the operations give me an operating profit. Why do I make an investment? Because I want to make profits. So what I make in the form of return, what I make in the form of profit, my operating profit, which is EBIT. From that EBIT, I pay to debt in the form of KD. I pay to preference in the form of cost of reference, and I pay to equity in the form of KE. To you people who are my capital providers, from this EBIT I start to pay you people, right? So can I say overall what I pay to you, all of you, is the weighted average cost of capital. So from the profit that I've made, after making the payment of weighted average cost of capital to you people on the capital which was invested in me, the rest of it, the extra profit that is left with the company, is the economic value added. Is the economic value added. So we very well understand that economic value added is the extra profit left which will ultimately belong to equity, is fine, but it is the extra profit left after making the payment of capital charges against the capital which you people employed. If you could connect to what I said, let me implement it in terms of formula. So I will say, when I invest my money in the business, what I generate is NOPAT, which means operating profit after the effect of tax is EBIT into 1 minus T, which is NOPAT. From that profit, if I make the payment to you of capital charges, means on the capital that you employed multiplied the weighted average cost of capital that you expect is my cost. If I deduct this, I automatically get the balance line figure, which is extra, which is economic value added. Could I very well explain this concept to you beyond the formula? Everyone, could I very well explain the concept to you beyond formula, in which the practical questions to be done? Let's start to look at them one by one. The first practical question that we should do, people in the class, is question 69 is extremely easy. Question number 70 is what we can look at as the first question. Super fast, easy, basic question we have to look at. Come on. Yes, what it says. Says that Delta Limited's current financial year income statement reports a net income of 15 lakhs. What's have been given is? What has been given is? Sorry, I started to think something. Yeah. So Delta's current financial year's income statement report a net income of 15 lakhs. So what's given is 15 lakhs of net profit, right? So Delta's marginal tax rate is 40%. The interest expense for the year is 15 lakhs. Wow. So what I need for EVA is EBIT, and what I've been given is PAT, tax and interest expense. Can you reverse calculate, sir, really easily? Sir, say net income, which is after the effect of tax. Can I say must be 60% because 40% tax has been in effect? On PBT, when you charge 40% tax, what's left is 60%. So this 15 lakhs is equal to 60%. So 100%, which is PBT, is how much? So 15 divided by 60% give me 25 lakhs as my PBT. And PBT comes after deduction of interest of 15. So adding the interest back give me 40 lakhs of my EBIT. People in the class, the first thing I had to calculating the EBIT. The company has 1 crore rupee of capital invested, of which 60% is debt. Delta tries to maintain WACC of 12.6. So if WACC is given, capital employed is given, how much is the capital charge? Sir, 1 crore into 12.6% give me 12,60,000, common sense, right? So on this EBIT, you have to first find NOPAT, right? So 40 lakhs minus 40% minus 12.6 lakhs of it give me 11 lakhs 40,000 as the economic value added. What I've done? EBIT into 1 minus T, which is NOPAT, and minus capital employed into WACC give me 11 lakhs 40,000 as the economic value added. So in the first part, they asked me to calculate the operating income, done. In the second part, they asked me to calculate the economic value added, done. Correct? Now, the third one, people in the class, is the part you have to learn new. They are saying the extra profit earned by the company after making the payment to everyone beyond their expectation, the extra profit is 1140. They are asking, if you have 2,50,000 share, how much dividend, extra dividend, can you distribute to the shareholder? Common sense is really simple. If I distribute this extra profit to the shareholder, shareholders are fine. But beyond that, if I distribute, the cash will go out of the company beyond their expectation. And as the cash from the company goes out, the value of the shares start to fall. Basic. Sir, 1140 divided by 250 shares give me 4,04.56 rupee of dividend per share, which is extra company has earned, which the company can distribute. Beyond it, if company distributes, right? Beyond it, if the company distributes, the share of the company will start to fall. And that is what they are asking, till which point the company is expected to pay the dividend before the value of the share would start to decrease. That was C part of the question answered. Question number 70 was easy, 71 was easy, 72 is a question, right, which is a B category question. What is different in this question? What is different in this question? Although it is B category question, but I feel like explaining it to you. Aligned are you all to me on this? Please, 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 please let me know if you could understand it or not. In the portfolio management chapter, do you know there is a concept of levered and unlevered beta? Levered beta is beta of equity and unlevered beta is beta of asset. Yes or no? Do you know from the beta of equity we can calculate beta of asset, and from the beta of asset we can calculate the beta of equity? Yes. What I want to tell you is that what I want to tell you is that the asset beta of the company has been given 1.11 times. But if RFRM has been given to calculate the cost of equity, I need the beta of equity. Using asset beta, can you calculate the beta of equity? The answer is yes. From something you have learned in the portfolio management, once you have the beta of equity, you have the cost of equity, using which you have the cost of capital. Then the EVA calculation become extremely easy. This was question number 72, on which the point of learning I wanted to discuss. Could I successfully do it? Requesting your responses. Could I, people in the class, successfully do it? Requesting your responses. Question 73 is a reverse calculation brilliant question. Let's start to read this question, but really fast, really fast. 73, asked in the attempt of November 24, is a reverse calculation question. What it says, economic value added has been given as 31,10,000. Sir, economic value has been given. Do you agree? It obviously implies that the question is somewhere going to be a question of reverse calculation. Generally, EV is being asked, other things are being given. This time it's being given. Equity share capital, the debt invested capital is 170, 80 and accordingly 250. Correct coupon rate is 10%. Data has been given. The beta of the company has been given 0.9. Risk-free rate of the return 8%. Market risk premium 10. So beta into RM minus RF can give me KE. Fine, sir. KE and coupon rate can give me KO. And the equity and debt. So equity and debt capital and KE and KO. Sorry, KE and KD. KE, KD, weight of equity and weight of debt ultimately can help me, people in the class, to calculate the cost of capital. Align to me on this, requesting your responses. Align to me on this, requesting your responses, people. Yes. So I have the cost of capital with me. Fine. Economic value added has been given as 31 lakhs 10,000. Corporate tax rate is 30%. You have to require to calculate PAT. Sir, in the formula of economic value added, do we have PAT anywhere? No, sir. No, the PAT is not there. But related to PAT, what do I have, sir? I have EBIT. So once you have EBIT, can you PAT calculate the PAT? Correct, sir. What is the formula of EBIT? The formula of EBIT says that economic value added into is equal to EBIT into 1 minus T minus capital employed into WACC. What all do you have? Do you have the tax rate 1 minus T? Yes, sir, 30% given in the question. Do you have the capital employed? Yes, sir, 250 given in the question. Do you have the economic value added? Yes, sir, 31 lakhs 10,000 given in the question. Do you have the weighted average cost of capital? Yes, sir, using KE and using KD and using the weights, I have KO, which can be calculated. Do you agree in this entire equation, the only thing that you will not have is EBIT? That you will not have is EBIT here. Requesting your responses in this simplified manner. Could you understand this question 73? Was not intending to solve it, but give you a sense of how can you people solve it. For this particularly, since we have not solved it, you need to respond to me. Could I explain? Yes or no? What was missing in this entire equation was only and only a bit which you can reverse calculate by solving that simple equation. So, sir, once you have K, once you have KD, you can have WACC, right? So, I will say economic value added is EBIT into 1 minus T minus invested capital into WACC. In this entire equation, only EBIT is missing, which is this much. From EBIT, you deduct interest, you get PBT. From which you deduct tax, you get PAT, which is going to be 60 lakhs, which is what the question has asked. So there is a tip, if you allow me, I want to give you for your entire AFM. Wherever you see a reverse calculation question, listen to me carefully. In your entire AFM, wherever derivative, forex, equity, business, portfolio, wherever there is a reverse calculation question, please pay attention to what I say. You have to, people in the class, simply put the formula of what is given. If economic value added is given, put the formula of it, right? Any other thing is given, put the formula of it, right? And try to put the values given in the question. Try to put the values, and automatically you will find that one particular value is missing. That missing value you will have to reverse calculate in the formula which is given, which you have used. That simple is the trick to solve any reverse calculation question, whether it belong to mutual fund or what. Correct? 73 is the question we have discussed. 74th is what we will discuss now. There is this simple concept of, people in the class, financial leverage, right? Concept actually of degree of financial leverage, because financial leverage is something else only. We have to learn degree of financial leverage. If you imagine the format of income statement is EBIT minus interest is equal to PBT. So degree of financial leverage uses word, what is my finance cost? Interest. So degree of financial leverage is a ratio which make uses EBIT divided by PBT. One number above, one line item above interest, one line item below interest. So EBIT divided by PBT. In other words, I can also call it to be EBIT divided by EBIT minus interest. EBIT minus interest, because PBT everyone in the class has nothing but interest only. Do you understand this? Everyone, do you understand this? So what I want to everyone tell you is that in the next question, institute want you to use that ratio. With the help of following information of Jetta, you calculate economic value added. What is the information given? The capital structure says equity is 160, reserve is 140, debenture is 400. So total of equity become 300, total of debt is 400. Cost of debt, I mean to say, interest is 10%. So that minus 30% of tax rate become cost of debt become 7%. Fine, sir. Cost of equity given as 14%, financial leverage 1.5 times. Now, if you apply the formula of economic value added, you need EBIT, which is not given in the question. You need tax rate, which is given in the question. You need capital employed, which is 700 given in the question, and you need WACC, which is calculatable. 14 into weight of equity, cost of debt, which is 10 into 1 minus T, into cost of debt value, the weighted average cost of capital. So let's not focus on calculating the WACC. The WACC given in the question, people in the class, to me, is 10%. Now the question is, how do I calculate EBIT? So the only ratio this is left to be used is the financial leverage. Now there is a problem in this question. Officially, the word financial leverage is something else only, but they have said financial leverage and done degree of financial leverage, which people in the class is EBIT divided by EBIT minus interest, which is what? EBIT divided by EBIT minus interest, right? Uh, Financial leverage, which is 1.5 divided by EBIT minus 40, which is the amount of interest. So debenture is 400 lakhs into 10% give me 40 rupees of interest, right? If you solve this entire equation, the only number missing, which is EBIT, can be found out, right, as 120, right? Now 120 is the EBIT into 1 minus T, make it NOPAT. Capital employed 700, right, which is 300 plus 400 multiplied by WACC of 10 give me economic value added of 14 lakhs, which solves question number 74. So for which particular point we have done this entire question? For this point of financial leverage. Getting my point? Question number 76 has just one particular point of learning, sir, which I will also explain in terms of in the outnotes here. When you take capital employed, you will have to take the book value of equity, debt and preference, the book values, everyone. But imagine the balance sheet, the book value of equity, debt, preference has been taken. But imagine, and accordingly, there would be some assets. Yes, because the balance sheet always tallies. Sir, imagine that certain assets are not recorded in the books. Imagine that there is a patent which is not recorded in the books. Now, if it gets recorded, right? Please imagine it's recording. If that patent gets recorded, people in the class, do you agree? The equity value, the reserves in the will also increase by the same amount. So my point is, if there is a market value of assets given to you, which is not considered in the capital employed, that is something you will have to consider. I'm not asking you to consider the market value of equity. No, I'm asking you to consider the book value of equity, debt and preference. But if the asset is not recorded or captured, by the amount of asset, the value of equity will increase. That is particularly the point of learning in question number 76. That's sufficient. My net worth is 300. My net worth is 200 and debt is 400, but there is this patent of 100 crore rupee, which is not recorded in the books. So which is why after its recording, 200 plus 100, my equity people in the class collectively become 300 and debt people in the class collective is 400 naturally. Other than this, there is nothing great in this question, question number 76. Now, there is question number 77, one more question which you will have to do at your own compulsorily. Question has ambiguity. Is the question from study material? You must do it at your own. The only point of learning I will share, because we have done sufficient questions of economic value added back to back if you realize. Question 7, I'll just explain you the point here. Says that any non-cash expense like bad debt, any non-cash expense other than depreciation, don't consider depreciation, but other than depreciation is there a non-cash expense, you will have to add it back to the NOPAT while calculating it. While you're calculating NOPAT, add it back so that you can, people in the class, find the NOPAT to be used for the purpose of economic value added. For example, in this case, EBIT is 410. Tax rate is 30%. So I will say 410 of EBIT minus the tax rate of 30%, give you NOPAT. But there is this bedded provision of 20 lakhs, which is non-cash in nature, is something you will have to add back. So adding non-cash expense of 20 will give you the actual NOPAT. Are you understanding? I did not read the entire question, but could you connect it to my point? If you want, I can read the entire question, but for that you will have to first give me an idea here. Are you all able to connect with this explanation? Yes or no? Everyone, your responses, please. Are you all getting my point? There's no need to read the same question again. It is the data of income statement balance sheet given to me. The point of learning here is from the EBIT, if you deduct the tax rate of 30% directly, you have to add back this 20. The only another point of learning here, everyone, is when the 20 rupee gets added back in the profit, the effect of it also goes to the equity. My equity people in the class, the reserves also increase by 20 rupee. So 70 and 100 was previously 800 the equity. Now it becomes 700. 700 and 100 it previously was, but now it becomes 700 plus 120 as 820 my revised equity balance. Getting my point? Because 20 rupee reserve will increase if a non-cash thing is reversed, right? And that's how the effect on question number 77, economic value added calculation, will be. Perfect. Do you require capital employed? Yes, sir, we do require capital employed. What will be the value of equity be now? 820. And what will be the value of debt be now? 100. So how much is the total capital employed now? 920. Simple. Perfect, sir. So here this entire concept of economic value added people in the class gets done. Now I will take you to the everyone in the class, the last section, which is buyback of shares. We have done really the topics which had so many varieties of questions actually. Such a huge variety of questions we had are the topics we are done with. The coming topics will have lesser varieties to cover. All right. So let's proceed ahead to do the buyback, everyone. That has to be a super ultra fast thing. Buyback, if you realize, boss, has really simple formulas. What it says? The buyback has really simple formulas. It says that buyback is simply when a company has cash, right? It gives cash back to the shareholder and it buys its own shares back. So what is the implication? After the buyback, the number of shares with the company will fall. Correct? Now learning the first thing. How many number of share will you be able to buy back simply depends on the buyback amount. What is the total amount that I'm ready to give to the shareholder? And what is the price for every share at which the share will be bought back? That every share that comes here, what is the price at which it will be bought back? So buyback amount divided by the buyback price give you the number of shares that can be bought back. It's not a formula, it's a common sense. If I have 1 lakh rupees to give to you, price of the share is 900, but to motivate you people, I'm offering you 1000 rupee of price. So that 1 lakh rupee that I give you, against which every share that I buy at 1000 rupee, which means I'll be able to buy back 100 shares. So initially people, if I have 2000 shares, right? What was the number? Yeah, initially there were 2000 shares, right? Pre-buyback, out of which if I buy 100 shares, so the number of shares that will be left after buyback will be 900. Lines are basic. So post buyback number of shares, pre-buyback shares minus the number of shares which are being bought back. Fine, sir. Cool. Next, post buyback EPS. Now there's a point of clarity here. Sir, the company who is ready to give that buyback amount to the shareholders, right, will get this amount either from surplus or from borrowing, which means one possibility is that company already had this amount with itself, already invested somewhere, or another possibility is that company will borrow that amount from somewhere. Now what is the implication of surplus being distributed or amount being borrowed on the profits of the company? Really simple. Before buyback, this surplus was invested somewhere. But now when that surplus is used to pay to the shareholder, that is no more with the company. And in the future, after the buyback, company won't be able to earn the income which it was initially earning on the surplus. Now, when suppose it borrows, previously there were no borrowing. Due to buyback, now there are borrowing. So in the future years, after the buyback, company will have to pay interest on those borrowings. So in the first case, interest is lost. In the second case, interest is paid. So if you ask me how much is the post buyback EPS? EPS is PAT divided by number of share. So post buyback EPS become post buyback PAT divided by post number of share. Sir, post buyback PAT is whatever has been the pre buyback PAT will be there. Just that an additional interest lost or paid with the effect of tax will be there, divided by post buyback number of share, which means the pre buyback shares minus the number of share bought back, which gives me the post buyback number of share. Correct? Sir, one more point related to clarity here. Do you agree, when you buy back, the equity falls, but by the same amount the debt rises? Suppose if you follow the borrowing route, so if you raise 200 rupee from debt, the same 200 rupees used for the purpose of buyback, are the assets of the company affected? If you follow the borrowing route, are the assets of the company affected? No. So will the revenue of the company or the operations of the company be affected? No. Which is why people in the class, I want to tell you that operating profit continue to remain same. My EBIT, which is my operating profit, continue to remain same, whether it is pre buyback or post buyback. However, the PBT After a bit, what do you deduct? Sir, interest. Previously, there was no interest, but after buyback, now there is interest because I have borrowed an amount, which means my PBT people in the class will be different. My post buyback PBT will be different from my pre buyback PBT, and that is what I want to tell you. Do you understand this? Right? Based on which we will do a practical question and then we will learn one more part here. Let's do a practical. Okay, let's learn this particular part. Do you people agree? Market price is EPS into P. So whatever is the post buyback market price is post buyback EPS into post buyback P. Common sense. Similarly, market value is number of share into MPS. So post buyback market value is post buyback number of share into post buyback EPS. All these basic formulas is what you will have to collectively use in the practical questions, starting with the first practical question on buyback being this particular question number 84. Let's try to understand what this simple question is. Rahul Limited has surplus cash of 100 lakhs of which it wants to distribute 27%. So 27% of cash Rahul is planning to distribute to the shareholder, which is 27 lakhs. Cool. So this become my total buyback amount. Company decides to buy back shares. Fine, sir. Finance manager estimate the share price after repurchase is likely to be 10% above the buyback price. If every share, if I purchase, if I buy back at a particular price, so after buyback price will be plus 10% of it. So if buyback is X, buyback price is X, after buyback the price become 1.1x. Cool, fine. The number of share outstanding at present is 10 lakhs. The current EPS 3. You have to determine the price at which share can be repurchased. Determine what? The price at which you would want to repurchase the share. Yes, everyone. Which means, do you agree in simple language it is asking us to calculate the buyback price, everyone? Yes or no? Hello? People in the class, please pay attention and tell me what do you think the examiner is asking? Then I will re-explain the question. What do you think the examiner is asking? Come on. Live people sitting here, please tell me. There are you, understanding me, please. Do you realize they are asking me the buyback price, the price at which share can be repurchased? If the market cap of the company should be 210 lakhs after the buyback, post buyback market cap is given. I'm trying to tell you, when the examiner is silent, right, not able to understand how to solve the question, you have to simply put down the data given in the question. For example, can I say post buyback market cap is post buyback number of share into post buyback MPS. Market cap is 210 lakhs. Can I say market price after buyback is going to be 1.1x? If the buyback price is X, post buyback market price is 1.1x. Now I need the post buyback number of share. Can I say 10 lakhs, which is pre buyback number of share, minus the shares which are bought back, give you the post buyback number of share? How many shares will you be able to buy back? Sir, 27 lakhs. 10 lakhs were original share. Then 27 lakhs is the amount of buyback divided by buyback price is X. Hello? 100 into 27% give you 27 lakhs amount of buyback. So total amount I have to pay you 27 lakhs. Every share I will pay you X. How many share will I be able to buy back? 27 by X. So after buyback I'll be left with how many share? 10 minus 27 by X. So I will say post buyback number of share is 10 minus 27 by X. This post-merger buyback number of share multiplied by post-buyback market price should be equal to the post-buyback market cap of 210. Solution is secondary, but to be able to understand this equation, people in the class is primary. Could you all do it? I need a validation. I need a response. Come on. Come on. This is how it is a particular typical nature of reverse calculation question of buyback price. Yes, unfortunately. What do all people say? Whatever has been given, you try to put the formula of it, you try to calculate the things in that, and you will find somehow market price is directly given. Number of share after buyback can be calculated as pre minus the bought back shares. Align to me on this. Sir, once you find the value of X, you get the buyback price of 21.79. Perfect. They are saying the number of share to be repurchased. So common sense. 27 lakhs is the total amount of buyback divided by every share buyback price is 27.19. So number of share bought back is 123,910. C part of this question is extremely easy. You will have to look at it at your own later. C part is very easy. Later at your own, you'll have to. The first two parts, if I could explain, the next question will make your learning more effective, which is question number 86. The timeline presentation of this question, through the timeline presentation of this question, you will start to find the question easy. Perfect. Here it is. Yes. So what does it say? Let's proceed ahead. SM Limited is a company having a market cap of 3000 crore. The current EPS is 200. So 300,000 crore is the market cap, where the current EPS is 200 with a P ratio of 15. So P ratio of 15 given EPS of 200 given EPS into P gives me MPS. So 200 into 15 gives me 3000 rupee of MPS. So if MPS is 3000 and the market cap is 3000 crore, which means the number of share would be 1 crore. So basic format of income statement is what I've created here, right? The basic format of income statement. So I've tried to figure out some values that P and EPS give me MPS. MPS and market cap can give me the number of share, which is 1 crore. And on 1 crore share, if I have an EPS of 200 rupee, which means I have a PAT of 200 crore. Sir, EPS is 200. Number of share we calculated to be 1 crore, which means my PAT, everyone in the class, is 200 crores. Fine, sir. Cool. The board of director wishes to consider a buyback of 20% of the share. Out of 1 crore, I want to buy back 20 lakh shares at a premium which can be supported by the financials of the company. So I want to buy back 20 lakh shares, for which I have to pay a buyback price. But how much price I can pay? Something which can be supported by the financials. Sir, how do we know what my financials can support? I will explain. Cool. The board expect the post buyback market price to be 3057 and the post buyback P ratio to remain same as 15. So after buyback market price is there, which is 3057. After buyback P ratio of 15 is there. Can you find out using that the after buyback EPS which I'm expecting to be there? So 307 divided by 15 of MPS give me 203.8 of EPS. Do it on the calci. 3057 MPS divided by 15 of P give me 230.8 of EPS. And now after 20% buyback, the number of shares that will be left is 80 lakhs, which is 0.8 crore. So EPS is there into 0.8 crore is there. So 163.04 become the amount of PAT. What all I have? I have the amount of PAT before buyback and I have the amount of PAT after buyback. Requesting your response before proceeding ahead. Till this part of the question, are you people aligned? Using the information of EPS, PE, PAT, market value, I have tried to find out both pre and post buyback PATs. You validate it to me. You confirm if you could understand this much or not. Then I will take you ahead. Yes or no? This is pre buyback scenario. This is post buyback scenario. And this is the format of income statement. Come on. Requesting your responses. Then I'll tell you what exactly is this question trying to make us ask. Understood everyone this much? Perfect, sir. So now it says post buyback P ratio will remain the same. The company proposes to fund the buyback by availing 8% bank loan since available resources are already committed. Sir, when you do this buyback, you have to make a payment to the shareholder. Where will you get this amount from? By borrowing from someone. Do you agree? When you borrow, you have to pay an interest, correct? So that is what they are trying to say. The interest which your income statement can afford to pay, the interest which you can show in the income statement is the amount of buyback which can be supported by the financial statement. So I have to find or back calculate the interest. Sir, if I have pre buyback PAT is there, So can I calculate pre-buyback PBT? Yes, sir. If tax rate is 30%, this is equal to 70%. So 200 divided by 70% give me 285 as the PBT. Before buyback, were there any borrowing? No. Which means was there any interest? No. Which means even my EBIT was same before buyback? Yes. And EBIT after buyback will continue to remain the same because EBIT does not change. It is the PBT which gets affected. So EBIT continue to remain the same at 285.7143. Now my question to you is, after buyback, this will be the EBIT, this we know. And after buyback, PAT we know is 163.04 divided by 70% give me 232.9143. So after buyback, EBIT is known. After buyback, PBT is known. So after buyback, the difference can I say is going to be the interest which my income statement can afford, which my financial statements can support. Could you connect it to the flow of this question? This question gives you information, these information pre and post buyback. So I have to go to pre buyback EBIT, assume it to be post buyback EBIT, and from post buyback PAT and PE, I'll have to bring it to PBT and reverse calculate this interest component. Could I simplify this question to you all, everyone in the class on timeline? Please tell me, please validate it to me. What do you all say? Everyone, yes, aligned to me on this. Settled are we? Correct. And that's how we will say the interest that we can afford is 52.8 crore, because that is the balancing figure that my income statement has. EBIT will be this is known, and PAT has to be this question has given. So interest has to be 52.8. That is the first question examiner asked. Second, what is the loan amount? So what will the loan amount be, of which 8% is the interest I can afford? So 52.8, if is 8%, so divided by 8% give me 660 crore as the amount of loan. So my loan amount or the buyback amount will be 660 crore. On this buyback amount, how many shares will you buy back? Sir, 0.2 crore. Only 20% out of 1 crore. So divided by 0.2 crore give me every share has to be bought back at a price of rupee 3300 as my buyback price. Every share will be bought at what price? At a buyback price of 3300 crore, which means now with this, what can you realize is how much is the premium per share paid? So common sense tells you initially the price of share is 3000. To motivate the shareholder, we have asked them that we will buy your every share at a price of 3300 crore. How much is the extra premium you are giving to them? You are giving to them 300 rupee of extra premium, which is 10% on 3000 is what you're giving extra. So the amount of premium people in the class become rupee 300 or 10%. Boss, this was the solution. Sir, how do you present it in the notebook is really simple. Just simply present what you are doing here. Simply present that P is this, EPS is this, market price is this. Then say market value is this, market price is this, so number of share is this. Then say EPS this, number of share is this, is PAT is this. Then say PBT is equal to PAT by 1 minus T. EBT is equal to PAT is equals to EBIT post buyback. This simple rhythm you will have to follow in the solution, and that become your presentation. Please tell me, could I successfully simplify this buyback question to you people through this timeline, which is otherwise a bit confusing? Please, 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 everyone, could I successfully do it? What do you all say, people in the class? Yes. Are you people aligned? Are your brains working? Settled with the learnings? And that's how, everyone, your entire first chapter, which means buyback concept gets done, and the entire chapter of equity business valuation done, in which primarily asked topics have been done by you. Yes, boss. Understood. Settled. Perfect. Now we are learning the next topic, which logically should be derivatives, because they have been asked 9 and 9 times. Uh, 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 uh. But if I do follow the sequence, what do you want? If we follow the sequence of this file, it will be easy for the students actually. Right. So great. Guys, if it is fine, if we take the lunch break by 1 or 1:15, yes or no? Till then, we would want to continue to learn. Are we people okay if we take the break by 1 or 1:15? Portfolio management won't take much time to complete. It's a simple rhythm, it's a simple flow that we follow. Be a 5-minute break cannot happen. We just come on. No, 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 no. Come on. Right? 1 minute of breathing space you can take, after which we will do portfolio management. So take that space, then we start with portfolio management, everyone. An easy chapter will get completed in a flow. You won't even realize how easy this is going to be. Yes. So timestamp, guys, a reminder for you, please do tag the portfolio management when we start it. And in that, the first topic you have to tag is risk and return of the portfolio as per Markowitz model, which means modern portfolio theory. Okay. Take a minute of breathing space and give me a minute to have water. Yes. So now, everyone, we are back to the easy topic of portfolio management. There? Yes. So, everyone, perfect. Portfolio management. The first topic in that you have to do is to simply calculate the risk of the portfolio and the return of the portfolio. Hello? Do you people remember a standard format of the table that you prepare? Right? Which format? Let me show you. Which format? Let me show you. So, people, recorded people, if you're doing the time stamping, please, it's a reminder to you. Please do that for me. It's really easy. Right. Sir, what happens is, there is a standard format that we used to follow to find the risk and return of individual security and then the risk and return of the portfolio. For example, imagine that we have been given the data of past. There are two scenarios that you have to learn here: data of past and the data of future. In the outnotes, I will just show you the format, just the flow. We will solve one practical question of past data, another practical question of future data to learn these things. Right? Sir, Suppose that we have been given the data of past 3 years. There is first security, the possible returns of which are called as X. There is another security B whose possible returns are called as Y. Whatever the standard format, you have to first make the column of year. Then 3 columns you need for first security, then 3 columns you need for second security, and the last column is again a common column for both the security. So first and last column are the common column for both the security. Now after year you have 3 column of security X, in which you calculate, in which first of you have the returns. So returns are given to me 15, 10, 8. How do you find X bar, the average return? Sir, the total divided by 3 give me the average return X bar. Then is the calculation of dx, which is nothing but x minus x bar. So x is 15 minus x bar, give you the dx. 10 minus 11, 8 minus 11 give me x bar, right? Sorry, give me dx. Dx is the deviation. Then dx square is the deviation at squared level. So whatever dx value is there, you square it up. So this is the total, 26 is the total squared level deviation. Dividing it by 3 give me the average squared level deviation. So which is my variance, and under root of it is variance, and under root of the variance people is ST. What you have done for the first 3 securities, the same thing you do for the other, I will tell you again. The 3 columns that you have made for the first security, the same 3 columns you make for the next security. You have their possible returns, you average the returns to find x bar, then you y bar, then you calculate dy, and then you calculate dy square. Now there is a rhythm. Dx into dx give me variance. Dy into dy give me variance. So which is why if you observe we have done dy square, which is why if you observe we have done dx square, which was ultimately, if you observe, was used to calculate variance, right? My deviation into my deviation is variance. So my deviation into others deviation, people in the class, is covariance. So dx into dy, if you observe, will give me co-deviation or covariance. So if I multiply dx into dy, sorry, dx dy, dx dy, dx dy, and add them up, I get the total co-deviation, which is 53. So how much is the average co-deviation? Sir, 53 divided by 3 is the average co-deviation, which is, people in the class, my covariance, which is 17.67 negative. Number doesn't matter, I mean to say the flow matters. Are you people clear with this 8 columnar table, right? So what officially become the formula of covariance? Summation of, which means adding which column? Dx into dy, dx into dy divided by n. Once you have the correlation, once you have the covariance, then you can calculate the correlation. Sir, what is correlation? Covariance into divided by SD into SD. So 17.76. So whatever is your covariance that you have calculated divided by individual standard deviations, right? Covariance divided by SD into SD give you the correlation. Now what is the use of correlation? Let me explain. Once you have come to the calculation of correlation, I will explain you the use, right? Don't worry about the understanding of the concept. This is just the flow you have got. Now we do a practical question, and then I'll ask you, are you people comfortable? If you say no, I'll repeat the things. If you say yes, I'll be very happy. Correct? Sir, when you calculate the risk return of the portfolio, it's all easy. In my portfolio there are multiple security, so return of first security into weight of first security, return of second security, weight of second, and so on. That way you can calculate the return of the portfolio. However, if I ask you to calculate the risk of the portfolio, the formula is not weighted average. The formula is a plus b whole square, which is a square plus b square plus 2ab, right? What is a? SD of a, weight of a, is considered a. SD of b, weight of b, is considered b. So a square plus b square plus 2ab become what? Sir, SD of a, weight of a whole square. SD of b, weight of b whole square plus 2 into a, SD of a, weight of a, b, which is SD of b, weight of b, and correlation between the securities AB, which is why you need to create that extended 8 columnar table so that you can have the correlation here, using which you can find the variance of the portfolio. To that variance, when you underroot it, become the standard deviation of the portfolio. Is the initial flow clear to every single student sitting in the class? Please tell me. Is the initial flow clear to every single student sitting in the class? So what happens is that, people in the class, if I have the returns which are x and y, the life is easy. But it may happen the examiner give you P1, P0 and D, P1, P minus P0 plus D divided by P0, using which you will have to first calculate the return of each of the years for both the securities. and then solve the question. For example, let's proceed to a particular question of portfolio management where we are going to have this situation, right? Just give me a minute, taking you to this chapter of portfolio management. Come on. This is the question we are going to solve is a comprehensive question. We have been given the two stocks AB. The price data is available for share A and share B. At the end of every year, these were the prices. You have to calculate the risk and return of individual securities AB. Do you people agree? If you make this 8 column table, then individual securities risk and return become easy. The individual securities expected return and the individual securities variance and SD get automatically calculated using the 3 column and using these 3 column. After which the last column you need is for the portfolio. Fine, sir, agreed. So if you have the possible prices, then can I do P1 minus P0 divided by P0 is equal to the possible returns? So first of all, from 2013 to 2019, you will have to find the possible returns. Can anyone in the class tell me you will have the possible return for how many number of years in this case? For how many years will you have the possible return? Is it 2013, 14, 15, 16, 17, 18 and 19? Is it for the 7 year? The answer is no. When you have the price from 13 to 19, the first possible return you will have for the year 2014. So 1, 2, 3, 4, 5, 6. You will have the data of possible return of 6 year, sir, from 2014 to 2019. So we have security X possible return, we have security Y's possible return. Then you have two more columns of security X, two more column of security Y, and the last column is DX into DY, right? Now let's understand. People, let's first, for your ease, let's have the calcs, let's solve the things in the class for your comfort. Let's first find the possible return of 2013 and 15. So sir, here 18.75 is the price as P1 minus P0 is 19.6 divided by P0 of 19.6 multiplied by 100 give me 4.34 on a rounded off basis negative return. For the second year, it is 33.42 minus 18.75 divided by 33.42 minus 18.75 divided by 18.75 give me 78.24. Everyone is the possible return. So that way you have the possible return of both the securities X and Y. Now, once you add all these possible returns, the total comes out to be 83.95. Yes, sir. So what is the average return? 83.95 divided by 6 give me 13.99 as my X bar. So what automatically become my dx, which is deviation of x minus x bar? So please pay attention, 4.34 as a negative number. Minus 13.33 gives me 17.67. How come? 4.34 as a negative number minus 13.99 give me 18.33 as a negative number. So please understand how do you do it on the calc. Sir, when you do this minus this, you get this number, you put it in the notebook, then you press into equal to, so that you can get this number, and then you press m plus, so 335.99, you write it in the notebook and that number goes to m plus. So both of these column will simultaneously get ready and automatically memory recollect will be this particular number out here, will save your time and efforts. So next will be 78.24 minus 13.33, 13.99 is equal to 64.25 you write here into equal to m plus is 4128.06 you write here. That way, if you do keep on doing m plus, so the total deviation at squared level becomes 6229 divided by 6. So 6229.69 divided by 6 give me variance of 1038. Variance of this, if you solve, you get 1038 under root of which is 32.22. Requesting your responses, could you understand for a particular security, how did I calculate its expected return, its variance and its SD? And the calculated trick to solve these questions in the notebook. First, you have to validate me till this point. People, what do you all say? Come on. What do you all say? You have to validate me till this point. Are we settled? Are we ready? Come on, come on, come on. Everyone in the class. Yes or no? Everyone, the live people sitting here, come on, we want not the Josh to be really high always, but your determination, discipline, your vision, your focus to be really high. Yes. Sir, the way you have done the risk and return calculation for the first security, exactly you did for the another security. So suppose now we have the individual return of both the securities and variances of both the securities. In the first part of this question gets done, solve the risk and return for individual securities. Now the next part, risk return of the portfolio by making investment in 60-40. So 60-40 investment risk return of the portfolio is easy. First security has this return into 60% weight plus second security has this return into 40% weight. So return into 60 plus return into 40 give me the weighted average return of the portfolio as 14.87. That's also easy. Now risk of the portfolio. Risk of first portfolio into its weight of 0.6 whole square plus risk of second security into its weight of 0.4 whole square. So SD of a weight of a whole square done, SD of B weight of B whole square done, right? SD of a weight of a whole square done, SD of B weight of B whole square done plus 2 into SD of A weight of A, SD of B weight of B. Sir, what about the correlation between the securities AB? We are yet to calculate. Please pay attention. Sir, do we have the covariance? Yes, sir. 96.37 is the total covariation divided by 6 give me the average covariation, which is covariance, right? Which is 16.06. Fine. Covariance divided by SD and SD. So divided by 32 and 24. So the 16.06 divided by 32 and 24 give me correlation of 0.0204. The correlation that you use in 2 into A into B into R give you the final, everyone in the class, the final risk of the portfolio, the variance of the portfolio. Sir, how do you solve it on the calci? Very easy. 32.21 into zero point 0.6 into equal to m plus 24.43 into zero point 0.4 into equal to m plus, then 2 into 32.21 into zero point 0.6 into 24.43 into zero point 0.4 into 0.0204 negative 0.0204 negative number m plus memory recollect give me 468 under root of which is 21.65. I'm getting, I don't know why, there's something here and there, but this is the flow to solve it on the calci, and that's how you get the risk of the portfolio. I need a validation. Could you people with this data learn the risk and return of the portfolio? Come on, requesting your responses, requesting your validation, people. Come on, come on, come on. Is this question done? Easy, basic? What do you all say? Connected to me at every step? Public? Literally connected to me at every step? Are you all there? Yes. So now the next thing. Next thing. Boss, you have to please understand what have you learned correlation to be? Sir, correlation is nothing but covariance divided by SD and SD, using which I want to teach you one more thing. Correlation is covariance divided by SD and SD, which means can I say correlation into SD is covariance, right? So what become another formula of calculating risk is this: A square plus B square is fine. Rather than 2 into A into B into correlation, you can directly see SD and correlation. SD and correlation can be replaced with covariance. Yes, sir. So I will say 2 into weight of A, weight of B, and the covariance between the securities AB. You can directly use covariance to the calculation of risk of the portfolio. Another basic formula, correct. So in this question or in any other question, wherever you want to use covariance, you can use it. Especially where covariance are given, you can use covariance. If nothing is given, you should first calculate correlation and then do it. Fifth part, the first two questions, which was the motto of this class, has been done. The next question we are going to do, people, is The next question will be question number 15th, right? Which is based on ex ante data, which means the data of future. In case the future data will be given about the data of possible returns and the probability. This time you will have 8 columns. Everything else will remain the same. The 8 columns will be probability, then 4 columns of security X, then 4 column of security Y, and then again a common column. The only difference between past data and future data is that whenever it comes to averaging, the averaging happens in the table itself. For example, if we have been given the possible return X, then do you agree we have to average it and calculate X bar? So the averaging done in the table itself, that 10 has 20% probability, 16 has 50% probability, and 20 has 30% probability. So weighted average automatically becomes 16. So X bar comes in the table directly. Once you have the X bar, you have X minus X bar as your dx. So the next column is dx square. But dx square multiplied by p happens in the table itself, which is why you directly have the average squared level deviation, which is your variance. What is variance? Average deviation at squared level. So do you agree dx square is a squared level, and with the multiplication of p, the average happens in the table itself. So the next 4 columns look like x, then px, then dx, then p into dx square, and the same 4 column for y. Now last covariance is also average co-deviation, for which dx into dy multiplied by the p tables happens in the table itself. So 1 plus 4 plus 4 plus 1 is the 1 plus 4 plus 4 plus 1 is the format of this ex ante probability distribution. If you want, we can look at a practical question of it, and then ultimately you will have to validate to me, sir, you have been given the two shares data ABC and XYZ. The probability of them is this and the possible returns are this. What is the standard format? 1 column plus 4 column plus 4 column plus 1 column. Cool. Probability given. Let's do it for first security. 12, 14 minus 17 and 28. Sir, what are the possible return? 12 into 0.2 m plus, 14 into 0.25 m plus, 7 which is negative into 0.25 m plus, and 28 into 0.3 m plus. Give me 12.55 as the x bar possible return. Now x minus x bar. So again the same rhythm. 12 minus 12.55 give you 0.55 negative u right here. Then you have to do its square. Into equal to into 0.2 give me 0.06. Sorry, 0.06. So once you have the dx, into equal to will make it dx square, and then multiplying with the probability give you this particular number, put it to m plus. Similarly, 14 minus 12.55, 14 minus 12.55 give me 1.45. Into equal to into 0.25 m plus. So 0.525, which is 0.53 I write here, rest of it is m plus. And that way if I do all of them and do memory correct, it will be 167.75. It is the squared level average deviation which is directly my variance given to me. When I press under root to it, the SD become 12.95. So I have the return of first security, I have the variance of first security, SD of first security. The same thing you have for the second security. And dx into dy into probability, if you do m plus average, you have the covariance directly, which is 144.25, and a co-deviation, the average co-deviation, the covariance is there. Do you agree with the table? Are you people comfortable with what we have done in the table? What do you all say? Yes, people in the class? Feedbacks, please. Feedbacks, please. Yes or no? What do you all say? Comfortable with what we've done on the table? Yes. So now, if you feel the execution, the first part say risk and return of the individual shares, done. Risk and return of the portfolio in equal proportions. Now there is no difference whether it is ex ante or ex post. The formula remains the same. First share into its weight 50%, return of second share into its weight 50%. First return 50%, second return 50%, you get weighted average. Even the risk is same. SD of 1 into weight of 1 whole square. So 12 into 0.9, 12.95 into 0.5 whole square. SD of second into weight of second whole square, 11.27 into 0.5 whole square, plus 2 multiplied by 12.95 into 0.5, 11.27 into 0.5. 2 into A into B into correlation between the securities AB. Sir, how did you calculate correlation? 144.25 divided by 12.95 and 11.27. Sir, individual SD. So covariance divided by SD become the correlation, which means please observe the formula calculation of correlation, expected return of the portfolio, risk of the portfolio relate the same. The only difference is that ex post requires simple averaging, ex ante require probability based weighted averaging in the table itself. So I will say covariance divided by SD and SD give me 0.988 negative correlation, which I put in the formula of 2AB, and then I get the final risk to be 1.26%, right? This, if I solve, I'm not solving it again, we have done it once previously, which is by not solving it again, a square plus b square plus 2ab into the correlation under root of which is SD directly, which is 1.26%. Third part of this relates to something which is not the focus right now. The focus was to finding the risk and return of the portfolio and the security using the Markowitz model. People, are you done with 15th question? Please tell me. Come on. Super ultra fast. 15th question, exposed data, ex-ante data, both the formatting, the flow, the calculation, everything are we sorted. You need to respond to me accordingly. I'll be proceeding ahead. Yes, public. What do you all say? It's very easy. It has a rhythm. How many of you at this point are live? Ravi says, sir, you are great. I'm not comfortable in Forex. But your 27 LDR topic, Hindi revision is awesome. Now I'm able to solve that question in Forex. So that's great, Ravi. I feel good about it that the video helped you out. Yes. So English people, we have some random Hindi people coming to this video appreciating it. I hope you also have the same benefit out of it. Miral is there, Bia is there, Sai is there. Who else? Come on. Other people who can be seen live but do not respond must be lagging behind them. Yes, they will respond to us later with their names. Miral, I know you are Hindi people. I connected to that because I don't know why do I remember you somehow through the discussion. Yes, the new batch is starting from 27th, which is day after tomorrow. I could not talk to you people, the new regular people, because I was all stuck with these existing people to serve as much as I could for them on YouTube. So great, guys. Perfect. Okay, you attended all your lives in March, which is why. Cool. Great, guys. So now listen to me. I'll tell you what some particular question has to learn. Question number 10th is a great question. What it has to learn, right? What's your name, by the way? AM Isogonist. What's your name? What's your name? You have enrolled for the batch. Great. So what's there to learn in question number 10 is really simple. Sir, in this question, examiner has given you the return of the portfolio. Generally, return of individual securities and weight of individual securities is given to find the return of the portfolio. But in this particular question, return of the portfolio has been given. Return of individual security A and B has been given. What you have to back calculate is the weight of security A and the weight of security B, which is not a big deal. In the same formula, if you reverse calculate the weights, it is doable. This is what the question number 10 has point of learning. Hello, everyone. Do you all get me? Please, live people watching up this marathon, do you all get me? 10th question has this point of difference as compared to the previous one. Nihal, that's really great. I'll see you in the next class. Then is one particular question, question number 8, where we have to understand some terminologies. Correct. Just in case it may happen that we know the entire question really well. Sir, perfect positive correlation, which means RS plus 1. which is strongest. Perfect negative correlation means R is -1, and independent or no correlation is R is equal to 0. So if examiner uses the word perfect positive, independent, zero or perfect negative correlation, you should be able to understand what value of R we would want to use in the practical questions. Other than that, we are all set. So after this, guys, we are all set to go to the next discussion. So risk return of the portfolio has been done. I would request all the live people sitting here, all the recorded people here, to please mark the next time stamping, which is CAPM. Brilliant concept, easy topic, and application in the variety of questions, right? So let's do apply that variety for CAPM. Let's first learn the concept, everyone. CAPM, the equation you all know really well. Equation is RF plus beta into RM minus RF is the required rate of return, right? Where you know RM minus RF is market risk premium, beta into RM minus RF is security risk premium. I'll tell you the type of questions institute may ask in this. The first possibility of question, everyone. First possibility of question is finding the required rate of return using CAPM, either of an individual security or the portfolio. If it is investment security, the beta will be given. If it is beta of the portfolio, you can calculate beta. Sir, how do you have the beta of individual security and portfolio? Really simple. Sir, let me show you one more formula, the basic formula. Do you agree beta calculation simply is correlation between security and market into a standard deviation of security divided by standard deviation of market? The formula which should be in your blood, the formula of calculating beta. This can also be said as covariance between security and market divided by variance of market. The formulas have logic, but we have the time foundation. We cannot think of deriving the formulas at all, right? This way you can have the beta of individual security. Fine, sir. Using the beta of individual security, can you find the required rate of return from that security? Yes, sir. Second, if it is the beta of portfolio, sir, it is weighted average beta of individual security, beta of first security, beta of first security, beta of second security, beta of second security, and so on. That gets sorted. The second level of question. You may be needed to not just calculate the required rate of return, but beyond that, you may be needed to comment on whether the security is undervalued, overvalued, or fairly valued, right? I will now tell you a point of learning which will again make your learning really comprehensive or holistic. First, you have to learn this, then I will tell you how to make your learning comprehensive or holistic. Expected rate of return is something else, required is something else. Do you know the difference? Expected is what I think I will be able to earn, right? Expected is calculated using modern portfolio theory, using Markowitz model that we have learned, right? Expected return of security is that X bar and Y bar that we calculated in 8 and 10 columnar table. So for a return particular security, if I have the expected rate of return, yes, I can compare it with the required rate of return calculated using CAPM. And accordingly, I can give the decision of whether the security is under, over, or fairly valued. But sir, how will you give the decision? Simple. Expected rate of return tells me how much do you think you will be able to earn, how much is your estimate or your forecast or your prediction of the return that you think you'll be able to earn. And required rate of return tells you how much you need to earn, how much is the minimum return you need to earn. So there is a difference. One is how much you need to earn, another is how much you think you will be able to earn. If I need to earn 10, but I think I'll be able to earn 12, is it good to buy that security? Obviously, yes, sir. Such securities are considered overvalued. Sir, if the required rate of return is 12, but I think I'll be able to earn 8, expected is less than required, will you buy that security? No, sir, I'll sell it. It is overvalued. And similarly, if the two things are equal, I assume the security to be fairly valued and I theoretically hold it. Yes, everyone in the class? What I am trying to tell you is that two things. The decision of whether you want to buy the security, sell the security can happen in two ways. One possibility, you have to compare the market price with the intrinsic value that you have learned in the chapter of equity business valuation. Market price is there in the market, intrinsic value you calculate. whether that is cash flow based valuation, dividend discount model, whatever. If the market price is more, you say security is overvalued, market price is less, you say security is undervalued, and so on, and accordingly you take the buy sell decision. In your AFM, the buy sell decision of a security can happen only in two ways. One is this one, another is this one, which is we have learned in the portfolio management, which is this and this. Are you able to holistically understand the linkages between the two chapters, from which a question you might have to face in the exam? People, buying selling decision can also happen by comparing expected and required rate of return, and not just CMP and intrinsic value out there. So depending upon the data given, you'll be able to identify that whether it is portfolio management approach or the equity business valuation approach, and accordingly the decision you will have to give. So when you see this, you will have to go to either one of the two chapters in the exam when you see a question on investment decision. Can I make it clear to all the live people sitting here watching me up? Please tell me. This is another type of question that you have to face in the exam. The third type of question that I have to face in the exam is the creation of security market line equation. Guys, do you agree that every line has an equation? Yes, and every equation has variables, right? So the one that are marked in yellow are considered variables. So required rate of return and the beta are considered variables. The logic of it is very detailed. Something is dependent, something is independent. All that we don't talk here. We have to simply focus. Whenever examiner give you the question to form an equation, the variables remain as it is. The required rate of return and the beta remain as it is. But in place of RF and RM, you will have to put whatever numbers of RM and RF are. Once you have those numbers, people, once you have the RMRF, put them up, and that automatically become the equation of CAPM. These are the three possibilities of question that you might have to see in the exam hall. Boss. If you all are ready, shall we proceed ahead to to solve the practical questions from this topic? Yes, what do you all tell me? First practical question on this will be, this extremely easy question, question number 31. Let's go to the practical questions, guys. Question number 31 is the practical question you have to first of all do. What does this question say? I will directly read the question for you. There they say that there are two securities AB and the return of market has been given to you. Fine. For the three economic scenarios that can happen in the future, we can have growth, stagnation, or recession in the future, the probability of which is 40, 30, and 30%. The respective share in the markets are going to give me these possible returns. It can give me 25, 10 or minus 5 return, or it can give me 20, 15 or minus 8 return. Similarly, market can give me 18, 13 and 3 return. Risk-free rate given in the market is 11. Determine whether the investor should liquidate his holding, which means sell the share, or contrary, make the fresh investment, means buy the share. Let's start from the scratch. How many of you agree it is a simple decision of buying, selling? Yes or no? Which in your curriculum can happen only in two ways. Comparing value with value, which is intrinsic with CMP, or comparing expected with required. Anywhere in this question, do you people have the data regarding valuation? No, sir. Which means what thought process will I have to apply? I'll have to apply, people in the class, expected versus required. So let's decode. The purpose of solving this question is not to play around the numbers, but to decode, the solution. I need expected and required. Given the data, let's talk for particular security A. Given the data of security A, do you think the expected can be calculated? Everyone in the class, please think along with me, participate along with me. How many of you feel that expected rate of return of security A can be calculated? Come on. People. Sir, if I have been given the possible returns and if I have been given the probability, so possible return into probability automatically gives me the expected rate of return, so life here is sorted. So required rate of return requires three things. Which three things? It requires RM, it requires RF, and it requires beta. Yes, RM, RF and beta. Sir, RM is market possible returns and probabilities are given. So market rate of return will also be found out. RM and probability. Cool. Next people in the class is RF, which is everyone in the class, 11%. Fine, sir. And next people in the class is beta that we need. Can I say beta's calculation require correlation between security market and SD of security divided by SD of market? Which means to find the correlation between the security and market, and to find the standard deviation of this security and market, I now need to make that 10 columnar extended table where first security X will be market and second security Y will be security A. Do you understand the background with which I want to discuss this question with you? Hello? Do you understand the background? Which means now people in the class, what I'll have to do? I'll have to create that 10 columnar extended table. Observe this. 10 columnar extended table, right? Where X is market, Y is security. My question to you is, rather than now creating the table, which we have done in the previous one, can I directly use the output of this table? Hello? Can I directly use the output of this table? Yes, there's no point of doing the same table again. So we will say, examiner has used here the formula of covariance divided by variance. You can also use covariance divided by SD and SD. The beta answer will be same, which is 1.345. So using the correlation in SD or using covariance and variance, once you have the beta will help you calculate the required rate of return, and comparing with the expected give you, everyone in the class, the final decision. If beta is 1.345, let's apply a CAPM. Sir, what is the expected rate of return of market? 1813 minus 3. 1813 minus 3. With the prefect of probability, the expected rate of return of market become 10.2. RF is 11. So beta into RM minus RF plus RF. So 11 plus 1.345 into 10.2 minus 11 give you the required rate of return of 9.924. So based on the risk involved, based on the beta, I need the required of 9.924. But the expected from the same share is 11.5. The share is expected to give me 25, 10 or negative 5, the probability of which is this. So the average return people I'm expected to have is 11.5, whereas what I need is 9.924. So what I'm expecting to earn is more than what I need, which is why I should make the fresh investment in this share. In other words, I should buy this share, which simply involved expected is more than required. Yes, people in the class, are you all aligned to me on this? Please tell me. I need your validation. The first question of CAPM, could you understand? The same data make you calculate expected, the same data make you calculate required through beta especially and RMRF, which may be given. Could I successfully do this, explain this question? 31, is it worth? So I think it make more sense rather to do calculate each and every number, which you can do at home and which you have done multiple times. Right now, let's focus on the flow of the solution, right? 31 gets done. Next question will be question number 35. It is the question of same under overvaluation, buy sell, but this time you have to apply the valuation approach and not the expected required approach. Sir, how do you know? If examiner give you dividend paid, it gives you the data of growth. Isn't it giving you the information or hint regarding valuation? Isn't it giving you the hint regarding Gordon's model? So using Gordon's model, you have to calculate intrinsic value, then you have the CMP, and then you have to comment down. Question number 35 is there. Only point of remembrance in this question is that question 35 has an ambiguity, which institute didn't rectify even at May 24 attempt. What is the ambiguity? The ambiguity, people in the class, is that in the next year, information has been given with respect to 2 year, year 1 and year 2. Present year dividend paid is 3. So I know it is D0 and I'll have to assume I have to add growth to make it D1 divided by K minus G, right? For next year, anticipated dividend of 2.5 has been given. Ambiguity is even 2.5 has been considered D0 and growth rate has been added here. Sir, what level of rubbishness is this? This is it. We have to please accept and solve the question like this in the exam. That is question number 35. Am I clear? Right, people? Next question that you have to properly do in the class is this particular question 38. Not properly do in the class. Again, we'll try to give you a sense of it. Proper question we will do in upcoming question. 38, category A question. What is the point of learning in this question? This question says you have to find the market rate of return and you have to find RF. Please tell me, have I anywhere taught you the calculation of RM and RF? Is there a particular formula to do it? No. So you have to apply your brains and figure out if examiner asks something which is generally not calculated through a formula, in that case, it requires reverse calculation. If I have been given the beta of the security and if I have been given the expected or required rate of return of the securities, sir, can I using that equation calculate RMRF? But sir, two variables we cannot find out. What if you have two equations? For first security having its beta and its required rate of return, 7 security having that's beta and its required rate of return. RMRF is a common number for all the security because they belong to market. So if you have two securities, you will have two different equations for two securities where RF and RF will be the common numbers which you can back calculate is the point of learning which I want to tell you. Is the point of learning that I want to tell you in question number 38. Please observe. You will have two equations. Required rate of return is RF plus beta into RM minus RF. For second security, required rate of return is RF plus beta into RM minus RF. Two equation, you apply elimination, you apply substitution, whatever you apply, right? The point of now the point of learning is not math. The point of learning is any question require back calculation of RMRF. This is how you can do it using CAPM. Could I explain the point of learning here? Everyone in the class, please validate, because it was not even reading the question, explaining that particular part of the question. 38th question. Could I successfully do it, people? Please, could I successfully do it? What do you all say? Your response will decide my approach. Right? How many of you feel really exhausted at this point? At this point, everyone, how many of you feel really exhausted? Really done? You are? Yes. So, all right, fine. Let's solve just one or two particular questions, right? Then we'll proceed to take a break after that. All right, cool. So, people in the class, these two easy questions, please pay attention. Question number 42 by the institute, right, says that expected return of two stock for particular market returns are given below, right? Sir, if the scenario in the market is bearish, right, then market will give you 7% return and the two different stocks, one is aggressive, another is defensive, will give 4 and 9% return respectively. Yes. Similarly, if the case is bearish, if the case is bullish, then market will give you 25% return where aggressive and defensive stock give you 40 and 18% return, right? What you have to calculate is the betas of the two stock. So first point of learning, wherever you have to calculate beta and there are two data points given, the beta calculation really simple. How many of you remember that formula of beta, percentage change in the return of security divided by percentage change in the return of market? So how much is the return of security changing from 40 to 4 to 40 it become 36, and how much is the market changing from 7 to 25, it become 18% change. So beta automatically become 2 times. That is the easiest way to calculate the beta, which they have also calculated using another method. So first point is to calculate the beta. The same thing you do for another security. 9 to 8 is 8% change divided by 18. Give me 9% change divided by 18. Give me 0.5 times beta. Second, the expected rate of return of stock is market is equally likely, which means market has 50% chance of attaining 7 and 25. Then what are the chances of aggressive, what is the return aggressive and defensive stocks expected to have? We will say 4% will be the return has a 50% chance and 40 has 50% chance. The average return people in the class is 4 into 50, 40 into 50 is 22. Similarly, for this security, you can do. So B part, again easy gets done. Third part, give the line of security market if RF is 7.5 and RM is equally likely. So RM 7 into 50% M plus and 25 into 50% M plus give me RM of 16%. So in the equation of CAPM, which is the line of security market line, beta and required are variable. RM and RF, you have to put numbers. So 7.5 plus beta into 16 minus 7.5 is equal to the required rate of return. That is the equation of security market line. So 16 minus 7.5 give me 8.5. So 7.5 plus 8.5 beta is equal to the required rate of return. That is the equation examiner is expecting you to answer. Required rate of return is equal to beta plus beta into 8.5 plus 7.5. This is the rate of return, right? And at last, everyone in the class is the alphas of the two stock that you have to find. Now, this is something I would want to avoid because it relates to the question of characteristic line, right? The concept of characteristic line we have not done, but when you do, you must do this particular question. The concept of characteristic line is this equation, which says the expected rate of return on the stock is beta into expected rate of return plus alpha. So in this question, if you observe, we have the expected rate of return on the security, expected rate of return on the market, and its beta we have. Can we reverse calculate the alpha using this equation? The answer is yes, and that is exactly what has been done in this question, right? That is what exactly has been done in this question if you observe here. We have not done it, we don't have to do it in this class, but is something you must do. People, settled are we? Do you want me to do it? Please respond. What do you all say? Do you all want me to do it? Please respond to me. What do you all say? So then question number 42, when gets done, the last question in this category is question number 45th, which is a series of ambiguous questions. 45th is just one question. It is a series of ambiguous questions that you have to learn. The last category of CAPM is what you're dealing with now. People, the last category. Shall we proceed to take a break now? Please. Before solving this question, or if you allow me, this question gets solved, then we take a break and then we do other practical concept of portfolio management. Sai, was that response for break? I missed it. Was that response for break? Lunch break, is it? So that's completely all right. We can proceed to take a break, post which we will solve this particular question and do other topics. Great, people. So right now 108, which is 110 is there. We will take a break till 1:30 and then we'll be back. Let's meet back, guys, at 1:30. Post which we will do rest of the question. I think one question particularly of CAPM. Then we do other topics of portfolio management. Yes, guys. So see you all after this 20-minute break. Bye-bye. Live people, those who are lagging behind, who wants to join live, please make sure you manage your break accordingly and come to the latest point at 1:30 p.m. when we start. All right. Bye. All right. So everyone in the class, are you all pleased back there, everyone? Come on, come on, come on, come on. Tell me, who all do we have in this class today? Yes, people. Who all do we have? So what were we doing? So before the break, we were doing the topic of CAPM and trying to cover different varieties of question being asked by the institute in this topic of CAPM. Yes. Do I have all these live people back? Yes, yes, yes. Tell me. Yes. So we have to start doing question number 45th. So 45th is a particular type of question is typical in nature and institute ask it repeatedly and the same ambiguity it is asking for so many years and we have to do this question in the exam, do the solution of this question in the exam in the same ambiguous manner, right? What it is, it says that Mr. X is holding a portfolio. The portfolio has 4 securities, 3 share and a PSU bond. The cost of the shares and securities is given, the dividend earned is given, and the market price has been given. The beta of the security has been given. The risk-free rate of return is 20%. Calculate the following: the expected rate of return of each using CAPM, which means using CAPM, you have to find the required rate of return or the expected rate of return of each security. Fine, sir. Sorted. What all do you need? Sir, for every security, I need RF. मतलब in total I need the risk free rate of return, RF, RM and beta. The 3 things that I need is this. Do you have the RF? Yes, sir. Do you have the betas of individual security? Yes, sir. But what about RM? Is the rate of return of the market given? No. And that is where assumption comes into picture. All the live people sitting here, please understand this is the first assumption that you have to remember in this question, that this entire portfolio has been assumed as market. What it has been assumed as? It's been assumed as market. And whatever the return this portfolio has generated will be considered as the return of the market. So I will say, everyone in the class, if A, B, C, if these are the 4 securities and PSU bond, so the total cost invested for them is 16, 20, 32 and 68. The total dividend earned is 16, 16, 16, 6800. The market price of them is right now this. So if I assume it to be P1, this to be P0 and this T, the return generated by this portfolio is 146 minus 136, right, plus 11,600 divided by 136 give me 146 minus 136 plus 11.6 divided by 136 give me 15.88%. This has been assumed as the return of market. So now what I'll say I have RM, if I have RF, and if I have the betas of individual security, can I calculate the individual required or expected rate of return? Answer is yes. Please check this out. RF of 12 plus 0.9 beta into RM minus RF is this. Similarly, second security, third security, fourth beta, you change the beta, you get the required rate of return. That simple is question number 45. First part. Assumption 1, you have to assume a portfolio to be the market. Second, average return of the portfolio. Sir, what is the average return of the portfolio? Sir, this is the average return we just calculated. No, this is the return actually earned. What is the return as per CAPM? CAPM return require the beta of the entire portfolio. So now you have to calculate the average beta of the portfolio, and the second ambiguity in this, the second assumption required is that you have to do simple average, right? Even if the weights are available, you don't have to do the weighted average beta. The second ambiguity is you have to do simple average beta. So 0.9 plus 0.8 plus 0.6 plus 0.4, the weighted average beta is 0.65. And based on the weighted average beta, the required rate of return, expected rate of the return become beta of the portfolio. RM minus RF plus RF give you 14.62 as the return of the portfolio. This was everyone in the class question number 45th, which gets done. Now is question number 46. Question 46. Again, the entire question we don't need to do, but it is similar to the previous question that will solve. 46th question is different from 45th question such that in the previous question, so story same, this is the same data given to you, just that in the previous question RF was given and the return of the portfolio was asked. In 47 question, return of the portfolio has been given and RF has been asked. It doesn't matter. More or less the story is same. I know that the required rate of return on the portfolio is RF plus beta of the portfolio into RM minus RF. Sir, the way to solve is same, right? The required rate of return this time is given. The risk-free rate we have to find. The entire portfolio can be assumed as RF, and the average of the four give me the weighted average beta of the portfolio. That's also available. So the only number that will be missing is the number of RF. Could I please, people in the class, explain? Using the return of the portfolio in this equation of CAPM, I will have to, the return of the portfolio which is given to me, I will have to, please don't assume the actual return of the portfolio to be the return of the portfolio. That is assumed as return from market. The required rate of return has been given in the portfolio. RF is to be back calculated using the simple average beta and the RM. Perfect. Once you have the RF and RM and individual securities beta, the first part which is calculating CAPM for individual security gets done. Now is my main point of learning to you, teaching to you. Question number 46. Institute solved in this manner. In the recent study material, Institute give an alternative way of solving the question. That alternative way I'm not explaining. But in my opinion, you should learn both the ways if possible. Why? Because it may happen that Institute may specifically give you some hint to apply alternative to. But in the attempt of Jain 26, this question was asked in MCQ. In MCQ, when they give you the choice, the choices were given as per this particular alternative that we discussed and not as per alternative 2. Which is why you should have both the alternatives, because it may happen that Institute, if asked this question in MCQ, then there you don't have an option to follow an alternative. There you have to follow the alternative as per which the answer matches. Correct? Due to which I'm saying you should follow both the alternatives. But yeah, otherwise, preferable is one alternative, the something that we have done, because it aligns with the previous question and other such questions. All right, it aligns to them, so it become easy for us to remember. That was question number 64 gets done, and that is where your entire CAPM discussion, people in the class, gets done. So what in the portfolio management you are done with? You are done with these two things. The next thing that you are learning in the portfolio management is Sharpe, Treynor, and Jensen's alpha, right? So live people sitting here, please pay attention. Recorded people, kindly make sure that, just one second. Yes. So recorded people, please make sure that you do this time stamping or Sharpe, Treynor, Jensen's alpha, which is also repeated quite a few number of times. So I will say, let's go to that particular section in terms of concepts. Let me tell you, this is just 1 minute. It will take for you to learn the concept. Just 1 minute. What it says? Sharpe, which is a reward to variability ratio, Treynor, which is reward to volatility ratio, and Jensen's alpha is the ratio. These are the three ratios used to rank the portfolio. To evaluate them, which one is the best? So the portfolio that generated higher return is the best portfolio, correct? But then you will have to realize what? That the return generated by the security or the portfolio, whether the return of past or the future, you have to write multiple names. Return of the portfolio actual or return of the security actual, return of the portfolio expected or return of the security expected, whatever it is, whatever return it is, minus the risk-free rate give you the excess return, divided by standard deviation of the portfolio is Sharpe. This one gives you divided by beta is the Treynor. Numerator remains the same. And last one is really simple, the expected rate of return minus the required rate of return. This is expected or actual return of the future or past respectively, minus how much was required as per CAPM tells you, over and above required how much alpha you have generated, that is Jensen's alpha. More than the formulas are important two things. Do you agree the ratios are considered better if they are higher? First thing. Second, the unit of Sharpe ratio is times. Because numerator is percentage, denominator is also percentage. Returns are percentage, ST also has to be percent, and the answer is become times. If numerator is decimal, SD also become decimal, and the answer is in times. Treynor ratio, people in the class, unit for that is either percentage or decimal. If the rates of return are in percentage, then the Treynor ratio also has to be percentage. If the rates of returns are decimals, because divide by beta is nothing, beta has no unit, beta tells you just the times, it has got no unit. So if rates of returns are decimals, then the unit, the final answer has a unit in terms of decimal, and the sum goes with the Jensen's alpha. If everything is percentage, final answer percentage, everything is decimal, final answer decimal, related to which if you have to solve the practical question. We'll start with the first practical question, which is extremely easy. 57 is such an easy question, there's no point in fact of doing it. Just for your comfort, we can discuss this once, right? There are 5 different portfolios. For each of the portfolio, we have been given the actual return earned by them in the past. We have been given the RM and RF, right? We have been given the standard deviation of all the securities, including the market, and we have been given the correlation of these portfolios with the market. You have to find Sharpe. Can I say Sharpe is return of the portfolio minus the risk-free rate divided by SD? Do you have the return of the portfolio? Do you have the risk-free rate? Do you have the SD? So 19 minus 9 divided by 2.5. 19 minus 9 divided by 2.5 is the 4 is the answer, which is very, very, very easy. Do you agree to it, people? Extremely easy. Yes. Next is Treynor's method, which is return of the portfolio minus the risk-free rate. Numerator remains the same, divided by beta. Sir, is it possible from this given information to calculate beta? Yes, sir. Beta is correlation of security with the market into standard deviation of security divided by standard deviation of market. So 0.84 into 2.5 divided by 1.2. 0.84 into 2.5 divided by 1.2 give me 1.75 beta. So 19 minus 9 divided by 1.75. 19 minus 9 divided by 1.75 give me the Treynor ratio. Again, extremely easy than you can expect. Last people in the class is Jensen's alpha, which is CAPM, right? CAPM, everyone in the class involves RM, RF, and beta of 1.75. How much become the required rate of return? So 14 minus 9 into 1.75 plus 9 give you the required rate of return of 17.75, correct? And if the actual return is 19, so 19 minus 17.75 give you the excess return as 1.25. What you have done for security, if you do for all 5 securities, people, then you can rank them as per higher is better, and that simply solves question number 57. That was starting with the basic question, right? 58th is an easy question, right? 59th is a question which is a category B question. Only thing I want to tell you in this question, let me focus on the point of learning, right? Sharing these points of learning can help you to save time. At the same time, know what is the thing a particular question has. Sir, average return is 9, 6 and 5 for the 3 different portfolio and market, whereas the risk-free rate is 9. So when you say the numerator is return of the portfolio minus the risk-free rate, the numerator become negative, -2, -3 and -4, which is why the Sharpe Treynor that you calculate, also people in the class become negative. Do you observe the point I'm trying to tell you? In that case, don't doubt your solution. The Sharpe and Treynor and Jensen's alpha can also be negative, because the numerator of Sharpe and Treynor, if is negative, the final answer has to be negative. Could I convey to you the simple point that will happen to you in case of 59 question? Last, don't get confused in the ranking. For example, 0.4 and 0.5. One is negative 0.4, another is negative 0. Which of the two is a higher number? Sir, this is 1 because it is a higher number, and this is 2, this is a lower number. So for ranking, higher lower should also be clear. Question 59, the point of clarity which was missing has been done. Question number 60, one particular thing I will guide you for this reverse calculation question. We will try to cover as much variety as possible for these concepts, starting with this question 60 asked in November 24 exam. Sir, there are 3 funds: growth fund, balance fund, regular fund and market. The average return has been given, the variances are missing, the Sharpe and Treynor's ratio have been given. Please pay attention. Obviously, now when someone gives you Sharpe Treynor and asks you to calculate the variance, we realize it is a reverse calculation question, right? Because naturally, to calculate variance, you need the possible return x, then you do x bar, then you do dx and so on. That's how you calculate originally the variance using modern portfolio theory, Markowitz, right? But here you have to calculate variance. Sir, let's try to put the formula of Sharpe. Sharpe I know is negative 0.15 is equal to 7.5, the return of the portfolio, minus the risk-free rate 9 divided by standardization of the portfolio. So can I say solving this question automatically give you the SD of the portfolio? Squaring it up will give you variance. For example, 7.5, right, minus 9 divided by 0.15 give you 10 as the standard deviation of the portfolio, square of which is variance. The first part people in the class gets done. Second part asks you to calculate coefficient of determination. Yes, do you people know what coefficient of determination is? Yes sir, correlation between security and market square. But how do we find it out? Let's now make use of Treynor. Treynor is minus 2, which is equal to 7.5 minus 9 divided by beta of the portfolio. Using this, sir, can you find beta? Yes, sir. So 7.5 minus 9 divided by 2 give me 0.75 as the beta positive. Fine, sir. How do you calculate beta? Sir, beta is equals to correlation between security and market into standard deviation of security divided by standard deviation of market. So if I have beta of 0.75, if I have the standard deviation of security just calculated as 10, the variance of market has been given. So 50.41 under root is 7.1 SSD. Can you not calculate the correlation? And once you have the correlation, you can square it up. So 0.75 into 7.1 divided by 10 give me 0.5325, square of which is 0.2835, on a rounded off basis 0.2836 as the coefficient of determination. 60th question again. Are you people aligned to me? What you have done for one particular mutual fund, you have to do it for all mutual fund. The next question is question number 61. I will just give you a sense of it. Just a sense of it. In fact, let me tell you, this is a good question. Effort taking question will involve creation of an equation. Just give you the point of learning. Do you observe in the previous question, Treynor ratio is given as -2. Why? Because the numerator are in percentage. 7.5 is percentage and 9 is also percentage. Right? If 0.075 minus 0.09 is there, can you have the Treynor to be 2? No sir, it will be then 0.02. Do you understand my point? The two things should be aligned. But that is what institute played around on in question number 61. It gave the return in percentage. Actual return in percentage, Jensen's alpha in percent, which the Treynor people in the class was in decimal. So you have to align the two things and you have to assume the Treynor to be 7.14 and 7.75%. This was particular point of learning at this particular question. First. Second, otherwise rest of it, if you make the effort, you'll be able to understand and solve this question at your own, question number 61. And that was simply, people in the class, the concept of and the question related to portfolio performance evaluation, which was our topic of Sharpe, Treynor and Jensen's alpha. Yes, people. And now after that, you have to be all there with me till the end. Now after that is systematic and unsystematic risk. What it is? Systematic and unsystematic risk. Let me tell you for that. Sir, we have to learn some concepts. Let's make sure the basics are clear, and then a practical questions that we do will really give you confidence. Perfect. Starting with the basic systematic, unsystematic, guys. Systematic is also known as non-diversifiable, unavoidable market. Unsystematic, it's also known as diversifiable, avoidable, specific risk, unit risk, idiosyncratic, residual, random variance, random error. These are the names which you might have to see in the exam. Correct? Fine. Miral, are you there? Able to connect to me? Super great. First thing, calculation of beta. Are we clear with it? Yes, sir. This is correlation method. This is regression method. Yes? Fine. Not focusing on it. Focusing on the first thing, calculating from this total variance, how do you break it to systematic and unsystematic? Total variance means variance of a particular security, which is sigma A square. The systematic is really simple. We had a flow in the class that standard deviation of market into beta square. Standard deviation of market square into beta of the security square is the formula. Flow will be really simple. will be there, Miral, for the whole session. That's really great. Like your determination, right? We will say how much is the risk of the market multiplied by how many times is my security risky as compared to market. Could you connect to the flow we talked about it in the class? How much is risk of the market and how many times is the risk of the security relative to market of that was the flow, and accordingly my systematic variance become the set square level. And unsystematic we say, which is represent with sigma. Please understand, understand, it's very important to understand how these calculations are denoted. We can say sigma e, this belongs to error term. It is unsystematic sd of a security, and when I square it up it become unsystematic variance of a security. Do you get my point? So point, people in the classes, the way to calculate unsystematic is really simple. Total variance minus systematic variance is equal to unsystematic variance. There is no other formula particularly to calculate unsystematic. It is total minus systematic is unsystematic. Sorted? Cool, sir. Fine. Then, sir, we learned beta of the portfolio to be weighted average beta of individual security. That is also fine, sir. Basic, doable. Next is unsystematic risk of the portfolio. The way you have broken down the things at security level, the same level of breaking down you can do at portfolio level. Sir, if you have the total variance of the portfolio, sir, total variance of the security, I understand it is summation of dx square divided by n, or p into dx square, sir, fine. If it is exposed data, this is the formula. This is ex ante data, this is the formula. But for portfolio, how do I calculate the total variance? Boss, Markowitz model, a plus b whole square. So if you have the total variance of the portfolio, it can be broken down as systematic and unsystematic. Cool. Sir, how do you calculate systematic in that case? Really simple. How much is the market risky? And this time think it in terms of portfolio. How much is the market risky multiplied by how many times is my portfolio risky relative to market? So I will say SD of market into beta of the portfolio bought a square level. So standard deviation of the portfolio minus the systematic variance calculated this way is the unsystematic variance of the portfolio. Total variance minus systematic variance is equal to unsystematic variance of portfolio. I will now explain to you a chart again which gives you a holistic idea of the things. Right? It will help you to understand the things. Please pay attention. And those who are watching it for the first time, please like this particular video, share your comments on how has your experience been. Right? Let me tell you this interesting part here. If you have two securities in your portfolio, perfect, sir. For individual security, how do you do it? Sir, if you have the total variance, from which if you deduct systematic, you get the unsystematic of individual security that we learned in the previous section. Guys, total of the security minus systematic gives you unsystematic of security. Sir, can we do the same thing at portfolio level? Yes. If you have the two securities total risk, using Markowitz, a plus b square, I can find the total of the portfolio. People in the class simply find the total of the portfolio, correct? From the portfolio's total risk, if I deduct portfolio systematic, something that you've learned here, give you the portfolios unsystematic. So total portfolio minus portfolio systematic is portfolio unsystematic. This is the method 1. Now I'll teach you method 2 as well. Method 2 says, if you have the unsystematic risk of security A and if you have the unsystematic risk of security B, using individual securities unsystematic risk also you can calculate the unsystematic risk of the portfolio, is what people in the class we are trying to teach you here, that using the risk of individual unsystematic securities, using the unsystematic risk of individual securities, you can calculate the unsystematic risk of the portfolio. Sir, how come? Simple formula, a square plus b square. Sir, where has 2ab gone? It becomes 0 due to something that I don't want to explain now, right? We can't go into the derivation of formula. I will just tell you a square plus b square means unsystematic SD of A weight of A whole square plus unsystematic SD of B weight of B whole square. That's how you can directly calculate the unsystematic risk of the portfolio using method 2 above. Perfect. Fine. Sir, which method to use, that data will automatically guide us. Sir, now before proceeding ahead to the question, I want to tell you the Sharpe index model, what it is. Sharpe index model, right, is altogether new model of calculating risk and return and correlation of the security or of the portfolio. Sharpe says the return of the security is calculated using characteristic line. We have not learnt this concept in the class right now. It was not a high priority topic, right? So I will say the characteristic line tells you the expected rate of return, not discussed. The risk people in the class is, according to Sharpe says first you calculate the systematic risk, either of the security or the portfolio. Then you calculate unsystematic risk, either of the security or the portfolio, and then you add them up to calculate the total. So at variance level, when you do systematic variance plus unsystematic variance, give you the total variance, under root of which will be the total SD. Always remember, it is the addition deduction, the addition of risk happen at variance level and not at SD level. Sir, how do you calculate unsystematic risk of the security or portfolio? Simple. Market SD square into beta of either security or portfolio, whatever be the case, is square. Fine, sir. Sir, what about unsystematic variance of the securities or portfolio? For security, the unsystematic variance is always given, or SD is always given. You cannot find the unsystematic of SD, right? Unsystematic SD of a security, because only way out to calculate the unsystematic of this SD is total minus systematic is equal to unsystematic. So if I have to find the total, how can I do total minus systematic is equal to unsystematic? Examiner has to give you the unsystematic of a security. Sir, what about unsystematic of the portfolio? Simple. For portfolio unsystematic, there are two ways. Total minus systematic is equal to unsystematic of the portfolio. But sir, again the same thing. If they are asking for the total, how can you say total minus systematic is unsystematic? That something is missing, right? Then the unsystematic of the portfolio will be found using this B method here. Using the unsystematic of individual securities, sir, formula B above will give you the unsystematic of portfolio. And once you have the unsystematic of portfolio and the systematic of portfolio will give you the total of the portfolio. Are you all people in the class able to understand that Sharpe index model tries to calculate the risk of the portfolio not with using A plus B whole square? It says find the systematic separately, unsystematic separately, and add them up to find the total. Are you all people in the class connected? Please tell me. Are you all people in the class connected to this? What do you all say? Perfect? Yes. So let's now do the practical question of it so that you are able to connect to everything which goes on in the class. Starting with the first practical question being, this really brilliant question. Question number 23. Miril, sorted. Great. Perfect. Now let me do the practical question so that you can feel the application of concepts. People in the class, let's pay attention, right? I feel slightly disappointing that I got so stuck in making the YouTube videos for English people that it is too late for me to make these video for English people. Which is why I understand a lot of people are not able to join live because they must have started to prepare. Some of you prepare AFM, and a lot of you will watch up this video one day before the AFM exam. I know it. But taking it live at that point, it's better to take it now so that there you have a margin of watching it at 1.25, right? Or watching some particular topics rather than our video, in their video if you want. So I thought rather than doing nothing at all for you guys, it's better do something, even if it is quite disappointing that not all of you are able to join live, because it's a high time to prepare, to start to prepare AFM. Some people do it from 26, some people do it from 27, right? So it's subjective actually, but great. I know the video is going to be of help to you. Miral, on top of everything, I appreciate your determination that you are there in the class. Yes. So Sir, question number 23. What it says? Sir, there are three shares in the portfolio, X and Y and Z. Yes. Portfolio weight in my securities, individual security has 30, 50 and 20% weightages, where beta is 50, 60, 0.5, 0.6, 1 by 2. The rate of return I'm expecting to earn is 15, 16 and 20, and the total variance is 0.02, 0.01, 0.12. Sir, if the return is 15, 16 and 20, aren't the variance too less? Yes, sir, because returns are in percentage terms and variance are in decimal terms. Do you know this relationship? Return and SD. If you have to convert to decimal, you have to divide them by 100. From percentage to decimal, if you convert. Similarly, variance of security or portfolio, variance and covariance, if you convert, you have to divide them by 10,000, which is 100 square. Cool, fine. SD of the market is 12%. You are required to calculate portfolio beta. Can you give me the answer in the next 30 seconds of portfolio beta? Everyone. Portfolio beta, people. What it says? It's 0.5 into 0.3 m plus, 0.6 into 0.5 m plus, and 1.2 into 0.2 m plus give you 0.690 times as the portfolio beta, which is an extremely easy part. Not a big deal at all. Cool? Fine. Then they ask you to calculate the residual variance for each of the three shares. For each of these three shares, what do you calculate? The residual variance, what does it mean? What are they asking us to calculate? Medial beta is 0.690 times, that's great. So for your reminder, beta you have to take till 3 digits after the decimal point. So it's point, if it is 0.6912, it will be 0.691. Yes. So residual variance means they want you to calculate the unsystematic variance of individual securities. What is the way? Sir, from the total, if you deduct systematic, what you get is unsystematic. This is my total. Sir, let's deduct systematic. How do you calculate systematic? Sir, what is the risk of market? 0.12, now in decimals, multiplied by its beta of 0.5 whole square. Yes. So 0.12 into 0.15, 0.12 into 0.5 whole square, that if you deduct from 0.0 to 0, you get 0.0164 everyone as the unsystematic variance of the first security, right? Exactly the same way. From the total of second, if you deduct the SD of market into its beta whole square, you will get the unsystematic of second one, and similarly the third one, you have done it. The third part, which is going to add to your conceptual clarity, please tell me. They say the portfolio variance using Sharpe index model you have to find. Portfolio variance using Sharpe index model you have to find. Please tell me, according to Sharpe index model, how do you calculate portfolio variance? Sir, first you find the systematic of portfolio, then you find the unsystematic of portfolio, then you add them up. But sir, if the examiner does not give you this, my main question on this video, on this particular topic is, if examiner does not give you, which model will you apply? The Markowitz model, which is a plus b whole square, or systematic plus unsystematic model, which is Sharpe model? Sir, the way to figure that out is really and extremely simple. Listen to me. If I give you a challenge right now, that okay, you find Markowitz, you find risk as per Markowitz, can you do it? Sir, individual security risk we have, so a square b square plus c square, so weight of a, SD of a, weight of a given to me. Cool. Sir, is the correlation between the securities given to you? Do you have the correlation between the security X and Y, or Y or Z, or Z or X? No. So if the correlation between the securities is not there, even if you want, can you please calculate? Even if you want, can you everyone in the class calculate Markowitz? No. So it is the correlation between the securities or covariance between the securities which help you decide whether you have to apply the Sharpe model or the Markowitz model. Could I deliver that point of conceptual clarity to you? So in this question, even if they don't mention it, I know that I don't have a choice other than to follow Sharpe. So I will say, what is portfolio variance now? Systematic plus unsystematic. What is systematic variance of the portfolio, sir? SD of market into beta of the portfolio that you calculated in the first part whole square give you the systematic of portfolio. So 0.12 into 0.69 whole square give you the systematic of portfolio 0.006856. Fine, sir. Sir, what about unsystematic of the portfolio? Is it total minus systematic? No, sir. Total is what you have to find. So then how do you find the unsystematic of the portfolio? Using the unsystematic of individual securities that we found here. So unsystematic SD of first security into weight of first security whole square. Do you agree unsystematic variance of first security you already have? So what you have to multiply it with only is the weight of first security. So 0.016400 into weight square, second security variance into weight square, third security variance into weight square. Give you the unsystematic variance 0.006651. Align to me. A square plus B square plus C square. That's all. So then I say systematic is this, unsystematic is this. Adding the two people in the class will give me the total variance of 0.013507, which is what the institute asked for in the C part of this question, question number 23. Requesting people in the class, your responses please. Could I successfully explain how does examiner ask you question on systematic and systematic? Please tell me. Please, please, please. Just give me a minute and respond to me. Are you aligned to this? Yes or no, guys? What's happening? Settled are we? Perfect. So now, what's the next thing? Sir, next thing everyone in the class is learning the point of learning of question 24. Yes, question 24, people in the class specifically ask you for the, gives you the specific SD of expected return. In the question, if the student is not able to understand what is given, then the question solving is gone. Hello? They have given you a specific SD, it means a specific risk, it means unsystematic SD of the security has been given if you realize. So if you have to find the total SD of A and B, it is unsystematic plus the systematic you will have to add to find the total SD. That's what question number 24 is primarily about. So first point of learning in question number 24 is knowing that a specific SD is unsystematic SD. Second point of learning in this question is there is also a risk-free security in this question, the treasury bill. My point it is doesn't matter. Your formula continue to remain the same. For example, formula is beta, weighted average beta. So beta of first security, weight of first security, beta of second security, weight of second security plus beta of third, weight of third. Third security we know is a risk-free security. Fine, sir. What will its beta be? Zero. What will its weight be? Whatever. Do you agree this entire part becomes zero? Then rest of it you solve and that become the beta of portfolio. My point is all the formulas will remain the same whether the security is a risky security or a risk-free security. All you should be able to understand is that beta of a risk-free security is zero. Standard deviation and variance of a risk-free security is zero. The return of a risk-free security is the risk-free rate of return. So on my treasury bill, if my risk-free rate of return is 6%, so that becomes the rate of return on the risk-free security. Everything else, people, is same in question number 24. Then the next thing we should look at is question number 28. Everything else we have seen before is all easy. Question 27 has a point of learning. 27th question, they say the random error is this, right? So what happens is that they say there is a portfolio which has 4 securities, their betas has been given, the random error has been given. Do you agree random error is unsystematic risk? But now that is unsystematic SD or unsystematic variance, please understand when they say this sigma, when they say E, it is the error term. But do you agree if it is not square, nothing is mentioned here, which means it is my unsystematic SD is what you have to take and weights are given. Sir, you have to find the risk of the portfolio. So simple, sir. Total is equal to systematic plus unsystematic. That's how question number 25 involves very easy solution. If I have the beta of individual security and the weight of the securities in the portfolio, can I find the beta of the portfolio? Yes. That multiplied by risk of the market give me everyone the systematic of the portfolio. How do you find the unsystematic of portfolio? We just did it. Individual securities unsystematic and their weights a square plus b square plus c square plus d square give me unsystematic variance of the portfolio. And systematic plus unsystematic give me total variance of the portfolio. That simple question 27 is. Only point of learning here was interpreting this random error. Yes. So I'm trying to make sure that everything which is needed to be explained, I'm able to explain it to you. Now question number 28 is the next question we're going to do in the class with a small point of learning here. What is the point of learning is really simple. It says what? It says that if there are all the live people sitting here, all the recorded people pay attention. It says that according to Sharpe, the correlation between the two securities directly does not exist. It is the correlation of the two securities with the market that exists. So it says that correlation of first security with the market is 0.8. Correlation of second security with the market is 0.7. Then the correlation between the two securities 0.8 into 0.7, which is 0.56. So according to Sharpe, correlation between AB is A with market and correlation of B with market. That simple is the thing. So sir, based on that simple thing is question number 28. Let's learn what this question is saying. All right. So this will again comprehensively cover this entire topic of, after this question, this entire topic of systematic and systematic risk, and will entirely complete this chapter of portfolio management, post which is going to be another easy and extremely important chapter of derivatives. Yes, boss. So let's now go ahead. Sir, a study by the mutual fund has revealed the following securities. There are 3 securities, A, B, and C. The standard deviation of that is 20, 18, and 12. The correlation of that with the market, sir, correlation is also represented with this Greek letter, which looks like P, called as rho, RHO, rho. So correlation of that security with the market is 0.6, 0.95, 0.75. Standard deviation of the market is 15%. What they are asking you to calculate, people in the class, is what is the sensitivity of returns of each stock with respect to market was? What are they clearly asking you to identify? Sensitivity of returns of stock with respect to market. So what they are asking for people in the class is beta. Yes. Oh my God. Where are you people? Back. Gayatri. Where were you lost in between? Miral. There. So what they are asking for is the beta of the two stock, right? So what do we say? What do we say? Can you calculate beta? Yes, sir. Beta is correlation of security with the market into SD of security divided by SD of market. So 60 into 20 by 15. 0.6 into 20 by 15 is 0.8 times beta. And similarly, 0.95 into 18 by 15 give you 1.14 times beta, and so on. Next is the important point you have to learn here, boss. What are the covariances among various stocks? Do you observe? They are not asking the covariance of the security with the market. You might think, sir, correlation is there and covariance I can find out. No, that's the correlation of the security with the index with the market. And what they are asking is the covariance between the securities. Do you realize how is this question different? And that is where we have to make use of that another formula. There are two ways. Markowitz says the covariance is simply dx into dy. Have you been given the individual deviations of possible return x and y? No sir, no such data is given. All you have is the correlation of the security with the market. So if you have the correlation of first security with the market and the correlation of another security market, multiplying the two, can you give me the correlation between the two securities? Yes sir, this will give me the correlation between securities A and B. And can I say covariance between the security is correlation into SD into SD? Hello? Hello? Yes or no? This is, see, what you're saying, Miral, is directly formula, and what I'm telling you is the derivation simplified for you. Can I say covariance? Correlation is what? Covariance. What is the formula of correlation? Sir, it is covariance divided by SD. So can I say covariance is nothing but correlation into SD? So if I have the correlation between the two securities as the multiplication of do, can you multiply their SDs with them to directly find the covariances between them? So I will say zero point 0.6 multiplied by 0.95 multiplied by 20 multiplied by 18 give me 205.2. First multiplying the correlations of A with market, B with market to find their correlation, and then multiplying it with their SDs to find their covariance, which people in the class give me 205.2 as the covariance between the securities AB. That is the main point for which I'm solving this question for you. Similarly, you can try it for another secure BC, covariance between BC. So the two correlation will give you correlation among them. Multiplying it with their SD will give you the covariance between them. 0.95 into 0.75 into 18 multiplied by 12 give me 153.9 as the covariance between them. Perfect. So that way is you can find the covariance. Now question number 3rd, 4th and 5th are relatively easy. They are less effort taking. You can now proceed to solve rest of question number 28 at your own. The point that I wanted to teach through this has been taught, right? Just with a guidance, with a learning, with a hint. What would be the risk of the portfolio consisting all three stocks equally, which means if there is an equal weight, how much is the risk of my overall portfolio? My question to you people in the class is, if the risk of portfolio has been asked, there are two ways, Markowitz and Sharpe. Given the question so far, what do you feel what we will have to apply? Given the flow of the question, rhythm of the question, what do you people feel what do we have to apply in this? Come on, tell me. Please, please. What do you think we have to do in this? Sharpe or Markowitz? Sir, you said whenever the covariance or correlation between the securities are given, then you have to apply Markowitz. Otherwise, it's Sharpe. Do you agree in part B of the question? It has specifically asked me to find the correlation covariance between the securities. And isn't the second part a hint that in the third part you have to continue to follow Markowitz people because covariance between the securities is there? That is question number 28. All learnings compiled for you. Yes, rest of it is easy. You'll be able to do it really well. Yes, boss. 28th gets done. And this entire section where we had to learn everything about systematic, unsystematic has been done. So your two chapters with so many concepts being repetitively asked, people are done. Now is the next thing we're gonna take. Very important. In fact, important than all the concepts of portfolio management is index futures hedging and call put gross payout, net payout ratio. Right? Call put, gross and net payoff. Let's start with the basic thing. Index futures hedging. Pay attention to it because you just have to learn one formula and 9 questions of different variations. Here also one concept and 9 variations. Cool. This one is extremely easy. Can't believe that easy. First one we can make easy if we learn the things really properly. Ready are we all? Shall we please proceed to understand the derivatives which may get over in the next 30 minutes, I guess. 30 to 45 minutes it can get over. That's so easy. People, so we are starting with it. Index futures hedging, let me show that concept to you first of all. So a reminder to timestamping people, please go back by few seconds, right? And show that we are starting with derivatives and in that index futures hedging, right? Taking you all to the OutNotes, the concepts notes where we have these things with us. Let me show that to you. First of all, let me give you a sense of hedging, right? Because it is not directly the formulas that I want to teach you, but also the background of the concept so that any practical question it is, you're able to solve it. Guys, starting with the first one. Do you people understand that at 0 point if I stand in the spot market, if I have a risk, right? If I have a portfolio which is exposed to risk, if I have gold or any other security which is subject to risk, right? At 0 point, if I have any such risk in the spot market, then I can hedge that risk through the derivatives market. So at 0 point, I have a portfolio which I feel risky, which is why I start hedging. How do I start the hedging? I take the position in the derivative market. What position do you take? I will teach you. How many, what value of position do you take? I will teach you, right? You take the position in the derivative market. You take the position in the call option, put option, future, forward, anything. In this topic, we are particularly learning to take the position in index futures, which means the futures contract whose underlying asset is Nifty, Sensex, any other stock market, calling it to be the index, right? So today I take a position in the derivative market, right, which is taking a position in the index futures, right? On the day you feel that the hedging is over, suppose you are anyways planning to sell that portfolio after 6 months. Once the portfolio is sold, do you have any risk of uncertainty? No. So when you feel that the hedging is over, you will settle all your positions. You will sell the portfolio if not sold. You will settle your derivative market position. Any index futures position that you have taken, that you will settle here, right? How do you settle it? All that we will learn. But this is the basic of hedging that you have to first of all start to imagine. Correct? Cool. Now let me guide you. The position to be taken, the position to be taken, and the number of contracts or the value of future for which the position is taken. Sir, imagine that there is a portfolio, right? Suppose of 1 lakh rupee. I will call it to be the value of the portfolio. Imagine that it already has a beta. Portfolio has a beta. Sir, if you don't know beta, you can calculate the beta to be weighted average beta of individual securities. Beta of first security into weight of first security, beta of second security, weight of second security, and so on. Cool, sir. So if you have the value of the portfolio and if you have the beta of the portfolio, you can hedge such a portfolio using this simple formula. The formula tells you how many value of futures you should take. It says whatever is the value of the portfolio that you want to hedge multiplied by what is the target beta you want to achieve. Suppose the present beta is 1.5. Do you want to achieve the beta of 0? You want to achieve the beta of 0.5. What is the beta that you want to change to? Is it that you want to make it 2 or 0 or 0.5 from the present beta of 1.5? So present beta is the present beta of the portfolio. Cool. This formula gives you the value of futures you have to take. And if you talk about the number of contract, means every future contract is standardized. Each contract has some particular number of futures. So this is the value for which futures I have to take. Dividing it with the price of futures will give me the number of futures to be taken. Dividing it with the contract size will give me the number of contracts to be taken. So the overall formula become value of the portfolio into beta target minus the existing beta of the portfolio divided by price of the futures multiplied by multiplier. Tell you the number of contract for which you have to take the position. More important thing is the sign, the position to be taken long or short. The formula has been created by me such that if the answer to that is positive, the position you take is always long, and if the answer to that formula is negative, the position that you take is short. Boss, at this point just I need a validation from you people. Are you people aligned to me on this? There is a lot more to be spoken on this. There is a lot more to be spoken on this, but till this point if you are settled, I'll take this ahead. Come on. Requesting people in the class your responses, please. Till this point, if you are settled, I'll take it ahead. What do you all say? Yes, settled. Cool. Sir, now the points of learning. Sir, value of the portfolio, people in the class, you have to understand the net portfolio value. Which means imagine that I take 50,000 of long position in a particular share and 30,000 of short position in the particular share. The value of the portfolio is not 80,000, the value of the portfolio is just 20,000 positive. First point of learning. Second point of the learning, beta of the portfolio you can calculate two ways. Simply the weighted average. Beta of first security, weight of first security, beta of second security, weight of second security. If the weights are in percentage terms. Rather than weights, if you want to make use of the market values, then you can calculate the beta to be beta of first security into the market value of first security plus beta of second security into the market value of second security divided by market value of A, market value B, and so on. This is doing the same thing. It is also weighted average. The answer obviously same. Mathematically, these are two different formulas. My point to you all is, how many of you agree that beta can be, sir, positive and negative both? How many of you agree to the fact that beta can be both positive and negative? And then my another point to you is, how many of you agree that weights of the securities, everyone in the class, can also be positive and negative? Please tell me. The weights of the securities can also be positive and negative, meaning to say, if my position in any of the security is long, its weight or its market value will be positive, and if my position in any of the securities it's long, short, then its weight and its market value will be considered negative. Yes, that's how you people in the class do calculate the weighted average beta of the portfolio. That is the learning with such specification I want to give you with respect to every possible aspect. Cool. Then the next learning. Do you agree in my portfolio I can have the risk-free securities as well or cash as well? The betas of risk-free security or cash is considered zero, right? Perfect. The beta of market or index is considered one, people, right? Now the last thing, last two things. Beta of the portfolio can also be positive or negative, and target beta can also be positive, negative. Value of the portfolio can also be positive, negative. So what I want to tell you is, one should be able to do the math correctly. For example, value of the portfolio is 10,000 into target beta is 0 minus existing beta is minus 2.5. Do you agree it's like 10,000 multiplied by 0 minus minus 2.5 is plus 2.5. This minus and minus when gets multiplied it become plus. So 0 plus 2.5, 10,000 when gets multiplied become 2,50,000, say, or say 25,000, whatever. Do you get my point? The math you should be able to do correctly. And the last thing, price of the futures the examiner give you is great. I need the actual futures price on the day when I start hedging. When do I start hedging? This is the point where I start hedging. This is the price point where I take the position in derivative. This is the price point for which I need the price of the futures. At this point, if the actual futures price is not there, can we find the fair futures price using cost of carry model? The answer is yes. How many of you remember cost of carry model? Spot plus interest minus income plus storage cost, kind of cost of carry model. The answer is yes. And that is the complete summary of the concepts that you have learned with respect to this topic. Perfect. Last, the contract is to be rounded off, that you know. Now I'll take you to the practical question, and then you'll realize with this discussion now how easy the practical question become, right? Give me a minute. Let me go to the chapter of derivatives, and then I'll tell you how does the practical question look like. Perfect. Starting with the first basic question. Okay. Just give me a minute. Let me have water, then we start. Yes. So come on. Very interesting and basic question will give you an idea of application of the concepts, right? So let's proceed ahead. Boss, come on. Says that on 1st July, this is 1st July, right? This is 1st July. On 1st July, P has made the following investment of this company ML Limited. He has 1000 share of 700 each, which means at this point, what is the value of the portfolio? He has 1 lakh rupee. Cool. Sir, which has a beta of 1.25. He wants to hold the investment till September end. When till which point does he want to hold the investment? Till September end, which means what is the period of hedging? From 1st July to September end. Fine, with the expectation of huge dividend. On the day of investment, on this day, September Nifty futures are quoting at 17,500. Sir, the actual futures price, the price of the index future on that day is 17,500. Please try to interpret on the date of investment on this date. September Nifty futures, the futures which will expire on September, they are quoting at 17,500 with the lot size of 50. You are required to advise Mr. P how to hedge the market exposure using available data. Starting with the first thing. Do you have a portfolio to be hedged? Yes, sir. For the purpose of hedging, information regarding Nifty futures has been given. This is how you get to know that, okay, I am in the topic of index futures hedging. Do you realize the first point, people in the class? How do you get to know that you are in the topic of index futures hedging? This is how you get to know. Read the question carefully, identify the data given in the question. Fine, sir, cool. Sir, how do I advise? Simply, I have to find the number of contract. Sir, what is the value of the portfolio? 7 lakh rupees. Yes, sir. Into what is the target beta? If nothing is mentioned, they want to completely hedge it, target beta 0. Minus what is the present beta of the portfolio? It is 1.25 divided by what is the price of every future? 17,500. How much is the multiplier? 50. So when you solve it, it's 7 lakh into 1.25 divided by 17,500 divided by 50 give me one contract short. When the answer is -1, it implies that one contract you have to short. If it is 1.2, then also it is one contract short. If it is 1.8, then it become two contract short. Then it become two contract short. Cool. The rounding of confusion should not be there at all. If it is 1.5, then it is two contract short. Cool. Fine, sir. Now they are asking, suppose you have taken that position here. Calculate the profit or loss, Mr. 2, during the expiry of 21 of September 21 futures in the following situation. Suppose you have short one contract. Now in September, when the futures will expire, suppose the Nifty future rise by 10%. So now you have to use common sense. If Nifty future rise by 10%, you understand what you have. Do you agree? One contract, you have a short position, right? On that short position, people in the class, if the on that Nifty short position, if it rises by 10%, then what is the implication? Sir, please first of all understand the value of the portfolio or the value of futures you have. You have shorted one contract, right? Every contract has 50 futures, so multiplied by 50, and every future is of worth 17,500. So the total value of futures that I've short is 8,75,000. And when something of 875 when I've short, when that rises by 10%, multiplied by 10% give me 87,500 of loss. So loss on Nifty futures is 87,500. I've taken a short position and its value rises. It's a loss. Could you all, people in the class, again understand why is it a loss? When you take a short position, the price rises, it's loss. When you take a short position, the price falls, it is a gain. When you take a long position, the price rises, it is a gain. When you take a long position, price falls, it is a loss. Correct? So now my position is short, the price has increased, it is a loss to me 87,500. But in my portfolio, sir, I have one more thing. What is that? Sir, that is a stock. Sir, if the market rise by 10 and my portfolio original share has a beta of 1.25, do you agree it will increase by 12.5%? Market rise by 10, beta is 1.25. So portfolio will, the original share will rise by 12.5. I have share worth rupees 7 lakh. If that increase by 12.5, so 7 lakhs into 12.5% give me a gain, people in the class, of 87,500. 87,500 gain on the stock. So do you people agree? On the day of expiry, the gain which is there in the spot market is compensated by the loss of the futures, and net there is no gain, no loss, and I am completely hedged. That is what I wanted to tell people in the class. That is what I wanted to do by way of hedging, and that is what I've justified in part number A. A similar justification you will have to do part number B, where they say, what if this time share fall by 5? So share if fall by 5, there will be a loss. When you have the share, it falls, there is a loss. Share when fall by 5 and beta is 1.25, which means market will fall by 4%. And when you take a short position in the market and when that falls, you people in the class have gain, and net of both of them will be again 0. When you solve B part of this question, you will realize. Please respond to me. Could I successfully do question number 19 for you people? Come on. Could I successfully do question number 19 for you people, which taught you the initial formula application, and second, how has hedging happened, justifying that hedging on the day of expiry. The two things you could learn. Next is 21st question, which will make you learn another thing. Okay. The another thing you have to learn in question number 21 is here. Ready are we all? Guys, is the rhythm of learning, is the flow of learning the concept and solving the question, are you people aligned to it? Yes, please tell me. Ready? So, Ram buys 10,000 share of X Limited at a price of 22, having beta of 1.5. Sell 5,000 share of A Limited at a price of 40, having a beta of 2. So many information given. Sir, in share of X, he has a long position. 10,000 quantity, 22 price, 2,22,000 total long investment. Sells means short position, 5,000 price, 5,000 quantity, 40 rupee of price, 2 lakh rupees negative position. Fine, sir. Individual betas of 2 and 1.5 have been given. He obtains a complete hedge. First of all, how much is my portfolio value to be hedged? 220 positive, 2 lakh negative, give me just 20,000 is the net portfolio value which requires hedging, people. Fine. So when I do that 20,000 rupee hedging, right, he obtains a complete hedge by Nifty futures, right? So he obtains a hedge. Question is, how many contract will he have to long or short to do the hedging, right? Let me explain. Some students say, sir, why are you overcomplicating it here, right? Why are you overcomplicating that? If the answer is positive, then it's a long position, then the answer is negative, then it's the short position. Because some students say they have simply learned it. If the portfolio is long, then hedging requires short. I mean, futures position to be taken is short. If the portfolio is short, the futures position to be taken is long. That is what a lot of you have learned. Let me crack. Let me break that myth, in fact. Here, what is the portfolio position? Sir, positive. Long net portfolio position of 20,000. So according to your logic, in futures, I should take a short position, right? But for the purpose of hedging, you will realize I am going to take a long position only. Sir, how the hell is this possible? That's something we cannot discuss in this video, but that I can tell you that what we are doing is absolutely correct. Let's first find the beta of the portfolio. Sir, weighted average beta of the portfolio is what? Sir, why do you find it? Unless you have the beta of the portfolio, you cannot apply the formula of number of contract. So beta of first security into the market value of first security, 1.5 into 220 plus beta of second security into the market value of second security, which is negative 2 lakhs, divided by market value of first plus negative 2 lakhs, which is the market value of second. Give me the weighted average beta to be negative 3.5. Fine, sir. Number of contract is value of portfolio into beta target divided by minus beta portfolio divided by price of the futures and multiplier. So 20,000 is the net portfolio value multiplied by 0 minus negative 3.5 divided by overall one contract is of 1,000 rupee. Overall one contract is of 1,000. It's dollar or rupee. Given to me an overall answer to this equation, to this formula, is 70. Since my answer is positive, it means that in order to hedge, I will have to take a long position in 70 Nifty futures contract. First is the number of contract clear. Second is the position long clear despite portfolio being positive. Yes. Now I'll say the most important thing. Let's first solve something, then I'll say the most important thing. They say he closes out the position on the next day. When next day, everything he decides to close. What three things he have? X limited, A limited, and Nifty futures. These are the three things he's having. So he closes out his position on the next day when the price of share X drop by 2%, share A appreciate by 3, and the future drop by 1.5. When all these drop and rise happens, what is the gain loss on individual position? Let's understand. On 220, if that drops by 2%, what is the gain loss? 220 into 2% give me 4400 of loss. Position is long, it dropped, loss. Sir, on 2 lakhs, which is a short position, if that rises by 3%, so something I've short, if that rises by 3%, so 6,000, 3% is 6,000 rupee, again loss. And the last is index futures position. I have 70 contracts of 1000 each. So my position is 70,000. When that drops by 1.5, my position is long. When that drops by 1.5, it is 70,000 into 1.5 give me 1050 of loss again. So the total loss given to me is this plus this is 11,450 people in the class. 21 had 2-3 point of learning. Learning first the value of the portfolio. Second, learning doing this mathematical thing of finding 70 long contracts. And third, despite hedging using Nifty futures, why is there a loss? Is the another point of learning. Has got no exam relevance, but for your confidence, I need to share that with you. Please think on that. Give me a response. Why do we have a loss despite hedging? Come on. Yes, everyone. So what it says that could you figure out the logic at your own? The logic, everyone, is really simple. Not that we have done the hedging incorrectly, but the fact that the things did not move according to the plan. Simple point, when Nifty dropped by 1.5%, what is the beta of second security to? Which means second security should drop by 3%, right? When market drop by 1.5, security beta is 2, it should drop by 3. But it has rather appreciated by 3. Do you analyze that why did hedging not work? Because the things did not move according to their beta is the problem why we had to incur a loss. If the things could have moved according to the beta, then there was no loss. And that is how question number 21 is the question solved in the class. Perfect. Could I successfully explain what are the things that you have to learn? Then is another brilliant question. Question number 25 we are going to do in the class right now. So many varieties to do in this class. Question number 25. Again, I'll take you to my English regular batch notes where we have done this question on the timeline and so beautifully done that it will clear a lot more concepts. Where is that question? Wow, here it is. Perfect. 25th question. Come on, everyone in the class. Shall we? Yes. People. What it says that BSE is 5,000, which means the Bombay Stock Exchange, whose index is Sensex. The value of Sensex today is 5,000. Cool, sir. The value of Sensex today is 5,000. Cool. The value of the portfolio that I have right now is 10 lakhs 10,000. The risk-free rate of return in the market is 9% per annum. The dividend yield in the index is 6% per annum, right? The portfolio that I'm having has a beta of 1.5. Fine, sir. We assume that future contract on BSE index. What is the index of BSE? Sensex. So on the index, there is a future contract. Do you people understand that we are there in this category of hedging through future contract? That is how you get to know, right? So there is a future contract on BSE index with 4-month maturity is used to hedge the value of the portfolio over the next 3 months. This is the point of learning in this question. Please understand what's happening. At 0 point I stand. I have a portfolio of how much? Sir, 10 lakhs 10,000. This portfolio I want to hedge, for which I chose index future. Using this index futures, I want to hedge my portfolio for 3 months. But what is the expiry of the contract? For 4 months. Cool. So on the day when you start the hedging, you take the position, but on the day when the hedging gets over, because hedging is there only for 3 months, this is when it will get over, and that is when you will have to settle your position. This brings me to explain to you point that, do you people agree? In this case, we are going to settle a future contract before its expiry. How is this question different from any other question out there? We are going to settle this futures contract before expiry. Do you get me on this? Everyone requesting your responses. Hello? Yes, sir. Fine. Cool. Sir, so I want to use an index future with 4-month maturity to hedge the portfolio over the 3 months. One future contract is 50 times the delivery of the index. Based on the above information, calculate. Sir, for the purpose of hedging, do you need? I need the value of the portfolio. Fine, sir. Given 10 lakhs 10,000. I need beta target in the absence of information assumed 0. Beta of the portfolio given to me as 1.5 divided by price of the future into multiplier. Multiplier given to me as 50. Has the price of the futures been given? No. But can it be calculated using cost of carry model? The answer is yes. So let's calculate the price of futures using cost of carry model. How many of you remember, sir, to the spot price, which is there 5,000. If you add interest and deduct a dividend, you get the fair futures price. Interest is 9% per annum, dividend is given as yield. So first of all, you have to realize that you have to apply the net formula of 9 minus 6%. Also, since the compounding frequency is not there, which means question is silent regarding compounding frequency, so we will apply the logic of simple interest, which is r minus y, the net interest into n, which is 4 by 12. Not e raised to rt formula, not any discrete compounding formula, simple formula of r minus y into n. What is n is another point of learning. N is not 3 by 12. Do you agree? The n in this formula is time till expiry. When I stand here, my time till expiry, people in the class, is 4 months. So n to be used in the formula is 4 by 12. So 1 plus r minus y into n, where n will be 4 by 12, into the spot price at 0 point, give me the price of index futures to be 5050. If one future is 5050, entire contract of 50 futures will be 5050 into 50, which is 2,52,500. First point of learning clear? That's sir, you have to use 4 months, not 3. Sir, now they are saying price of the future contract you identified. What is the gain on the short futures position? Sir, why will I take short futures position? In order to hedge, maybe? I think so. So there is some position in the futures you take, the index futures, right? So what is the gain on that futures position if the index turn out to be 4500 in 3 month time? Sir, at the end of 3 months, if the index, are they talking about index future? No, the index itself, the spot market price, people, if it turns out to be 4500, what is the gain on this futures position? You have to understand the concept really well. Application is really great here. Sir, at 0 point, the price of the future is 5050. They are saying you take a short position and they are saying there is a gain, but let me validate it first. Sir, how do I decide the position to be taken in the index future? Sir, using that formula. So let's apply that formula. I will say value of the portfolio into beta target minus beta of the portfolio divided by price of the futures and multiplier. So if I solve this, I get the answer to be -6. It implies that I have to take short position on 6 contracts. So my position is short, that is for sure. So on such 6 contracts that on which you've taken a short position, right? How much is the gain? But sir, how do you know there is a gain? Let's check that as well. So I know that what I've done today is the 6 contract short position at a price of 5050. How much become then the price? 4500 become the price. Can you calculate the gain loss? Yes, sir. When I sell something, I have an inflow. When I after 3 months, when I square it off, which means now I will have to buy it, there will be an outflow. An inflow minus outflow is the simple equation of gain loss. So 5500 minus 4500, is it the gain? The answer is no. The answer is clear big no, because when you compute gain loss, the futures price is to be compared with futures price. But sir, after 3 months, the spot price and the futures price will be same due to the concept of convergence that you taught in the class. No sir, convergence applies on the expiry date. On the expiry date, if the futures price is 4500, then I agree. If this on the date of expiry, if the spot price is 4500, then I agree that that will be the futures price. But before expiry, the spot price and futures price are not same. On the spot price, you will have to again apply cost of carry model to find the futures price, and then futures price can be compared with futures price. Boss, this is a very detailed question teaching you a lot of things. Are you all able to connect to me dot to dot on this question so far? Please tell me. Your validation motivates me to explain it much better in more detail, every possible thing that this question has. Please. So let's calculate the futures price again. And you know what is another point of learning here? To calculate the futures price of this day, you will have to take the spot price of this day, not the original spot price of 5000, but rather the spot price of 4500, the price of index, the spot itself that prevail on that day. So I will now say 4500 is the price into 1 plus r minus y, which is 0.09 minus 0.06 into t. Do you agree? Time now left is 1 divided by 12. Just 1 month is left to expiry. So accordingly, the futures price on that day become 4511.25. 4511.25. So now I can compare futures price with futures price and calculate the gain loss. Sir, if I take a short position at this price, I have inflow. To square it off after 3 months, I will have to buy it, giving me a feeling of outflow. And inflow minus outflow is the per future gain loss. Multiplied by every future has 50 such contract. 50 such, every contract has 50 such futures, and I have taken position on the 6th contract. So 5050 minus 4500 into 50 into 6 give me 1,61,625 as the amount of gain, because inflow is higher than outflow, right? And that's how I realized that, okay, they were saying that there is a gain is correct, the position is to be taken on the future, short is what is correct, and ultimately I have calculated the gain loss when a future is settled before expiry. Please, 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 please. It was really effortful to explain this question right from the scratch till this point, which in which I have told you every possible point of clarity on this question. Miril, I really happy that you learned it in a great way. Everyone else, could I successfully do it? Recorded people, please do share your comments to me on this whenever you're watching this. Why do I specifically say this is that, as I said, the timing of taking this live is not perfect, but not everything that I can give you is at a perfect time. At least the video I can make perfect, if not at a perfect time, but you will be able to watch it at a perfect time, that I can tell you. Yes. So do share with me your responses when you watch this up. Yes, boss. So brilliant question. Question number 25 had some points of learning that we have discussed, right? Next question that we're gonna do is question number 27. The last question for this concept, people in the class, pay attention. The last question for this concept. Post which we will do one concept and one or two easy question, and your entire derivative will be done. Yes, so give me a minute. Yes, boss. 27th. We are not going to do this concept entirely. I will just give you an idea of it. Let me go back and figure out what is something I can teach you more on this. 22nd is a reverse calculation question, similar to that RAM question where we were calculating these gains and losses, where I was explaining you that hedging is not happening. Hedging is not happening. Cool. 22nd question is a similar reverse nature calculation question with some ambiguity. You should cover it at your own. Okay. Reverse calculation with ambiguity. Cover that at your own. Question number 20 is an old question from exam. The only point of learning is that this time your portfolio has share as well as the cash. Okay. Uh, Okay, let me not teach you what I'm trying to teach you, because anyways I'm not done the solution which requires that learning. So ignoring the learnings of 20, everything else has been conveyed to you. Cool. Now I'll give you an idea of what is to be done in this question number 27 that we do. Okay. Not reading the question entirely, just trying to explain directly the summary of it. Yes, what it says. It says that there are three shares, X, Y, and Z, where the number of shares is 6 lakhs, 8 lakhs, and 4 lakhs. Cool. Price per share is 1,000, 1,500, and 500, and their beta is this. Cool. They want the CEO of the company feels that the risk is high as compared to market. So we say, yes, it is high. Market beta is 1, and your betas are 1.5, 1.3, and 1.7. So average will also be more only. They want to reduce the systematic risk, which is beta to 0.95. So beta target is 0.95. That's also clear, right? You have to manage this beta, adjust this beta from whatever is the present weighted average beta to 0.95, for which there are two alternatives. Dispose a part of the portfolio to acquire risk-free security and take appropriate action in Nifty futures currently trading at 8250, where multiplier is 210. In this question, let me tell you, there are, in concepts we know that there are two terms to adjust the beta. One is risk-free security, another is index future. The concept of risk-free security is really simple. When you have this entire portfolio which you feel is risky, if you want to reduce the risk, so point is really simple. This is the portfolio which you feel is very risky right now. So a part of this portfolio, sell the risky security and buy the risk-free security. From this entire portfolio, some part of the security you sell and buy the risk-free security for the same amount, so that the overall risk of the portfolio of risk-free and risky, overall risk of the portfolio become lesser, because the weighted average risk will become now lower. Yes, that is people in the class. That is people in the class what you have to do. Perfect. Do you agree to me on this? Perfect, sir. So what do you have to do, sir? Dispose of a part of the existing portfolio to acquire risk-free securities. They are saying sell some securities and buy risk-free security to reduce the beta. Second, use Nifty future. First and second part are extremely easy. I'm not even reading that. The conclusion of the first and second part is that your present beta is 1.4, which is the weighted average beta. How do you calculate? If you have the number of share, if you have the market price, do you have the market value? Yes. Can you convert the market value to percentage weightages? For example, first, second, and third share has respective market value totaling up to 20,000, right? 20,000 if is equal to 100%, then 6,000 is 30%, 12,000 is 60%. So 12 divided by 20 is 60%, 6 divided by 20 is 30%, and 2 divided by 20 is 10%. So once you have the weights in percentage and you have the beta, the weighted average beta turns out to be 1.4. That is not something I wanted to teach. That is quite obvious. 1.4 is the present beta. Main thing that I want to teach here is the value of risk-free security to be acquired, right? Since it is asked sometimes in this exam, I want to also teach you one particular scenario of adjusting beta through risk-free security. Please pay attention. you have to find the weighted average. Meaning to say, right? I'm not trying to teach you the concept directly, trying to teach you the concept through question. So I will say, people in the class, please pay attention. Now I have two securities in my portfolio, risk-free and risky. Both of these securities have some betas and have their weights. Yes. So for example, I know beta of the risky asset I calculated is 1.4. Beta of risky asset is 1.4 into the weight of risky asset plus beta of risk-free asset has 0. It has 0 risk into the weight of risk-free asset. I know this will give me the weighted average beta. And I know the weighted average beta I want is 0.95 because that is my target beta. So can I reverse calculate the weight that should be there in my portfolio of risky asset and risk-free asset? Do you understand? The weighted average beta, if I know, can I reverse calculate the weight that I should be there in my portfolio of the two securities, existing risky and the risk-free, to get this beta of 0.95? When I solve this equation, I get the beta of risky asset to be 67.86 and the beta of risk-free asset is to be 32.14. Now I'll speak a line. The class student will be able to relate to it. Others in the class try to learn from me. Now, how do I find from these percentages, how do I find the amount of investment? Which is extremely simple. What it says? It says that start with the amount and percentage of what is intact. What I said is start with the amount and percentage of what is intact. Meaning to say, in this question, do you agree my overall value of the portfolio is intact? It is fixed. Correct. For example, my portfolio is 20,000 lakhs. This 20,000 lakhs rupee of portfolio will remain intact. Some part of it is risky and some part of it is risk free, but the total remain intact. Previously it was 20. Even if I sell something and buy something, it will continue to remain 20. So the total portfolio value remain intact. What is the percentage of total? 100. So now I will say common sense simply is, if 20,000 of my portfolio is 100% and I want 32.14% of it to be risk free, what value is risk free? 20,000 into this percent give me 6428 lakhs is the risk free security that I should have in my portfolio. This is the value for which I should sell my risky assets and buy the risk-free assets. Could you understand what this question, people in the class, for part number C was? Adding another point of learning, advise the number of security to be disposed of. Look at the logic, look at the beauty. The number of security to be disposed of. You are saying sell risky asset. Exactly which asset to sell? Sir, all three of them. In what proportion? In original proportion of 30, 60, 10. So when you say that I have to sell 6, 4, 2, 8, I'll have to sell them in 30, 60 and 10% proportion, which means 6428 multiplied by 30% is 1928, multiplied by 60 is 3856, and then 642. These are the amounts for which share of XYZ are to be sold, where price per share is 1505, which means the number of share to be sold is this divided by this. Amount to be sold is 1928 divided by 1000, give me 1.9284 lakh shares to be sold at this price, and accordingly this is the number of shares of each of the securities to be sold. Could I also explain to you all part number D of this? Please tell me. Part number D of this, could I explain the concept of people selling, acquiring risk-free security, and to acquire those securities, if you have to sell a portfolio, how do you sell it? In the original proportion you have to sell it. Requesting your responses. So from this question 27, my main point of learning was still point number D. Point number E and F you must do at your own. Must do at your own. But could I explain you till point number D? With that, let me tell you, we have really done a lot of things, right? And rest of the other questions that you see are homework, right? As in category and category questions that you must do at your own. Primarily, the learnings of this entire heading of index futures hedging has reached to you through different questions that you've solved in the class. Yes, the variety has been covered. Last topic from derivatives is call put gross and net payoff calculation. Asked 9 times out of 17 attempts, right, which is very, very, very frequent. Cool. Is what we will start now. Let me tell you, some of you might think, sir, this is not important, asked only 4 times out of, say, or anything. Suppose mutual fund return calculation is asked only 4 times out of 17. But you have to not think it like this. You have to think it like that, sir, these 27 topics, in these 27 topics, in the attempt of May 18, there were 11 questions. In the attempt of Jan 26, there were 9 questions. In the attempt of September 25, there were 12 questions. Do you get my point? In the attempt of May 25, there were 10 questions in the exam, covering 63, 70, 50, 86, 58 such marks. So in these 26 topics are such topics which were asked only 4 times. For example, say post-merger EPS, only once, second, third, fourth, but it's all fine. You at least cover these topics to gain this level of confidence in the exam. This analysis, people, is literally like never before. It's literally like never before. You must watch my analysis video if you've not watched. In that video itself, I will teach you the concept of valuated risk. I'll teach you the concept of standard deviation. I'll teach you the concept of trend analysis in the video itself, because I had to apply these concepts of statistics, or I can say finance, to even my analysis. Yes. So great. Now it's a reminder to those people who do time stamping. Please do it for this particular topic that we're starting now, everyone. Taking you all to the next, another brilliant and extremely easy, was so easy. The concept of call put, gross and net payoff. Yes. Just give me a second. Let me have water. Then I proceed ahead. Give me a minute. The simple table that you see on the screen, this table is all you should be able to understand to solve any possible question of call or put having long or short position, whether you have to calculate gross payoff or net payoff. Yes, let's start with it, people. Call is an option to buy, put is an option to sell, correct? If this is a, let me have a piece of paper. If this is a call option contract, right? When I sell this contract to you, you have a long position. When I sell this contract, I have a short position. So you have the long position, which means you bought the option. I sold the contract, which means I have a short position, right? Sir, what option do you have? When you have a long position, you bought the contract, you bought the option, but what option do you have? Sir, it is an option to buy the underlying asset. Suppose that underlying asset is calculator. So when I sell this contract to you, what do you get? You get an option to buy this calculator at a price decided today, calling it to be the exercise price. So Calci become the underlying asset, right? And you have an option to buy Calci after, say, 3 months at a price of rupees 100. So exercise price will become 100. What is my situation? I have given you the option that if you want, you can buy from me. You will buy, but this option has been given by me. That is my situation, correct? Now let's apply common sense. You have an option to buy the calculator at rupees 100. Price of that Calci in the market right now is 130. Right now, as in after 3 months. When do you decide? Sir, it is on the day of expiry. You will have to take a decision whether I want to exercise the contract or I want it to get lapsed. So on that day, you have to compare the spot price of that day with the exercise price. In our case, the spot price on the day of expiry, ST of the calculator become 131 and the exercise price is 100. Please apply your common sense and tell me. This calculator whose price in the market is 130, you have an option to, your position is long, you have an option to buy the same calculator at a price of 100 under the contract. Will you buy? Answer is, will you exercise? It is yes. And the other scenario, if the price in the market of the calculator turn out to be 60 in a bearish scenario, if the price of the calculator turn out to be 60, will you, in that case, requesting your responses, exercise the contract and buy at 100? If the market rate is 60, the answer is no, contract will get lapsed. Simple, logical, fine. Sir, similarly, what is put? Put, people is in the class, is an option to sell. So this is a contract. I sell this contract to you. So your position is long, my position is short. But what do you have in the long position? What do you have? Sir, you have an option to sell this underlying asset, this calci, to me. Contract you bought, this is the contract that you bought. What does that contract give you? That contract gives you an option to sell the underlying asset, this calci, to me at a price of rupee 100. Please tell me, price of that calci on the day of expiry become 130. Will you exercise the contract and sell it to me at rupee 100 under the contract? The answer is no, it will get lapsed. However, if the price of that calci in the market becomes 60, will you exercise the contract and sell that calci to me at rupee 100? The answer is yes, you will exercise. First of all, are you people clear with the positions to be taken of long short in call put, and also understanding when do you exercise and when do you not exercise? No need to remember any formula. It is no formula. It is all common sense. I don't want you to remember this is more than this or this is less than this. Just start to, you should be able to think in the moment and figure out what is the, when it should be exercised, when should it not be exercised. Simple, yes or no, quick. Now you will learn about gross and net payoff. Gross and net payoff. For which you'll have to first of all learn the first thing. Sir, what do you have to learn the first thing? About the premium. When you take a long position, whether it is call or put, doesn't matter. When I sell this contract to you, sir, 1 second. When I sell this contract to you, your position, everyone in the class is what? Long. You got a choice, but to be able to get that choice, you must have paid a premium to me. So in conclusion, who pays the premium? Long. Whether it is call or a put, doesn't matter. If your position is long, you have to pay the premium to me. As a short, whether call or put, I will always receive the premium. But once you pay the premium, you get the option, and on the day of expiry, you have a decision whether you want to exercise it or not. And if it is beneficial for you, you will exercise. And if you exercise, what do you get? Let me explain to you. That is called as gross payoff. Imagine that price of the calci in the market is 130, but you have an option to buy it. You have an option long. You have an option to buy it for 100. Will you exercise? Yes. How much of gain do you feel for yourself? Sir, 30 rupee. Something of 130 can be bought by you at rupee 100, 30 rupee of gain. So let's do a net settlement. On the day of expiry, I will bring 30 rupee of cash and give it to you. To you, it is a 30 rupee of gain. To me, it is 30 rupee of loss. Life is sorted. I give you 30 rupee. So that is a net settlement, gain loss settlement we have done on the day of expiry. Fine, sir. But if I want to calculate, this is gross payoff, 30 is gross payoff, called as net settlement. Fine. Sir, but if I have to find the overall net profit, overall net payoff on this entire transaction, can I say to get this option, you must have paid a premium at 0.2 me of rupee 10. Sir, you are long. To get this option, you must have paid premium. So on the day of expiry, you received 30 rupee of gross payoff. But at 0 point, you paid to me 10 rupee of premium. So how much is the net payoff or the net profit you have overall of both the points? It is just rupee 20. Similarly, for me, I paid you 30 rupee on the day of expiry. But at 0 point, I received 10 rupee of premium. My net loss, people in the class, is 20 rupee considering both the points, initial point and the expiry point. Requesting your response, is this box clear to you? The gross and net payoffs for long and short, is it clear to you? Please. No other question beyond this chart can be there. It covers bullish, bearish, it covers call put, it covers long short, it covers everything. Sir, now let's cover a bearish scenario. Price in the market is 60. Will you buy at 100? The answer is no, it will get lapsed. So as a long, will you come to me? No. Will there be a gross payoff? No, which means gross payoff is 0. But at 0 point, did you pay to me a premium? Yes, minus 10 is your loss, plus 10 is my profit because I was short, I received the premium. You were long, you paid the premium. Sorted. Sir, what about put? Put is an option to sell at 100 when the market price is 130. Will you sell at 100? No. Gross payoff 0. You don't come to me. But premium you paid. You paid me 10. I received 10. My profit, your loss 10. Sir, price in the market is 60. Will you sell at 100? Yes. How much gain do you feel for yourself? I need a response on this. How much gain, people in the class, do you feel for yourself? Come on, everyone in the class. What do you all say? How much of gain do you feel for yourself? Do you feel a gain of rupee 40 for yourself because something which is of 60 can be sold by you in the market for rupee 100? Answer is yes. So 40 rupees the gross payoff. You are long, you came to me to exercise, I'm ready to pay you 40 rupee of cash from my side, from my pocket to you. Take this 40 rupee of cash on the day of expiry in the form of net settlement. So that 40 is called as gross payoff. Cool. But overall, for both the points, if I want to find the net profit or net payoff, it is like 40 rupees I paid to you on expiry, but you paid me 10 rupee of premium and initiation, so my net loss is 30. My net your net profit is 30, my net loss is 30. That simple is the calculation of net and gross payoff for all the positions. Perfect. For which, let's proceed to solve the practical question. The first such practical question we will solve is the question from Jan 26 exam paper. Question number 34. Very repetitively asked categories. Please look at the number of times such questions everyone has been asked by the examiner. So repetitive in nature, right? Look at the number of times. Yes. So I'll start with this particular question asked in Jan 26 exam. I will explain that to you from my another file called as New Question by ICAI. So I've given this file to you, New Question by ICAI file, okay, which has compilation of all new questions, where I will take this up. Come on. Such an extremely easy question to deal in the exam. Come on, people. What it says. What does it say? Says that. Sir, Miss Priya initiated the following option strategy on Omega Industry Limited security. What is the strategy she did? She bought, which means listen to the words, boss. This is the level of clarity you should have. When someone says I bought, does it give you a clear understanding that my position is long? Which means I will decide, I will choose whether to exercise or not. It means I will receive the gross payoff. It means I will pay the premium. Yes. So I bought one European call option. So I have an option to buy the underlying asset, which means this company's share, sir, at a price of 620, which is my strike price. After 3 months, for which I've paid a premium of 42, I have paid a premium. My position is long. I also bought, which means again I've bought, which means I'll pay the premium. But this time what I've bought? A put option to sell the share of Omega Industry at a price of 480 after 3 months. When that is European, it means that it can be exercised only on expiry. Fine, sir. Cool, sir. Aligned, sir. Great. You know what? Sir, anyways, additional information, people in the class is 550 per share. Yes. Lot size, everyone, is 150 shares per contract and Priya holds the position until expiry. What is the point? You have to calculate the net profit in the following scenario at expiration. Do you agree on the day of expiration, the net profit or loss, the net payoff does not require anything to do with the spot price at 0 point. Today, whatever is the spot price, I need to compare exercise price with the ST. Exercise price in case of call is 620, means option to buy at 620. For put it is 480, which is option to sell at 480. And the price in the market in the first case, suppose on the day of expiry, the spot price become 550. Let's take the decision one by one. Sir, for call, option to buy at 620. The price in the market is 550. Will you exercise the option? Will you buy at 620 from the market if the price is 550? The answer is no, lapse. Will there be a gross payoff? Zero. If the price in the market is 380, will you buy at 620? The answer is no, lapse, gross payoff zero. If the price in the market is 680, you have an option to buy at 620. Will you buy? Exercise yes. Gross payoff you will receive is the amount of gain, which is 60 rupee, which is 680 minus 620, 60 rupee. I have to find the net payoff. Let's figure out the amount of premium to be paid, right? So net payoff is gross payoff minus premium. 0 gross payoff. Amount of premium paid is 42 multiplied by the multiplier of 150. So 42 into 150 is 6300 loss. 42 into 150 is 6300 loss. But in this case, 60 was the gross payoff received. 42 is the premium paid. So 60 minus 42 into 150 gives me 2700 of gain. So this is the situation of gain loss in case of call option in the three different scenarios. Now, for the put option, what it is, let's try to understand. Option to sell at 480, right? Whose price in the market is 550. Will you sell at 480? No lapse, gross payoff 0. Price in the market is 380. Will you sell at 480? Obviously, yes, I will exercise and the gross payoff is 100. Price in the market, people in the class is 680. Will you sell at 480? No, the option will get lapsed, gross payoff 0. Now let's think about the premium. Is the premium paid? Do you understand? I was long, I had an option. If I exercise, I will receive the payoff, right? So wherever there is a payoff, it is a received. Wherever there is a payoff, it is received. Since my position is long in both call and put, wherever there is a premium, I will pay, right? So I will pay a premium, people in the class, of rupees 8 per share. So 8 into 150 give me 1200 of loss. Here gain was 100 rupee per share, right? On which I paid a premium of 8. Gross payoff was 100 minus premium 8 give me 92 into 150 is 13,800 of gain. In third case, again there is a premium loss of 1200. Net 6-3 loss, 1-2 loss give me 7500 of loss. If the price on the market become this, overall loss, people, is overall gain is 7500. In the price becomes 680, overall gain, everyone in the class, is 1500. That is his net profit or loss in the following scenario on expiration 1, 2 and 3. Could I, people in the class, explain that, requesting your responses? Please answer that to me. Could I? Everyone, could I? What do you all say? Yes or no? Yes. Perfect, people. Got it? How much out of 10? 10 on 10. Now let me explain to you a very beautiful point asked by the examiner that determine the upper and lower break-even point. Sir, do you know wherever the price will rise, bullish case, the call will get exercised. So when the price increased to 680, call got exercised, right? When the prices were falling, call get lapsed. Similarly, when the prices are falling, right, which is 380, the put got exercised, which means in the bearish case, put got exercised. In the other two scenario, put got lapsed. What they are asking is a very interesting thing. Says determine the upper and lower break-even point. Meaning to say, break-even point is a situation where you don't have any gain, any loss. Yes, Meryl, you say 100 out of 10. That's great. Sir, break-even point is a point where you don't have any gain, any loss. Look at the beauty of explanation now. When I buy one call and when I buy one put, how much is the premium I pay on both of them? Total 42 plus 8 is equal to 50. Do you agree? When the price will rise, call will get exercised and put will get lapsed. I will be able to earn my gross payoff only from call. When the price falls, put will get exercised and call will get lapsed, right? And I will be able to earn my gross payoff only from put. Yes, sir. And how much gross payoff would you want to earn in the two scenarios? Sir, 50 rupee of gross payoff because I have paid initially a premium of 50. If I'm able to recover 50, then my break-even is achieved. Then there is no gain, no loss situation. Do you understand what I'm trying to tell you, people in the class? Hello? Do you understand? Price in the, if the exercise price is 620, I have an option to buy the underlying asset at 620. Think from the perspective of call. What should the price in the market be? What should the price in the market be such that your gross payoff is 50? Because premium paid is also 50 and the net payoff will become 0. You will achieve break even. What do you think the price in the market of the share should be on the day of expiry, third month end? Common sense. Do you agree if the share price in the market is 670, which is 620 plus 50? 620. So the price is 670. I have an option to buy at 620. The difference of 50 is my gross payoff. 50 is the premium I paid. Net payoff becomes 0. So the upper limit of break-even price is 620 plus 50 is 670. Similarly, when the price will fall, I know that I'll earn through put. I want to earn 50 rupee of gross payoff so that net payoff can be adjusted to make it 0. Please tell me. I have an option to sell the underlying asset at 480. What should the downside price in the market be for me to earn 50 rupee of gross payoff from the put? What should the downside price be? I have an option to sell at 480. Do you agree if the price in the market is 430? Then I'll be able to earn 50 rupee of gross payoff. So 480 minus 50 is 430 is the price. That's the upper and lower break-even prices will be. That's simply, people in the class, the common sense behind question number 12 that you had to learn. Question number 34. Such a simple thing. Now I'll take you to question number 35, right? A question quite unique, beyond expectation. Won't get into much detail of it, but I'll just give you a sense of it, right? Question number 35th. Perfect, people. This also I would want to explain it from what? Have I missed that question in this new file or what? I cannot see it. No, it's here. It's here. It's here. I thought that question has been missed. Cool. Question 35, which is here. This particular question is we have to, on a lighter note, learn, right? So let's be super ultra fast. Let's not get much into it. Post this question, you have to tell me, do you feel like taking a 5-minute break or something? Yes, so let's now proceed ahead. Sir, you have to, in this question, think first of all, learn about the settlement of futures contract. Do you agree how are futures settled? Very simple. Sir, when I buy a future, there is an outflow. When I sell it, there is an inflow. An inflow minus outflow is the gain loss. Suppose this time you sell first. Suppose I take a position and I sell a future. So there is an inflow. Later on, I'll have to buy it back. There is an outflow. Again, inflow minus outflow is the gain loss. That simple is the situation. Only thing additionally as a point of learning here I have is the concept of brokerage. What it says. It says that a speculator purchases BFL Limited May futures contract size 125 at 7750. When you purchase, there is a long position, which means at this price you have to feel an outflow and choose to write BFL 7790 May call option with a premium of 30. You have to please realize the word write means choose to short. Writing a call option means selling a call option. So you choose to write means choose to sell a call option of the same company at a price of exercise price of 7750, and when you sell something you receive a premium of 30. On May 18, the spot price rise and the future and the call premium rises. Future price becomes 7780. Call premium rises to 36. Brokerage on the transaction is 0.02% of the transaction value of futures. And for call, I will tell you. First, profit or loss on the futures I have to find out. Please, you have to first learn to calculate the brokerage, right? Do you agree when I buy future or when I sell future? Whatever I do, I have to pay brokerage. Sir, of what value? When I buy future, it is 7750 into 125 into 0.02% is the brokerage I pay. So my buying price increases, right? I sell future at 7780 into 125 size into 0.02% is the brokerage I pay. So common sense. On future brokerage 7750 into 125 into this. On future the brokerage is 7780 into 125 into 0.02. I have the amount of brokerage. What is the net of transaction cost gain loss? When I sell future, it gives to me a feeling of inflow. When I buy it, it gives to me a feeling of outflow. So every future I have 30 rupee of gain multiplied by the quantity of 125. Give me, sir, 30 multiplied by 125 give me 3750 of gain on the futures I have, right? From which if I deduct the two brokerage that I paid on the futures while buying and while selling, the net profit comes to 3361.75 is the first part, calculating the profit or loss on futures. Is the first and the basic thing everyone in the class done? So I would appreciate, thank you so much you people. With these small efforts motivate me. Despite the live viewers being so less, I know the video is of use to a lot of students, which is why the live has become 100, right? And I want, if that can reach to 500, it will motivate me to do more such things for you guys for this attempt and in the upcoming attempts. Yes, yes. And I don't want you to ever watch it in the upcoming attempt, because I really want whenever you are watching it, you just crack it in that particular attempt. You just pass in that particular attempt. Yes. So please tell me, requesting your responses, are we settled? Everyone? Yes or no? Settled are we on this? Sir, now let's learn about the options. First of all, you have to learn about the option trading. For this particular question, you'd have to have a mindset of real world. You don't have to have a mindset of what happens in the theoretical world. You don't have to have a mindset of cross payoff, net payoff. You have to have the mindset of the real world. Meaning to say, when you sell an option, what you receive is premium. So 30 is an inflow. When you sell an option, you receive premium, inflow is 30. When you square it off, which means now you have to buy the same thing. When I buy it, I have to pay premium, which is 36 rupee of outflow. So do you people first of all realize 30 minus 36 is a 6 rupee of loss that you have on every one option? Because you receive 30 and you have to pay 36, 6 rupee of loss multiplied by 125 quantity give me 750 rupee of gross loss that you have on the call option, is the first thing you have to understand. Perfect. Cool. The second thing, everyone in the class. Sir, what about the brokerage? Read this line carefully. Brokerage for the transaction is 0.02%. For futures, it is clear. For strike price net of call premium for option, what is the strike price? 7790. Minus premium, which is 7790, minus 30 is the net amount. For this net amount, into 125 into 0.02% is the brokerage you have to pay, right? So when I sell option, that time I pay brokerage. So 7790 minus 30 into 0.02 into 125. Now, when I buy the thing back at 36, again I pay brokerage. So 7790 minus 36 this time into 0.02 into 125 give me this brokerage. So now I'll say 750 rupee of gain minus the brokerage on option, first at selling the option 194, then at buying it back at 193.85. So from 7050, when you deduct the two brokerage, you get the net loss that you have along with the brokerage. So 750 was lost, these two are also lost, 1130 become the overall net loss on the options. That was people's second part of the question. Third and fourth part of the question, extremely easy, you'll be able to do it at your own. My main point was to explain the first 2 points. Question number 13, which is this particular question, question number 35th gets done from my side, which had this unique point of learning. All other question on this category are really same, is of no difference. People, requesting your responses. We are really done with this another chapter having two topics of utmost priority which we have done in this chapter. Now what is the point of more excitement is how will the upcoming paper of May 26 and November 26 be? Will it follow this trend, right? In the past, so many attempts. The worst case was 40 marks of question from these 27 topics. The best case was 88 marks of practical paper from these topics. So let's see. But as I said, these topics should be of priority. Does not mean other topic you leave. From these topics, you should not skip if you are planning to. If the time is short, you cannot skip any of these topics. Other topics you might have to skip to, but you don't have to only rely on these topics, is my point. Yes, so that people really completes your entire derivative. Now we have to start with the next chapter. So let's take a quick 5-minute break, right? When did we take a lunch break? Was it at 1:10 something? So it's 2:30 and 3:30. Oh my god. People, am I only one not able to feel the time? I didn't realize it's been 2+ hours since we have done lunch. Is it that? It's been more than 2 hours than we have done the lunch. So great, everyone. Perfect. So let's now take a quick 5-minute break, post which we come back and figure out the topic to be started. Yes? So let's meet back after this quick break. Let's have coffee, all right, tea, coffee, whatever. Let's meet back by 3:50. All right. So I'll see you all after this quick 5-minute break. All right. Bye, people. All right, everyone, are we back? What do you say? People there? Everyone. Are we all there? Right. So we are 50% done. We are 50% done, almost 50% done with the all the concepts that we have to do, all our efforts. Now we will do Forex, right? And in Forex, I will tell you what are the two things that you have to primarily do. One is forward hedging, another is foreign currency investment and borrowing. These two topics you have to understand really well, right? It is of importance. Okay. Then the next two topics I will tell you how are they effortful or how important are they. Yes. So starting with the first two topics, foreign forward hedging and foreign currency investment borrowing. Right. Frankly saying, I can consider to not pick this topic and rather pick mutual fund. Give me a minute. Okay, let's do it in the sequence only so that any student who's trying to, watch the things in part does not have to struggle. First, we do forward hedging and then we foreign currency borrowing and then we do money market hedging. Let's start with the first one, taking you to the concept of forward hedging. Time stamping people, please do the favor of doing it for me, right? So that I can pin your comments to the comment box and everyone is able to see them. Perfect. Sir, starting with the hedging in the forward market. Let's start with the most basic thing. Right? You have to give me a very few minutes to understand the basics and the practical questions then will automatically follow. You'll be able to feel that whatever we are learning in the OutNotes is conceptually clear and then application of those concepts in the question is as it is happening. Yes, sir, you import something today in the foreign currency, which means, do you agree as an importer, if I am importing today, then I have to make the payment to him? But imagine that you import today, but the payment of that has to happen after 3 months. So at 0 point, I import something, but after 6 months, for example, I have to make the foreign currency payment to him. Let's say I'm an Indian company, my home currency is rupee, but if I import something in dollars, then I have to make the payment of dollars to him. Which means, do you agree after 6 months you will go to the Forex market and buy that foreign currency dollar? But sir, that is where exactly the problem is. I stand at 0 point. I'm not sure what is going to be the price of dollar after 6 months, which is what I'm afraid of, which is what my uncertainty in the spot market is. Because rupee per dollar rate today I know, but what is going to be the rupee per dollar rate after 6 months? That is uncertain. That is the risk that I have in the spot market. How do you eliminate that risk? Through hedging. So whenever you want to start hedging, you take the position. Whenever you think the hedging is over, you settle the position. That simple is the logic. Cool, sir. What position do you take is really simple. The golden rule says do in derivative today the same thing that you will do in the spot market on a later date. Do you agree as an importer in the spot market, you will go to the Forex market and buy the foreign currency? So in order to hedge today at 0 point, in order to hedge, do the same thing in today only, which means under the forward contract, buy that foreign currency today only. Enter into a contract today to buy the foreign currency today only at whatever is the forward rate today. Similarly, if you're an exporter, you know that you are going to receive the foreign currency and you are going to the forex market to sell it, but you don't know what is going to be the rate, which is why you need hedging. Which is why at 0 point, when you start the hedging, you take the position in the derivative, the same position that you will do in the spot market on a later date. So on a later date, you are going to sell the foreign currency. Why don't you sell it today in the forward market only if you want to hedge? So in that case, I will sell the forward currency. I will sell the forward contract, which means I will enter into a contract to sell the foreign currency. Agreed? That is the position to be taken. Forward position that you have to take is, I have explained. More important thing in this question is to learn what exactly examiner is going to ask. Possibility 1, calculation of total inflow or outflow. Meaning to say, sir, if I am an importer, I have to buy the foreign currency from the forex market, right? And whether you buy it from the spot market or through the forward contract, whatever. But when you buy the foreign currency, do you agree from your pocket it will be a home currency outflow? To buy those dollars, you have to pay rupee. Is the first thing clear? Yes, sir. Second, if you're an exporter, you know that ultimately you'll receive the foreign currency, go to the forex market, sell it, right? Whether in the spot or through forward, you will sell the foreign currency and you will receive your home currency. So how much is that home currency inflow? That is the first thing examiner can expect you to calculate. Second, I'm being precisely exam oriented here, right? Second, examiner may ask you to calculate the gain loss, for which you should first of all learn what are the four terminologies. One is S0, which is the spot rate at 0 point, which is actually there, the rupee per dollar rate actually there in the market. Then EST, estimate of spot that will prevail after 6 months. At T point after 6 months, what is the rate of spot which will prevail? That I'm trying to estimate today. So EST is my estimate. Today when I stand, I'm trying to estimate after 6 months what will happen. Then today in the forward market, a rate actually prevails at which the contract can happen, right? Using which the execution or the settlement will happen after 6 months. Rate is booked today, actual buying selling will happen after 6 months. So the cross represent where would the actual buying and selling be done, where would the execution at that rate be done. Cool. And I'm writing F0 here because the contract is entered today. I'm writing EST here because that is when you are trying to estimate the future. And then is actual spot of T point, which means at the end of 6 months, I will I will have the actual spot price that will prevail in the market at that point. Fine, sir. Now, examiner can either expect to find you the total inflow outflow, the first thing that we learned. Second thing examiner may want you is to calculate the gain loss. Meaning to say, examiner will ask you to calculate that if there is no forward, how much is the expected gain loss? So you have to apply common sense and compare S0 with EST. Meaning to say, suppose you are an importer, you have to make the payment of $1 lakh. Rupee per dollar rate today is 50, but you are expecting is to become 55. So you'll have to apply common sense that, okay, today if I buy dollar, I'll be able to buy it 50. But later on, if I buy, I'll have to be able to buy it at 55. Do you agree? On every dollar, there is a 5 rupee of loss happening due to delay. Based on my estimate, there is 5 rupee of loss happening due to delay. So that is what that 5 rupee of loss multiplied by $1 lakh give me. $5 lakh as the expected loss which will happen. Why the word expected? Because it is not the actual it will happen. Sir, I am estimating rate to be 55. Rate is expected, which is why the loss of 5 lakh rupees also is expected. Cool. Then examiner says, what if now you hedge at the rate of 54? What if you hedge at the rate of 54? Which means now do you agree? My outflow, my purchase of $1 lakh will not happen at 55. If I book a contract today, I will be able to buy those $1 lakh at 54. So now I will say, today if I buy dollar, it will be at 50. But after 6 months, if I buy it under the forward contract, it will be at 54. So it is 4 rupee of loss on $1 lakh, it become 4 lakh rupee of loss. 4 lakh rupee of loss I will have in case of forward. So I will say, if I don't hedge, which means I will compare S0 with EST. And my expected loss was supposed to be 5 lakhs. However, if I hedge, I will compare S0 with F now because contract is booked, right? And my actual loss now, not expected, actual, because if the contract is booked, it become actual loss. The actual loss people in the class will become 4 lakhs. So the second possibility is calculating the gain loss where you have to compare S0 with if not hedged, what is the gain loss, and once you hedge, what is the gain loss. Do you understand me on this? Right? Let's first try to solve the practical question of the second category, then I'll explain the third category. Right? Then I'll explain the third category. Sir, I am proceeding ahead with this, but one thing you should always remember is What matters to you always is your home currency inflow outflow, home currency gain loss in any question of Forex. In most of the question of Forex, especially hedging, right? So I'll take you to the question of Forex of forward hedging, which is the question I want to first of all solve, is question number 21. All right, a comprehensive question, which is why I'm solving, and not that it is an important question. It is as important as any other question, for which I'll again take you to the timeline of our regular batch. So these are your full English regular batch notes where the timeline for this particular question I have to check. Perfect. Here is the timeline. Okay, wait. Just a second. Huh? Sorry for taking up time. It's sometimes hard to find it, but you'll be able to surely find it. Just give me a minute. Here it is. Sir, what this question says. Question says there is this company called as JKL Limited, which is an Indian company which has an export exposure of JPY 10 lakhs receivable on 31st August. Do you agree that do you know that you can read this line casually? But this line has particularly a lot to understand. If you are an Indian company, you have to realize your home currency is rupee. So any inflow or outflow ultimately has to be in your home currency rupee. It has an export exposure. What is the implication? The implication is that my foreign currency, which is yen, I will receive those foreign currency because I've exported something today, right? On 31st of August, I will go to the Forex market to sell those foreign currency. Yes, under forward or a spot or whatever. But if I go to sell those foreign currency in the Forex market, I will have rupee, which is home currency inflow. Inflow is what the other thing I wanted to explain. Cool, sir. Japanese yen are not directly quoted against Indian rupee. Rupee per dollar rate has been given and yen per dollar rate has been given. So if I am an Indian company, home currency is rupee, foreign currency is yen. I need a rate between rupee and yen. But in the absence of information, I have rupee per dollar and yen per dollar rate. Can I do the cross currency and find one of the two rates, which is yen per rupee or rupee per yen? The answer is yes. What will you want to calculate? Sir, quantity is yen, the exposure and in terms of yen. So I would want my base currency to be yen. So I would want to calculate rupee per yen. Sir, how do you calculate? Simply make this as numerator, make this as denominator. I'm not trying to teach you cross currency here, directly coming to the cross rate. So 62.22 divided by 102.34. 62.22 divided by 102.34 give me 0.6080. So today rupee per yen effectively is 0.6080. Perfect, sir. It is estimated, you are trying to estimate future, that yen will depreciate to 124 and Indian rupee will depreciate to rupee 65. You are trying to estimate future, right? And you are using the word appreciation and depreciation, which relates to the change in the spot market rate on a later date, which is you are trying to find the estimated spot rate. So similarly, 65 divided by 124 give you the estimated spot of 0.5242 of rupee per yen. Cool. The forward rates are also available. If you do the cross currency of forward rate, which is 66.5 divided by 110.35, give you 0.6026. So do you have an estimate of do you have the forward as well? Cool. So you have S0, you have ST, and you have EST, and you have F. Now look at the way institute is asking you the question. Calculate expected loss if hedging is not done. If you don't hedge, what is the loss? How will the position change if you hedge? So through the language, is it clear that in the first part, through the, oh, is there a glitch in the audio? People, what is the glitch? Please tell me. Others, please confirm. Is there a glitch? So the battery of my mic looks really okay. Miral, please confirm it once more. Are you sitting at the same point where I'm speaking? Let me check, no? One second. Audio is back? Cool. So that was for a few seconds, right? I hope so. So that was for a yeah. Fine. Cool. Yes. Great. So the look at the flow of the question. It says calculate the expected loss if the hedging is not done. And how will the position change if you take a forward cover? So obviously, sir, look at the language. You realize that every time you calculate gain loss, you need two rates. In the first case, you cannot use forward because forward is to be used in the second case. Then in the first case, the only rates that are left for you to compare is S0 and EST. That become the common sense. In the second case, they say, how will the position change if you take forward cover? Meaning to say, you're an exporter, right? You will go to the Forex market to sell yen and receive rupee. Suppose that you don't sell yen at this rate because now you take a forward cover, so you will sell the yen at this rate. Now, how will your gain loss be? So in that case, you compare S0 with this rate. Are you all connected to me on this? Requesting your responses. Could I convey this point to you particularly? Come on. Yes or no? So I will have to simply now think it in terms of rupee inflow. That sir, I was supposed to receive the rupee against every yen that I sell. I was supposed to receive the rupee at the rate of 0.6080, but now I'll receive it at the rate of 0.5242. So every rupee, due to delay, there is a loss. On every yen, there is a loss of 0.5242 minus 0.6080 multiplied by 10 lakhs give me 8 lakh. 10 million give me 8 lakh 38,000 of loss. That will happen to me. 8 lakh 38,000 of loss. Perfect. It is expected. Why the word expected? Because it is based on expected spot rate. Then how will the position change if you take forward cover? So sir, common sense. Earlier, if I would have sold those yens at the rate at 0 point, I would have sold it at a point of 0.6080, but now I'll be able to sell it at 0.6026. How much inflow loss it is? Earlier, I was receiving this rupee against every yen, but now I'll receive this rupee. So 0.0054 of loss. 10 million give me loss become 54,000. So I will say with the help of forward, my loss has been reduced from 838 to 54,000. Is this clear? Are the 2 points clear to you? Yes, sir. My loss become this. Now they say, if the spot rate, are the two things clear? Now you're learning something new. Now the examiner will say, suppose you took the forward contract thinking that rate will become something, right? Rate, you thought the rate will become this. So you booked this particular forward contract. Now, but the actual rate become this. What is the implication is what they are asking. Sir, we will have to check it out here. Now they say if the rate become 0.5977, you thought the rate will become 5242, but the rate become 5977. Is it justified to take a forward now? You took the forward at 0 point with this expectation, but the rate has become this. Now when you come here, you get to know the actual spot. So they are asking your justification. You're asking that please justify the decision that you took 6 months back or whenever, right? Was that decision correct? I will say, if I would have not taken a forward, then do you agree I'll be able to sell my yen at an actual rate of 0.5977? In that case, the loss would have been 0.6080 minus 0.5977 give me into 10 million, give me 1,03,000 rupee of loss. Loss of how much, people? 1,03,000 rupee of loss. So if I don't take forward, if I would have not taken a forward, loss would have been a lower number. I estimated of 838, but it would actually would have turned out to be 103. But do you agree? Taking forward, what's still better, because that reduced my loss to 54. So I will say forward is still justified because loss under the forward is least as compared to the actual spot, which is lesser than initial expectation, but still more than the forward case loss. Boss, could I explain this entire question number 21 to you? This was scenario 1. Possibility 2, which require you to compare your S0 with EST, then F, and then actual ST. I'll make you people do one more question of this category. Question number 22. Why are you doing this category again? Let me teach you. Are you settled with this? Requesting people in the class your responses, please. Tell me. Right. So come on. A company operating in Japan has today effected sales to an Indian company. Cool. The payment is due in 3 months' time from the date of invoice. So initially, I feel that I have to think it from a Japanese company, that my home currency is yen. I sold something to the Indian company and so on. The invoice amount is 108 lakh yen, but you have to now apply common sense, right? Or even if you apply, don't apply, drop it. Wait. At today's spot rate, it is equivalent to rupee 30 lakh. So 30 lakh rupee is equal to 108 lakh yen. Fine, sir. It is anticipated that the exchange rate will decline by 10% over 3-month period. And in order to protect the yen payment, the importer proposes to take appropriate action in the forex market. Who proposes to take the appropriate action in the forex market is the most important thing. Sir, it is the importer who did it. Are you realizing the point? I thought I am a Japanese company, right? But importer company is the Indian company, and it is the Indian company who proposes to take the appropriate action. Common sense, because sir, Japanese company, if the invoice it is in yen, what risk does the Japanese company have? The Japanese company will receive yen and it is its home currency. There is no risk. The risk belongs to the Indian company because Indian company has to make the payment of yen, which means now it will have to buy yen. Yes. And to be able to buy the yen, it is proposing to use the forex market where 3-month forward rate is presently quoted at 3.3 yen per rupee. What has been given to me? The rate of yen per rupee. Now read the line again. The invoice amount is 108 lakh yen. Today's spot rate, it is equal to 30 lakhs. So I know that 108 lakh yen is equal to 30 lakhs. Using this rate, I can also find 1 yen is equal to how much, or I can also find 1 rupee is equal to how much. What do you have to find? Sir, since the given forward rate is the rate of rupee, I should also proceed to find the rate of yen per rupee. So I will say 30 rupees equal to 108 lakh yen. So 1 rupee is equal to 108 divided by 30, which is yen per rupee 3.36. What that become? That become, people in the class, my current spot rate. That become my current spot rate. Now they will say, it is anticipated that this exchange rate will decline by 10% over 3-month of period. I'm expecting that this rate of 3.6 yen per rupee will decline by 10%. So 3.6 minus 10% become 3.24. So on the timeline, if you have to understand, I have been given the present spot rate of yen per rupee 3.6. I have been given an estimated spot rate of 3.24, and I have been given the actual forward rate today, which is there in the market at the rate of 3.3. Cool. Now look at the scenario. Look at the question, what they are trying to ask. They are trying to say, you are required to calculate the expected loss and to show how it can be hedged by the forward contract. So first you have to calculate the expected loss. You can't use the forward contract in the first part. So obviously the other two rates that are left is this and this. Language obviously clearly says the loss that you are expecting without forward, how much loss is expected. So rather than 3.36, now the inflow outflow will happen at the rate of 3.24. Cool. Then if you take forward, so there will be no use of the expected loss, because in that case you will book a forward contract here. So as compared to S0, what will be forward? Do you all first of all realize in the first case these two rates compared, and then in the second part of the question these two rates compared? Now I'll take you ahead to explain my main point. Do you know how is this question different from the previous one? Let me try to make you people do the mistake first of all. Sir, I am an Indian company. Yes. Sir, I will buy yen. Yes, sir. For when I buy yen from my pocket, do you agree it is a home currency, rupee outflow? I'm an importer. I have to make the payment of yen from my pocket to buy those yen from the forex market. I'll have rupee outflow from my pocket. Sir, outflow was happening at the rate of 3.6 if I do it at 0 point, but now the outflow will happen at the rate of 2.3.24. Do you not Miral Jain? You can join live from now. Okay, just give me a minute. Let me complete this one, then I'll guide you what's happening. Right? People in the class, please pay attention. Miral, let me complete this question, please. We are in the middle of something, then I'll guide you what's happening. So, at the rate of 3.24, if now the outflow happen, it is a loss to me. Why do you feel it is a gain? Do you people realize what I'm trying to tell you? I rather feel a gain for myself. How can they say it is a loss to me? So the point of learning here, as I say in the class, is to really important to figure out whether you can apply a gain loss on a per unit basis or a totality basis. If you're my class student, you'll be able to connect, and if you're not my class student, you have to understand it now. Sir, in the previous question, quantity to be bought or sold was yen. I was exporter, so I had to sell yen. And the rate that was given, or which I calculated as cross currency, was the rate of yen only. So the rate was rupee per yen and the quantity was yen. But in this question, it is different, sir. It is different. Sir, quantity, if you realize, is yen because my invoice amount is in yen. But the rate given to me is in rupee. And in that case, people in the class, do you agree? You cannot think on rate to rate basis. You'll have to, in such cases, think on a totality basis that, sir, to buy 108 lakh yen at this given rate, how much is going to be rupee outflow? And to buy the same 108 lakh yen at this rate, how much is going to be the total outflow? That total outflow versus total outflow is needed to be compared, is the point I wanted to tell you, which is why we are solving this particular question number 22. Could I teach that to you? Please respond to me. All the live people sitting here, all the recorded people sitting here, please validate. Could I teach you this particular point here? Yes. So I will say quantity is rate yen, rate is rupee. So I'll have to divide. So 108 divided by 3.6 give me 30 lakh rupee of outflow. To buy 108 lakh yen at this rate of yen per rupee, I will have to pay from my pocket 30 lakh rupee. So the outflow, people in the class, is 30 lakh. Point of learning here is that you have to do it on totality basis, unlike previous question. Sir, if I buy those yen at this rate, rather, what will be the outflow? 108 divided by 3.24 give me 108 divided by 3.24 give me 33.33 lakhs. All right, sir. So do you agree the home currency rupee outflow, to purchase those 108 lakh yen, right, is more, if as per estimated spot rate, is more by 3.33 lakhs. So the loss expected is 3.33 lakhs. That is why I'm here in this particular question for you people to be able to remember when do you apply per unit and when do you apply totality. Nothing else beyond this is new in this question, question number 22. Am I clear? Now the forward part, you will have to do it at your own. Sir, S0 outflow is 30. As per forward, the outflow to buy those yen is 108 divided by 3.3, the forward rate given, giving you 32 lakh 72,000. So overall 2 lakh 70,000 become the amount of actual loss as per forward. So we will say loss without forward is 333. Expected loss without forward is 333. But if I book the forward, the loss become 272. So it's a great deal that we should go forward. Question number 22. Could I explain the main point that I'm trying to explain? Right? Now, there is one more question. Cool? The situation 2 is clear to you. I'll take you now to situation 3. Situation 3, everyone in the class is what? Please pay attention. Situation 3 asks you to compare two rates. Simply, which is your common sense. They will tell you, I did this import today or export today. I am expecting rate to become this. And there is a forward contract available in the market is this. Please tell me, due to forward, is there is a gain or loss? They will not say if there is a no forward, what is gain loss? Then if there is a forward, what is gain loss? They won't ask you the gain loss twice. They will ask you the clearly the gain loss only once, that due to forward, is there a gain? Is there a loss? So what is the common sense? Common sense says, suppose rupee per dollar rate I'm expecting to be 55. Rupee per dollar rate as per forward is 54. So I will simply say, if I don't do forward, this will be the outflow. If I do forward, this will be the outflow. Where do I have a lower outflow? Forward. So there, due to forward, there is a gain of 1 lakh rupee. Comparing which two rates? EST with F0. These two rates you have to directly compare. S0 in that case is of no use. When is that situation? It is the situation where examiner won't ask you the two gains and losses. Without forward, what is the gain loss? With forward, what is the gain loss? That is not how institute will do. Institute will clearly say, I am booking this forward contract. Due to forward contract, how much is the gain loss? I'll compare EST with the forward. That simple is the situation. Are you understanding my point? So what are the three possibilities on which this question may be made? Possibility 1, finding the total outflow or total inflow, obviously in home currency terms, under forward. Second, gain loss calculated twice, S0 with EST, S0 with F. Possibility 3, calculating the gain loss only once, comparing forward with EST or ST, right? For the second scenario, we have done two practical questions, one on per unit, another on totality basis. For the third situation, we are doing a practical question now. For the first situation, we will do the practical question in the next concept automatically, right? We are doing the question now, which is forward versus ST, right? For which one practical question I would want you to look at is, say this particular question. Which question, boss? I don't have a ready question for this. This is 29 is one such great question, but it is a more detailed question. So I will, people, just read a question in front of you for your comfort, to figure out how does the examiner ask such questions from you. You'll have to do it at your own. Look at this. Look at this. Question will say, compute the profit or loss the company will make if it hedges its foreign exchange risk with the exchange rate on 31st December 26 as. What it says? It says you are standing on 1st July. All right. This is expiry, which is 31st December. You want to compute the profit loss if it hedges the foreign exchange with the forward. So what is the forward rate given to me? The forward rate is given to me, right? So if you hedge using forward, what is the rate at which inflow outflow will happen? Sir, I purchased goods, right? So I am an importer. So at the rate of 64, I have a rupee outflow. At the rate of 64, I have a rupee outflow. Just trying to give you a sense of this situation 3. Please pay attention, right? Not explaining the entire question, just understand the situation. I'm an importer, right? I have a rupee outflow at the rate of 64 if I book the forward. If I don't book a forward, then my outflow will be on 31st December, the spot rate is expected to be 68. Do you agree? Due to forward, I have a lower rupee outflow. This outflow is in my home currency rupee. So without forward, rupee outflow for every dollar, 60,000 is the dollar quantity. Per unit is possible. Quantity is dollar, rate is dollar. So every dollar outflow will become 68 without forward. But if I take forward, every dollar outflow becomes 64 rupee. Can you feel a 4 rupee of gain due to forward? Has nothing to with S0, just comparing F with ST. Requesting your responses, people. Could I, requesting your responses, convey this particular point to you? Although this question has other more detailings, which is why I'm not discussing it in detail right now, but the context of the question is examiner asking for the gain loss only once, not twice. Without forward, what is the gain loss? Then with forward, what is the gain loss? That's how you get to know that, okay, you have to compare due to forward what's happening. Simply, rather than ST, now the inflow outflow will happen at F. So due to forward, if it's a higher inflow, it's gain. If I'm an exporter, there will be inflow. So due to forward, higher inflow, gain. Lower inflow, loss. If an importer, there will be home currency outflow. Higher outflow is a loss, but lower outflow due to forward is a gain. Perfect. So that is what the conclusion of question number 18 is, which I wanted to explain the third possibility, right? This, everyone, now let me guide you what are the other possibilities in the section. Question number 17 is a good question. Okay, it you must check it once. Okay, it asks you to compare two rates. It is possibility two, actually comparing this with this, right? That's all it asks you to compare. Fine, that is this thing. 18th and 19th question is possibility 3 that I've explained. Question was 12 and 13 are also repeatedly asked easy questions, right? 12 for your comfort I'm doing in the class right now, but 12 and 13 are also repeatedly asked easy question, doing them right now for your comfort, especially 12th, right? Then is when this topic will be considered done. The following two-way quotes appear in the foreign exchange markets. What are the two-way quotes which are appearing? Right. The USD spot rate is rupee per dollar 46 and 46.25 bid ask. 2 month spread is 1 and 1.25. Generally, the spread word relates to the difference between bid ask, but obviously, when bid and ask are given, 2 month spread automatically means the 2 month forward point, 2 month swap points. Cool. Calculate 2 month forward rate. Such an easy thing. Sir, spot rate is given, low high spread has been given. So we'll assume that to be the premium points. 46 plus 1 is 47. 46.25 plus 1.25 is 47.5. Cool. How many US dollars should the firm sell to get 25 lakhs after 2 months? What a simple question. Sir, you want to get rupee, you want to buy rupee. So when you buy one currency, you have to pay another currency. So how many dollars you will have to pay, you will have to sell to buy 25 lakh rupees after 2 months? So when they say after 2 months, I have to use the forward rate. So let's apply common sense. It's the simplest question on conversion. When I have to buy rupee, right, rate is of dollar, so it's like I'll have to think it in terms of selling dollar. I wanted to actually buy rupee 25 lakhs, but the rate is of dollar, so I will say buying rupee is selling dollar. When I sell dollar, the other party buys, and the relevant rate become bid rate, so it become people 47. So since the quantity is rupee, rate is dollar, I will have to divide buying rupee divided by 47 gives you the dollar to be paid. 25 lakhs divided by 7 give me $53191 to be paid. B part extremely easy. C part, everyone. How many rupee if is the firm required to pay to obtain 2 lakh dollar in the spot market? So first of all, it is the spot market. This is the area you have to focus on. Second, sir, to obtain 2 lakh dollars, which means to buy 2 lakh dollar, how many rupee you have to pay? Again, a simple buying selling question. Dollar 2 lakh you have to buy. When we buy dollar, the rate is also dollar. The firm other party sells, the bank sells, which is 46.25 ask rate. Quantity is dollar, rate is dollar, you have to multiply. So 2 lakhs multiplied by 46.25 is 92 lakhs 50,000. Again, an extremely less than expected easy, less easier than expected question. Question number C is. D part of this question, people in the class, please pay attention. Assume that the firm has $69 in the current account earning no interest. Rate of return of investment, right? Rate of interest on rupee investment is 10% per annum. Should the firm encash dollar now or after 2 months? Sir, what is the point happening? Listen. Right now you have $69,000. You have two choices. Sell that and convert that to rupee using spot rate and invest that amount in India at the rate of 10%, or wait for 2 months, let it remain 69 only dollar, because no interest are being earned on the dollar current account, but sell it after 2 months at the forward rate. Here if you sell, it will be at a spot rate. So let's do both the option, right? 69,000 people at the spot rate when I sell. So when I sell dollar, the other party buy become 46. So 31 lakh 74,000 is what I will receive as rupee. For a period of 2 months, what is the amount of interest at the rate of 10%? So 10% for 2 month amount of interest become this. right? And the total amount of rupee received after 2 months is 32,26,900. Logical? You can check 3140 31,74,000 into 10% into 2 divided by 12 give me 52900. Adding this give you the total amount of received as 3269 32 sorry 26,900. Fine. However, if you receive the amount after 2 months, it is 69 only that you receive. But this time you are able to sell it at a forward rate of 47. So 69,000 multiplied by 47 gives me 32 lakhs 43,000. So selling it at a forward rate is a better deal because it is a higher rupee inflow. Not comparing any gain loss, it is a situation one question where you have to simply find the inflows as per forward rate, and that is why I say selling at the rate of 32 lakhs 43,000 people in the class is a better deal. Could you all, everyone, connect to this simple particular question requesting your responses? 32 lakhs 43,000. Come on. This was question number 12. Very easy, super duper easy. Wanted to teach you. Are you people, live and recorded people, understanding me? Please confirm, please validate. Such an easy thing. Miral, I didn't know that you are here, so I missed to talk to you. Okay. So this concept is anyways done, Miral. Then I will anyways take you to the main page where I'll be able to tell you how much of this video has been done and how much more we are planning to do it. Yes. So 12th question gets done. Give me 2-3 more minutes, Miral, then I'll give you everything. Right? What a coincidence. In a class, in this world of so many names, how can there be two Miral? Unless you are the same Miral motivating me just by joining live. Are you the two different Mirals? Or one is, I mean, Miral Shah. Are you Jain? Because Shah, I think, sir, Shah sometimes is Jain surname. My God, isn't it the level of, I mean, the height of coincidence? Hello? Miral is not Rahul. You have to please realize. Miral is not Rahul or Rohit or Ankit. The only two Mirals that I have seen in my life are two of you. It's not Rahul where every fourth person on the planet is Rahul. Yes. What a coincidence. Great. Well, keep on doing it. Anyways, question 13th, you know, is what? You haven't met? Will you agree? I have never met two Mirals at the same time with such a unique name that both of you have never met any other Miral other than this YouTube video. Wow. Great. I think sometimes the Forex is easy to process than the things that happen to us in the real world. Isn't it? Perfect. So listen to me. Listen to me. Guys, question number 13, I'm just sharing the point of learning. Yeah, both are Jain. That's what my coincidence. I mean, not just the name, the surname, which is why I'm doubtful you're motivating me to join from two different devices. Right? Listen to me. Listen to me. Well, jokes apart. Jokes apart. Question number 13, right, involves interpolation. What is the point? Yeah, listen to me. What is the point? 2-month swap points have been given. 3-month swap point has been given. Just sharing directly the point of learning here. Examiner want you to calculate 2.5-month swap point. 2.5-month swap point. How will you do it? Really simple. Interpolation. It's like 2-month swap point is 70. 3-month swap point is 160. How much is 2.5-month swap point? Whatever way of interpolation you have learned, you can apply. Class students, do you remember this particular way of interpolating? 2.5 minus 2, this minus this, divided by 3 minus 2, which is this minus this, is equal to x minus 70 divided by 60 minus 160 minus 70. Using this way, you will have to interpolate for bid, and then you will have to interpolate for ask. Correct? That is the point of learning in question number 13. Then the next thing I would want to teach you, 17th is fine, good question, I'll have to look at it. 18th and 19th question are easy. They relate to possibility 3, comparing F and S0, right? Question number then is something we have really covered everything. Then is question number 25. You will have to do this question at your own, right? Category A question. This question is also simple, just sharing with you the point of learning. Do you agree? I say home currency inflow, higher is better. Using spot rate, there is some inflow. And if you don't use a spot, which means if you don't use ST, right? Give me a second. If I'm an exporter, there will be a home currency inflow. Yes, sir. Using ST, there will be some inflow. Using F, there is some inflow. Which of the two is better? Something that gives me higher inflow is better. Logical. Examiner is a step ahead. It's not brilliant, it's rather dumb. He's not asking you to compare the inflows, he's rather asking you to compare the contribution. Meaning to say, let's assume these inflows to be sales and let's deduct the variable cost from these inflows. From the sales, when I deduct the variable cost, what do I have? I do have contribution. And the examiner wants you to compare the contribution of these two options. ST versus F is what they want you to compare the contribution for. Are you all, everyone in the class, understanding my point, people? Hello? Do you all see me live? My live is there, right? Am I live? Right. So that's how examiner want you to solve question number 25. All right. That's a question, you will have to check it at your own, which people in the class completes with great detail this entire discussion that I had to do with you on forward hedging, right? 5 times institute has asked this question. Now to give this clarity to Miral, Jain, what's the plan for the day is going to be? We are going to do at least 2 more topics: foreign currency investment borrowing and foreign currency money market hedge, right? After which, one thing we can do is we can call this day, okay, and then have a separate marathon one more day. When do you have the separate marathon? Maybe on the day of FR exam, because tomorrow or day after tomorrow, if I take it, no one will be there to watch it up. Cool. We can do it on the day of marathon exam for the rest of the topics. This is one possibility, I'm guessing. That depends on the number of live students which will be able to be there, right? If no live students, if students choose to do it at their own, then we don't do live for the rest of the topics, right? So depending upon your preference, we will decide. For now, I guess we will do these 2 important topics, right? The foreign currency investment borrowing and money market hedging, as the other 2 topics. So we will be, for these bigger chapters, we will be done with, for this bigger and complex chapters, we will be done with the high priority topics. For a smaller and easy chapters, the high priority topics will be left, which I'm ready to do, but depend on the time that you people have to watch that video, we will take a marathon. Am I clear for the plan for the day? Even to you, Miral Shah? Yes. So we are expected to spend around 40-45 minutes more to complete the rest of the things. Settled are we? Sorted are we? Come on. Or we can try, because entire thing we won't be able to complete, that is for sure. So it does not make sense to make a 15-hour stretched video. After a point, it won't be able to go into your brains, right? After a point, even my efficiency will be gone. So it doesn't make sense to just do it for the sake of doing it. Let's do it when you get the best out of it. Perfect. So, Meeral, I'm not going to take IFM today, right? We will end at Forex today. Mutual fund, IFM, MNA, IRRM, RMSA, all these topics will be in the next session. We'll get over in the 6 hours max. Okay. Yes. So we can wrap it up after Forex. Aligned to me? I knew because easy topics in the mutual fund and everything, anyways, your struggle won't be much. Okay. And I'm anyways ready to take it. Perfect. So great, guys. So Meeral, now you can decide if you want to join or what do you want to do. Perfect. Sir, now taking you all ahead to the next topic, which is foreign currency investment borrowing, which Institute has actually asked very frequently, right? The concept which will blow your mind again. Why are you, sir, so confident? Because with this clarity with which you will learn this topic will make you automatically realize this clarity will make you automatically realize how easy the question become with this way the way you learn the topic. All right. So everyone, let's take it ahead. Just give me a minute. People, give me a minute. I need to get water. It's not there with me. I'll need a minute to get it back. Okay. I'll need 2 minutes. Okay. I'll be back in 2 minutes. Yes, there are we all. Perfect. So, sir, interesting, right? Sir, foreign currency investment borrowing. You won't realize how interesting this particular topic is and how easy does it become when you understand what's exactly is happening. Imagine that you're an Indian company, right? Let's first learn investment, then we'll learn borrowing. So I had to went down 2 floors and then get the water bottle and then again climb up 2 floors. So suppose you are an Indian company, you have rupee to invest. What can you do? Sir, you can simply go to SBI, invest your money in India and redeem it after a year. So you have rupee, you invest rupee, you earn the rupee rate of return, whatever is it is in India, you redeem it and you get your rupee back. What is another choice? Suppose you want to make that investment with a US bank. You want to make that investment with a US bank. If I ask you what is a very obvious common sense, what will you do? Do you agree? If you have rupee and if you want to invest in US, you have to obviously go to the Forex market. And in the Forex market, what will you do? Sir, you will have to go to the Forex market to sell that rupee so that you can receive the dollars which can be invested in US. Common sense? You have rupee, so something if you have, what are you going to do with it? You are going to sell it. One option was to invest it directly in India, but I cannot invest rupee in US. In US, I will have to invest a dollar, which is why I'll have to go to the Forex market. So I will sell those rupees so that I can receive dollar. And once I have dollar, I will invest those dollars in the US on whatever is the dollar rate of return and ultimately redeem those dollars. Now you have to apply common sense. Now you have redeemed dollars with you. Isn't it obvious that dollar you are there with you, but what you ultimately need is rupee, because rupee is your home currency. You are an Indian company. Your final inflows and outflows should be in rupee. So the redeemed dollars that you have, you are going to sell it in the Forex market again and receive the rupee back. And that's how you will get to know the final amount of rupee inflow that you have. Correct? So if you have rupee, one option is this: invest it and redeem directly in India. Life is sorted. However, if you have dollar, first you have to sell rupee to receive dollar, then invest dollar to redeem dollar and sell those redeemed dollar to receive the rupee back. This is another way, and both of these will ultimately give you your rupee home currency inflow. Whichever option has a higher inflow is a better option if you realize. Whichever is a higher inflow is a better option if you realize, right? So what you have to people understand here is a simple thing. What you have to realize here is a simple thing, that today when you sell rupee, the timeline avoids all such confusions which I speak now. Today when I sell rupee, do you agree that's a point zero today, which is why the rate will be spot rate. Later when you sell the dollars and get the rupee back, that is after a year, so whether that will either be the forward rate or the spot rate at T point, which is ST. Correct? If you are have rupee amount, then rupee gets added to rupee, I mean rupee interest gets added to rupee amount, and if you have dollar amount, then dollar interest gets added to the dollar amount. Perfect. Rest of the imagination is something you can do at your own. Now I'll take you to a practical question of foreign currency investment, and you will realize this is how exactly even the practical question gets solved. I will take you to the foreign currency investment question, and the first question we will do is question number 72, for which I'll show you the latest regular batch timeline, right? So in the question of Forex, where is my timeline? No, this is not here. Is this here? No. Is this here? No. Where is the timeline was? Yeah, that's here. That's here. People. What it says that, please pay attention, is that it's as easy as it looks. ICL, an Indian MNC, is expecting to execute a plant in Sri Lanka. As they say, an Indian MNC, do you people agree? As an Indian company, my home currency will be rupee. Wherever I make an investment, my ultimate inflow should be in my home currency, rupee. Fine, sir. Aligned, sir. So that's an Indian MNC who's executing a plant in Sri Lanka. It has raised to rupee 4 billion. Half of the amount will be required in 6 months. So ICL is looking for opportunity to invest on 1st April. So in short, they have 200 billion rupee to invest on 1st April for a period of 6 months. It has two options. For 6 months, you want to invest, you stand on 1st of April. What are the dates? This is 1st April. So accordingly, the last date will be 30th September. Fine, sir. Cool. Sir, in the you have two options to invest in. One is yen, where you can invest as a foreign currency. Another is dollar, where you can invest as a foreign currency because your home currency is rupee. When you invest in yen, the nature of investment is an index fund, is a mutual fund, right? Where when you invest in mutual fund, the amount of dividend you will receive is 25 billion yen, obviously in yen only, right? Income from stock lending, there is one more income that you will receive here is from the stock lending, 11.9276 yen, and discount on initial investment at the end. Whatever amount of initial investment that you made in yen, 2% of it will be the discount, right? 2% will be it's at discount at the end when it's traded, right? The interest on the US investment is 5% per annum, because what you invest in the US is the treasury bill, a government bond risk free security. On 1st April, exchange rate is yen per rupee 1.5 and dollar per rupee 0.014. On 30th September, the rate become 1.57 and rate become 0.013. Sir, these are three alphabetical codes, which means they are Swift code, correct? So logically, should I interpret it as rupee per dollar considering Swift code? But look at the number. Can rupee per dollar be 0.014? No, sir. It has to be dollar per rupee if it is 0.014. So obviously, you have to interpret it as dollar per rupee. So if this is dollar per rupee, which means you're not following Swift code, yes, we are not, which automatically implies that it is yen per rupee. Now have your calcies ready with me. Let's follow the timeline. Please tell me if I have 200 rupee. Let's go to Japan and make the investment. If the rate today on 1st April are this, what is the amount of investment you'll be able to make in yen terms? Sir, quantity is rupee, rate is rupee. So let's multiply 200 into 1.58. 316 is the amount of yen that I'll be able to invest today. On the amount of investment that I make, at the end, it will trade at 2% discount. So 316 minus 2% give me 309.68, the closing value of investment, plus dividend and income from lending is there. So plus 25 plus 11.9276. 11.9276 give me 3346.6076 is the amount of yen which gets redeemed on maturity. I know I need to bring it to my home currency, so I will go to the Forex market and sell it. We are lucky to not have bid and ask here. We are lucky to not have. Otherwise, there's a choice, a decision to be taken. So I will now say that let's go to the Forex market and sell those yen so that I can get rupee. I went to the Forex market, rate was rupee, quantity was yen. So I will divide it with 1.57. So I get 220.7692. 220.7692, the amount of rupee to be received in the first case, 220.7692. Perfect, easy. Sir, similarly, if you make the investment in dollar, what happens? Let's check. Sir, I invest 200 rupee. Rate of dollar per rupee 0.014. So 200 into 0.014 give me $2.8 in billion terms which get invested. If I invested for a period of 6 months at the rate of 5% per annum, how much is the amount gets redeemed? So 0.05 into 6 divided by 12. 0.05 into 6 divided by 12 plus 1 multiplied by 2.8 give me $2.87 which get redeemed. Let's go to the Forex market again to sell those redeemed dollars and get rupee. People, I will see the rate is 0.013. This time quantity is dollar, rate is rupee. I'll have to divide with 0.013, giving me 220.7692, the same amount, boss. Whether I invest in Japan or I invest in yen, the ultimately home currency inflow from both the alternative is same. It is 220.7692 only. That is how the question, this one particularly, is to be solved. I'm yet to give my last advice, which I will give right now. But before I proceed ahead, could you feel that this question was simply an application of what we have learned in the OutNotes? Requesting your responses, people. Come on, requesting your responses on this. Please, please, please. Could I do it for you? Examiner says best course of auction, we will say we are indifferent, return for both of them is same, but the risk perspective, I will say index fund is mutual fund which is risky, treasury bill is a risk free security that is less risky, so I will invest in treasury bill. That was simple question number 72 done in the class. A question on investment. Now I will give you a question on borrowing, right? Let's first learn the borrowing here in the timeline exactly the same way. So whenever you see a practical question of investment borrowing, this timeline should be part of your imagination. And let me start this thought with the most basic difference with the investment borrowing is that investment is about availability of fund and the borrowing is about need of the fund. Boss, you get my point. When it comes to investment, right? मैम क्लास चल रहा है, मैं आपको कॉल करता हूँ. When it comes to investment, it is about availability of fund which I need to invest, which I need to sell. For example, here, rupee was available, so I decided to invest it, I decided to sell it, right? But borrowing is about need. Here, rupee is needed, so I can borrow it, or I can, something which you need, you will buy, right? Rather than selling. So I will buy it or I will borrow it. Do you understand the point? So first thought of difference. Now I will initiate the discussion. Please pay attention. I will say rupee you need, right? Rupee you need. Examiner gives the requirement of rupee. One option is to go to SBI. You are an Indian company, go to SBI to borrow. So whatever is the rupee borrowing rate, SBI will charge, and you have to ultimately make the repayment of rupee. Your home currency outflows there with you. Safest life, no problem, no need to go to the Forex market. However, this is just option one. However, if you need rupee, you have one more alternative. Whatever is the amount of rupee you need, go to the Forex market and buy that rupee. Buy the rupee, yes, buy the rupee and pay dollars against it, so that you get to know the amount of dollars required. The amount of dollars required, right? So when you buy rupee, the rupee that you need, right? For example, I need to buy a machine for rupee 1000. So either borrow 1 lakh 1000 rupee from SBI or go to the Forex and buy 1000 rupee, for which you will have to pay dollars. So at least you know the amount of dollar required to be borrowed. Sir, what you need is dollars. So let's borrow that amount of whatever is the dollar cost of borrowing you borrow. So you get the amount of dollar to be repaid. Whatever is needed to be repaid, you go to the Forex market again to buy those dollars, so that after buying those dollars, you can make the repayment of you. So buy those dollars, you will have to pay from your pocket the rupee at the end of a year. And that's how you can get to know to ultimately make the repayment of these dollars against the loan of dollar, how much is the rupee that will go out of your pocket. So one option was to borrow in rupees so that you repay rupee. One option was borrow in rupee so that you repay rupee. Another is buy dollar. You will get to know the dollars to be borrowed. Now you repay dollar, and to repay those dollars, you will buy the dollar again and pay rupee from your pocket. That ultimately gives you the home currency outflow. Boss, in terms of concepts, please tell me, are you all settled? Can you all connect? When I said it is a need, you will buy, you will borrow. See, again, you will buy so that you can pay. When it was investment, it is a situation of something is there, you sell. When you redeem it, again you sell. But here it is a need. Every time there is a need, I will buy it. So one possibility is this. I'll take your conceptual clarity ahead. I'll tell you another possibility. Second possibility. It may happen that examiner tells you that you are an Indian company, right? I know my home currency is rupee, but examiner tells you you need dollar, boss. You need dollar. As an Indian company, why do I need dollar? That's not your concern. That's the thing given in the question, that you need dollar. The best part is timeline remain the same. You need dollar, go to the US bank and borrow dollar, life is sorted. US bank will charge a dollar rate of interest, so you know the dollar to be repaid to them. And to be able to repay those dollars, you will have to buy those dollars, and ultimately from your pocket, how much is the rupee outflow will happen to buy those dollars, you can know. Meaning to say, even if the requirement, the start point is dollar, the end point has to be rupee outflow is the point that I'm trying to tell you. Correct? Correct. Sir, what is the rate at which this buying will happen? Either ST or F, whatever it be, because we are standing at the end of first year, obviously. Sir, another option. You need dollars, right? So something that you need, you can buy. If you need dollar, go to the Forex market and buy dollar. So when you buy dollar, you will have to pay rupee from your pocket. So that way you can get to know the amount of rupee which is needed, which you can borrow. So the if you need to buy dollar, you can pay from your pocket rupee, and to pay rupee you will have to borrow rupee from the Indian bank SBI. You can borrow from India, and when you borrow from India, you have to repay from your pocket rupee to SBI, and that's how you can ultimately get to know the amount of rupee outflow that will happen. Meaning to say, even if the starting point is dollar, the path is buy the dollar to pay rupee and borrow that rupee to repay rupee. Path 1. Path 2, borrow dollars to repay dollar and buy those dollars to ultimately pay rupee from your pocket. The path changes because the starting point is this. However, if rupee need is given, the path look like this. Requesting your response, could I make the things clear to you? Please, in terms of concepts, am I clear? Right? I'll make you people solve a practical question of this category, and you will then say that you are clear about it. Let's solve this particular question number 75, everyone in the class. Let's solve this particular question number 75. Wow. The timeline is there in the regular batch notebook, which is going to help you out. Surely help you out. Here it is. Here's the timeline. Yes, so let's solve this question. It says that there is this company called as Messrs. Daksh Limited, which is planning to import machine from US at a cost of 15,000 USD. Do you agree? They start this question with need, that you want to buy machine. So obviously you will need $15,000. The question start indirectly with the concept of borrowing. Perfect. The company can avail loan at the rate of 19% per annum with quarterly rest, with which you can import the machine. So Daksh Limited, which is an Indian machine, the Indian bank says, we will give you loan, right? Such an amount of loan using which you can buy $15,000. Do you agree? It being an Indian company, the situation is that the question starts from the dollar requirement. I am an Indian company, but the question starts from dollar requirement. So they say, the Indian company says, see, you need to buy, people in the class, you need to buy $15,000, for which you will have to pay rupee from your pocket. Whatever amount of rupee you have to pay, that you can borrow from us, an Indian bank, at the rate of 19% at quarterly rest, which means at quarterly compounded, and you can figure out after 6 months whatever is the amount of repayment. Simple, cool, fine. Sir, with quarterless using which it can import the machine. However, there is an offer from the New York branch of Indian-based bank extending credit for an 180 days at the rate of 2% interest. Sir, the 15,000 amount of loan can also be taken from New York. So directly this amount you can borrow at the rate of 2% per annum for 180 days, which is 6 months, and repay dollar to the US bank after 6 months. But when you repay dollar to them, you will have to buy those dollars after 6 months and pay rupee from your pocket. Do you agree? One path is this and another path is this. Yes or no? The buying selling in your mind should be clear. The borrowing repayment in your mind should be clear. Yes, fine. Sir, what about this irrevocable letter of credit and what about this commission charges? I'll tell you later. The spot rate is dollar per rupee 75, 180-day forward rate is dollar per rupee 77. Justify whether the branch bank offer should be accepted or not. Let's apply common sense. If I don't apply, if I follow Indian bank approach, if I follow this path of borrowing from India, how much is the ultimate rupee outflow from my pocket? Do you agree? I need $15,000. I will go to the Forex market, buy those $15,000 and pay how many rupees? Sir, today rate is 75. So 15,000 into 75 give me 11,25,000 rupee I need to pay to buy $15,000. So this is the rupee if I need to pay. This is the amount I will need to borrow. Yes, sir, let's borrow this amount. Rate is 19% per annum with quarterly compounding. right? So 1125, let's remove. 19% divided by 4 simply become 4.75%. So in 6 months there will be 2 times of compounding. So 1125 plus 4.75%, I'm just applying common sense, plus 4.75% give me 12,34,413, the amount of repayment that will happen here. With the quarterly compounding, 12,34,413 is the amount of outflow that will happen. 12,34,413 is the amount of outflow that will happen. How simple this is? How simple this is? Extremely. Sir, 15,000 in one step converted to rupee using spot rate. In another rate, adding interest converted to the repayment. Are you people 10 out of 10 clear with what I've done? 1123,314 on the calci. Do you have this number ready? Yes. The next step, people, is to borrow from US. So let's borrow 15,000 from US at the rate of 2% for 6 months. Sir, you have to consider 360 days here, right? So if it is 180 days, don't consider 365. So can I say 2% for the entire year? Then 1% for 6 months. So 15,000 plus 1% give me 15,150 to be repaid here. Let's now go to the Forex market and buy it at the rate of 77. Multiplied with 77 give me 11,66,550 to be repaid. 11,66,550 to be repaid. 11,66,550 to be repaid. Based on our discussion so far, 1166 and 1234, obviously New York branch offer is a better deal. Now there is a point of learning you have to learn here in this particular question. Sir, what is the point of learning? Learning is regarding the commission charges for letter of credit. US Bank today will give you loan only when you give to them a letter of credit. What is the letter of credit? You will go to the Indian bank. To the Indian bank, you will ask that please create a letter on which the Indian bank will write that US Bank, I am a good party, I don't default. That letter of my goodwill they want. So I will go to the Indian bank, and Indian bank today will charge 2% for 12 months. So today, if I go to option 2, which is the New York Bank, do you agree in this option there will be one more outflow of commission charges on letter on credit? Yes. How much is the commission charges? Let's calculate. 15,000 is the amount. Today, if I go to the Indian bank, bank will say rate is rupee per dollar 75. Cool. Then Indian bank will say that since you want it for 6 months, so 6 by 12 into 2% will be the commission charges. So 15,000 into 75 into 15,000 into 75 into 6 divided by 12 into 2% give me 11,250, the commission you will have to pay from your pocket to the Indian bank. Can I say of alternative 2, that is one more outflow. But do you have that amount with you? Do you have that amount of 11,250 with you? No. Since all other outflow are in rupee terms, and that too at the end of 6 months, then this also has to be taken at the end of 6 months. So I will assume that amount I don't have. I will go to SBI, that Indian bank, borrow that amount and make the repayment. So do you agree in alternative 2, to find the total amount of outflow, I have to assume the commission to be borrowed from Indian bank. So 11,250 is the commission that will borrow I from Indian bank, and with the effect of compounding after 6 months, how much will it become? Plus 4.75% plus 4.75%, it is 12,330, 12,344. That is how the total outflow in that case is 12,344 is the commission charges after 6 months with the effect of interest, and this outflow that we calculated will be the total charges. Do you get me on this? Requesting your responses, people. All these charges of commission and taking a loan from the US bank comes under alternative 2, which is borrowing from US. Yes or no? Now there is an ambiguity which institute has made. I'm not expecting you to remember it. If you are able to, that's really great. Institute has made a mistake of not doing compounding here. Institute says 11,250 is the amount of commission charges to be paid to the bank. Let's assume that is the amount of loan taken from the bank. So you will pay 19% without any compounding effect. What a hopeless, senseless thing. They say, the Indian bank says we have a rate which is quarterly compounded. So here institute has ignored the compounding, and without compounding they have simply added the interest. So they are saying 1166,550 is the rate, is the final amount you have to pay under alternative 2, plus this commission of 11,250 you have to pay here. So with interest become 1069, so the total outflow become 1178,869. so can I say, if you borrow from Indian bank, it is 1234 of outflow. If you borrow from US bank, to them this is the outflow, and with the commission it is 1178, which is still lower, which is why we should accept the offer from the New York bank. Boss, requesting your response. How much out of 10 could I simplify this particular question to you? Question number 75. Please, 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 please. You should, Miral, do the same thing. You should try to do the same thing which institute has done, but I'm not expecting or pressurizing you to remember this entire thing, because even if you don't, the last step will be incorrect, which is relatively okay, because even the conclusion will be correct only. Yes, I can pressurize you for such questions where right from the scratch if there is one such assumption, because I know that in that case entire solution become incorrect. Here, even if you are not able to remember, not entire solution, the last step of it will be incorrect. That too of only one particular alternative, which is considerable. So if you remember nothing like it, if you are not able to remember, that's also okay. Could you please connect it to what I said? Question number 75 people in the class, are we done? Please tell me. Second part of this question is homework. You'll have to do it at your own. It simply says, suppose you follow Indian bank alternative. Sorry, if you follow foreign bank alternative, then it requires forward rate here, which requires hedging, because Indian bank is a spot rate today, no hedging required. If you take forward rate, then it requires hedging, and suppose that hedging has 30,000 of additional cost. Will you in that case still suggest this? I will say there is a gain of how much? There is a gain of 55 as compared to Indian alternative, which has this outflow. The foreign loan has total outflow of 1178, leading to a savings of 55,000. Even if there is an additional cost of 30, then it is still worth to go with the foreign bank loan. That was 75th question. People, that was a solving of a question where my need was a foreign currency amount. Do you understand it? Sir, now is the next situation. Please be all there. Please be all active. I understand that it's really too much for the day. But what I have to more appreciate is that you are still better than everyone else out there. Those who could not watch it in one go. So if you are watching it in one go, that's really is anyways appreciable. So please continue to remain there. Please continue to be patient. One thing I can tell you, on the day of exam and on the day of result, you will think, you will feel good, you will feel satisfied, you will thank yourself that I made those efforts which are giving me results today. So it will give results today. Be patient, continue to be there. We have to solve some very few questions now, right? 75th is done, right? 70. So out of the questions that I will suggest you should look at, first was 72, done. Then was 75th, done. 76th as exactly same question as 70 previous question, which is 75. Okay, we have done rather 75, which is a more advanced question. All right. Then is 77 question, a basic question which will make you people practice this concept really well. This concept question involves borrowing as well as investment, in which initial point, start point is home currency. Home currency requirement is the start point. You can either do this or go this. You can either do this or do this. So that's the question which you need to practice. 77. Then 78th is another question which I won't do it in the class. It's such a huge question, but explain on a lighter note what this question tries to say. Its timeline, if you see, you will find it complicated. But if you look at the solution of this question, you will start to love the timeline, because it has simplified and summarized this entire question, which is really huge in this simple format. I won't do this entire question. I'll try to explain it. If you get it, that's really great. If you're not able to get it, that's also fine. Cool? Just a minute. Please pay attention to what I say, right? Sir, after this question, you will have to do just one particular concept and one particular question after this question. And that will be the end of this marathon. People in the class, please pay attention. Question number 78. If it comes in the exam, it will be effort taking, let me tell you. Directly trying to share with you the summary of this. What they say, that you are, first of all, a London company. You are a London company. As you hear this word that you are a London company, do you people realize that all your inflows and outflows ultimately should be in pound? Yes or no? As a London company, they say that you have borrowed $5,000. Sir, what an awkward situation. Yes. No worry, I'll simplify it for you. Please pay attention. Right? This timeline is the story. This is the question. This is the solution. Okay. Sir, you have borrowed $5,000. So when you borrow something, you know that you have to repay something, right? So when you borrow dollar at the rate of 4% for 3 months, along with interest, you have the dollar outflow there, which you have to make the payment of. Cool, sir, fine. Now they say the dollar which you have, you can invest those dollars in New York in dollar terms, or you can invest in London in pound terms, or you can invest in Frankfurt in euro terms. So please apply common sense and tell me, if you have dollar and if you want to invest it in New York, can I say dollar can be as it is invested in dollar terms only? There's no need to go to the Forex market. So in dollar, when you invest, the rate of return in New York is 8%. So you have dollar, you invest in dollar, rate of return is 8%. So after 3 months, you redeem the dollar, which means you have the dollar inflow in your pocket. Aligned to me or not? So try to understand the color coding. This is the dollar inflow available in green, and this is the dollar outflow to be met to make the repayment of the borrowing. Yes. Anyways, you have dollar with you. You want to now invest in London, which means you need pound. So isn't it an obvious thing that you will have to sell those dollars in the spot market and receive pounds against it? So let's go to the Forex market, sell these dollar at whatever is the spot rate and receive the pounds. What you do now? Sir, in London, the rate of return is 5%. So I will invest these pound at the rate of 5% and redeem pounds, and the amount of inflow is here. Very similarly, if you have dollar, you want to invest in Frankfurt, which is euro. So at the spot rate, sell dollar and receive euro. Invest this euro at the rate of 3%, which is the rate of return in Frankfurt, and redeem euro. Boss, till this point, are you all aligned to me? That you have the redeemed amount of respective currencies in three different alternatives. You have the redeemed amount in respective currency available with you, from which an outflow of dollar of 5,05,000 is to be met. Come on. Till this point, if you validate me, I'll make this thing go a step ahead. Yes or no? Please. People, what do you all say? Yes. Now you have to understand common sense. Sir, examiner asking where should you make the investment? Examiner asking where should you make the investment? Generally, what do we do? Something that gives to me a higher home currency inflow. My home currency is pound. So something that gives to me a higher pound inflow is a better option to invest. But this time examiner asking what is the net gain in terms of pound. So answer should be in pound only, but what they want is gain. They mean to say when you invest, you redeem is fine. But from that redeemed amount, if you make the repayment of the borrowing of $5,05,000, how much is the net gain ultimately left? How much is the gain you ultimately have in pound terms that you tell us? So it's like if I have an inflow of $5,10,000. If I have in the first case inflow of $510, from which can I pay the $55 against my borrowing? Yes, what I'm left with is simply rest of the $5,000. I need my ultimate gain loss in terms of pounds. So simple, go to the market, sell these dollars at whatever is the forward rate. Since now it's happening in third month end, I will have to sell everything at forward rate. Now it is not the spot rate, it's the forward rate. So sell those rest of the $5,000 at a forward rate and receive whatever pound you can receive. Is the first thing clear? Basic. Dollar inflow was there from which make the dollar outflow payment and receive. Rest of the dollar is left which you can sell in the market, forex market. Next, amount in terms of pound is there. Amount in terms of pound is there which is redeemed. This redeemed pound is there with me. I know that I need to buy $5,05,000, right? Do you understand? To make the repayment of dollar, I will have to buy dollar. So at the end of third month, using forward rate, buy those dollars. Why do you buy? Because you have to repay and make the payment of pound from your pocket. So from your pocket, there will be a pound outflow, which is needed to buy these dollars. And in your pocket are these redeemed pound inflows. So from the pound inflow, if you make the payment of pound outflow to buy the dollars, the rest of the pound left become your gain, which is a gain in terms of pound. Could I explain this one as well? You will have to please validate me. Could I? People in the class, explain this one as well. You will have to please validate it to me. What do you all say? Everyone? Yes or no? People, please. And on a similar pattern will be the last one. I'm not explaining it to you in the class, but whenever you're solving this question, refer to this timeline and your life with this question will be 100% sorted. That I can tell you. Be, oh my God, where were you for so long and now how are you back? Were you really watching everything, Bia? Please tell me. So everyone else, that's how in a simplified manner you can solve this complicated question 78 through this timeline explanation that I've made. All right. Yes. So that's how you will have to do it. Apply your common sense. When you have something, you sell it. When you need it again, you have to buy it. That's common sense, right? When you do buying selling at 0 point, that's spot rate. When you do buying selling at a later point, it is always the forward rate. That way, if you apply those basics really well, you'll be able to make sure the answer is correct. 78 question in terms of concept look easy to you right now, but when you proceed ahead to execute, you will find it a bit struggling, which is fine. Through practice, you'll be able to deal with it. When you execute, you won't find it difficult in terms of concept, but executionally, choosing between bid ask, calculating the forward rates here, using the spot rates, all that part may be a bit difficult. Yes. So that was question number 78. And with this discussion, let me tell you, we have learned it really well. The concept and the application of foreign currency investment borrowing. That is one of the topics which Institute ask in the chapter of Forex. Right. Now let me tell you the plan. Right. Payoff forward contract and currency option should not be included in this list. Sir, why? Let me tell you. Well, let me tell you. I'll maintain complete transparency. Listen to me, right? Or 4 times money market hedging has been asked. 4 times. Out of which currency option was only 3 times, because once only money market is asked. One time only money market hedging was asked. So currency option actually is asked only 3 times. While making this list, I did not pay attention to it, right? And I considered currency option to be a high priority topic asked 4 times, which in fact is asked only thrice. Now, in this sheet, we have not considered even a single topic which is asked 3 times. In this list of 33 topics, we have a lot of concepts asked 3 times. For example, concept of leading lagging in the forex is asked 3 times. The concept of binomial model or margin in futures, which is asked 3 times, right? So you have also a list of those 33 questions, right, which has higher average of 75 marks asked in the previous attempts, on an average ranging from 96 being the highest to the lowest of 48. Our focus is not those 33 questions. Those out of those 33, 28 we are doing. Which topics we are not doing? The asked topics asked 3 times, like bond refunding, like convertible bond, like FRA settlement, like leading, lagging, like margin on futures, like binomial. These topics you will have to do at your own. We are focusing on 27 topics asked for 67 marks on an average. In those 27 topics, the currency swap should not be included. But let me say it transparently. When I say this average mark or 67, or when I say these marks, thrice currency options was asked, the marks for which are included in them. Okay, the marks for that were included in them. So please make sure you don't remain in the impression that 67 marks you are covering without doing currency option. No, in that case the currency option question asked three times, right? And this. Out of four times, three was currency option. That marks of approximately those 4 to 6 marks has to be removed, right? Making it transparent for you. So that we should not do. Similarly, fate of forward contract has been asked twice. But I realized that out of four, two times was default and two times was early delivery. Give me a minute, I'll explain you why are we not doing it. So it's not the concept of CAPM that you learn once and the question is asked 5 times. Fate of forward contract is a simple topic, I agree. But the thought process required for early delivery is entirely different and default is entirely different, which means it is equivalent to covering two different topics rather than one, and then two questions of each of the topics are being asked. Do you understand the point? So effectively fate of forward contract also should not be included here because fate of forward contract has been asked 4 times, but 2 times was early delivery and 2 times was people default. And to learn those topics, it is like you have to learn two different concepts of which the probability of being asked is relatively lesser. So those four questions are also included here in this topic, right? Which is how the marks come to 67. So I would really request you, I'll be very clear with it, except for currency option and fate of forward contract, we will do everything in the both the parts of the marathon, which is again good enough, which is also a huge coverage. But transparency is needed, which is why I explained. Could you understand my point here? People in the class, please pay attention. Come on. Super ultra fast. Could you understand my point? Please respond to me. Yes, so that you are aligned. Perfect. But money market hedging, which has been asked 4 times, takes relatively lesser effort than the two other topics. So we will cover surely money market hedging, right? Which is asked 4 times, which is of priority. So let's do cover the last thing of this marathon as money market hedging, right? Sir, extremely simple topic and logical as well. And just one question and you will be all set with this topic, the concept of money market hedging. People, look at this. First, learn it from the point of view of exporter. Sir, you export something today. When I export something, I know I will receive a foreign currency on a later date, right? So what you have to do simply today, when you export today, you know that you are going to receive a foreign currency on a later date. So what your plan is to borrow today. Suppose you are planning to receive 1 lakh rupee on a later date. So I 1 lakh dollar. So I know that when I export something of 1 lakh dollar, I know that after 3 months I will receive 1 lakh dollar, right? So I want to do such a thing today that this 1 lakh dollar which is being received can be used as it is to make the payment. So what do you have to do? At 0 point you borrow 1 lakh rupee, 1 lakh dollar, sorry. For simplicity, I'll rectify, but for now, can I borrow 1 lakh dollar today so that after 3 months I have to repay 1 lakh dollar? So whatever amount I'll receive from my other party against export, those 1 lakh dollars can be used as it is to make the repayment. So the step 1 today become borrow an amount so that it can be repaid after 3 months. So my point is not the borrowing, the repayment of the borrowing, because that $1 lakh will come, $1 lakh will go out. That is not the point. Point is, when you borrow those dollars today, what is the use of it? Now, taking you a level ahead. Boss, people in the class, please pay attention. Do you agree? If you borrow 1 lakh today, then the amount of repayment will be 1 lakh plus something. So what you should borrow today is the present value of 1 lakh, which with interest can become 1 lakh dollars, so that whenever that 1 lakh dollars received from the other party, I can make the payment to the bank against the borrowing. Please validate to me, are you people clear with the first step, that I will have to borrow the present value of those 1 lakh dollars today? Present value of 1 lakh dollars is what I need to borrow today. Yes or no? Quick. That borrowed amount, everyone in the class, that borrowed amount, when I have borrowed something, what is the next step? Sir, that amount become available. Let's go to the market to sell that amount using spot rate and receive your home currency rupee. If you have rupee in hand, you have it's available. So what you do, you invest that amount, people, and receive, and at whatever is the rupee rate of return, and ultimately redeem that amount in terms of home currency. So the point is, those 1 lakh amount, 1 lakh dollars at which you export, when you were receiving those 1 lakh, you had an option to hedge it using forward. You could have sold those 1 lakh rupees at a forward rate, but another choice is that borrow the present value, sell that present value in the spot market, receive rupee, invest and redeem ultimately rupee. So you can compare, when I sell it using forward, how much is the home currency inflow? And if I do money market hedging, how much is the ultimate amount of home currency inflow? That is the thing that happens in case of receivable. Similarly, for payable, the situation is different. I know that I have to make the payment of $1 lakh after 3 months. So automatically, please tell me today, will you invest so that you can redeem 1 lakh rupee, $1 lakh after 3 months and make the payment as it is? Yes. So the first step automatically comes investing the present value of 1 lakh today, so that with interest, when I redeem 1 lakh rupee, when I receive it, I can use this amount to make the payment to the other party. So the step one become invest present value of 1 lakh dollar. Now, to be able to invest, I will have to, people in the class, buy it from the spot market. To be able to invest, I'll have to buy it in the spot market. And when I buy it, I need to pay home currency rupee from my pocket, which I will borrow, so that I will make the repayment of rupee. The ultimate home currency outflow can be found out from my pocket as an importer in case of money market. So the step, people in the class, is either borrow, sell and invest, or invest, buy and borrow. The starting point automatically will give you a sense of what is to be done. Can I take you all to the practical question, the last practical question of this marathon, which will cover importer as well as exporter perspective. It was a reminder for the people, not this point. Go to the previous point where we started the concept of money market hedging. Please timestamp that. Cool, right? So taking you to the practical question, boss, on money market hedging, and you will find how easy that particular question is. Let's solve question number 36. Not because this question is important, but because we want to do a question on money market hedging. Whichever question you do is the same story. Perfect. Sir, in this question, they say you are Columbus Surgical based in US. So I know my home currency is dollar. If I import in any currency, ultimate dollar will go out of my pocket. If I export in foreign currency, so I'll say that again. My home currency is dollar. If I export in any currency, right, I will receive those. So okay, let's read this question. Automatically import export gets covered. I am Columbus Surgical. My home currency is dollar. I have recently imported raw material from UK. Now apply common sense. I have imported something from UK. So will I be needed to make the payment of pound to them? Correct. To make the pound to them, I'll have to go to the Forex market to buy the pound. Correct. That means to buy the pound, ultimately from my pocket, my home currency dollar should be outflow. So I will buy the pound in the Forex market, which is why dollar should go out of my pocket, which is my home currency. Cool. Sir, and that has been invoiced for pound 4,80,000 payable in 3 months. So I have to pay him 480 pound. I have also exported goods to India and France. To India and France, I've exported. Indian customer has been invoiced in pound. I am lucky. I am a US company. Customer is in India, but I have exported him not in terms of rupee or my currency dollar. I have exported it in terms of pound. Pound 138 payable in 3 months. So what is the advantage? I know to the importer I have to make the payment of 480. To the other party, as an importer, I have to make the payment of 480 pound in 3 months. And I know at the end of 3 months, I will also receive pound from that Indian customer at the of 1,38,000 pound. So net, I have to do the arrangement only for the net amount, which is 480 minus 138 gives me only 3,42,000 pound, for which the net arrangement is to be done, right? The French customer has been invoiced for euro 5 lakh payable in 4 months. To the French customer, I have to make the payment of 4 lakh, correct? Pound, 4 lakh euro. So in conclusion, I am a US company. Sorry, from the French customer, I will receive pound. I spoke a word incorrectly. I'll receive pound 590. So in conclusion, I am a US company. I have to make the payment of pound net of these two amounts, and I will receive, which is in 3 months, and I will receive euro 5 lakh 90,000 in 4 months. So there is an importer or exporter, both the situation to be dealt here. Let's first deal with export, right? People, they say the spot rate and the 3 month forward between pound and dollar is this, and the spot rate and the 4 month forward between dollar and euro is this. The US, France, and UK, the pound, euro, and dollar rates of investment and borrowing has been this. You are required to show how will you hedge, forward market or money market. So forward market hedge is automatically a part of it. Let's first focus on the forward market. People, if I sell euro, see, as an exporter, I'll receive euro. I'll go to the Forex market, sell it, right, and receive my home currency dollar. Sir, what is the rate between euro and dollar? This is the rate. After 4 months, forward rate is applicable. I sell euro, the rate is of euro. When I sell, the other party buy, the bid rate become applicable. So I'm able to sell 590 at the rate of 1.9510, right? So as an exporter, 590 into 1.9510 give me the dollar inflow of 11,51,090. My home currency dollar, it is ultimately a receipt, ultimately an inflow that I have. Easy, sir, sorted, sir, basic, fine. Now let's do the export hedging through money market. My question to you is, if I am an exporter, I will receive 5,90,000 euro after 4 months. That is clear. What should I do today is my question. Should I borrow today so that I can use the amount to be received to repay? The answer is yes. So I will borrow the present value of 590. Sir, euro means France means the borrowing rate of 16%. Sir, so I will say, how do you calculate present value? Do you get the first step that I have to borrow today? Requesting your responses on this particular point first. Requesting your responses on this particular point. Come on. Do you realize I have to borrow today? Come on, people in the class. So, yes, do you get that point? So, 590 is the amount divided by 16% is the borrowing rate. Time period is 4 by 12. When you get the present value, the amount actually being borrowed today is 561.27. Hello? What do you know now? Amount borrowed is there in my hand. I don't have to worry about the repayment. Repayment will happen when that 590 euro will come. I have to worry about the amount that I have in my pocket. Let's go to the Forex market to sell this euro. Sir, I went to the Forex market to sell euro. Rate is euro. Spot rate is applicable because you do it today. On the timeline, the imagination should be there. When I sell, the other party buy. 1.8890 is the rate. So when I sell euro, the dollar received is 1058,080. Now what do? You have dollar now. Sir, let's go to the market to sell. Sorry, let's go to the market to invest those dollars. So in the US market, investment rate is 11.5. Let's invest this amount at the rate of 11.4 for 4 months, which gives me an ultimate inflow of how much? 1098640 as the amount of dollar inflow that I will have after 4 months. So when I use forward market, amount of dollar inflow, my home currency is 1151. When I use funny market hedging, amount of dollar inflow is 1098,640. Whichever is a higher outflow is a better situation. So forward is a better hedging. Do you understand exporter money market situation hedged? Really simple, right? Sir, this see, every question of money market has to look more or less the same only. which is why we are lucky. Solving one question and learning one concept automatically make you capable of doing multiple questions in multiple attempts. Yes, sir, this is done. Now let's think about importer perspective. The net amount to be paid is 480 minus 138 versus 3,42,000 pound. Right? Let's hedge using forward. I know I need to make the payment of pound. So what is the rate between dollar and pound? The rate between dollar and pound in the forward market is this. I want to buy pound. The quantity, the rate is of dollar. So buying pound is equal to selling dollar. And when I sell dollar, the other party buy it at a bid rate, which is 0.9520. So whatever is the quantity divided by 0.9520. So 342 divided by 0.9520 give me a outflow in dollar terms from my pocket as 3,59,244, my home currency outflow against the import. So forward hedging outflow is really simple. Now let's talk about money market. 342 is the dollar I will need to pay. My question to you is, I invest today or I borrow today, such that whatever pound of 342 I need to pay, I can receive from somewhere. What do you think I will do today? Sir, common sense, if you want to receive it on a later date, redeem it on a later date, so you will have to pay it today, which means you should invest the present value of 342. Do you get my point? The initial point, the initial step that you take, the first step. Sir, I need to invest the present value of 342 pound. I see the rate of pound investment is 10%, time period is 3 months. So 342, the calculation of present value is like 10% for 3 by 12, give me the present value of pound 333,659. That is the amount of investment I need to make. Align to me, everyone. If you want to make that investment, let's go to the spot market today and buy that. I want to buy pound, rate is of dollar, right? So when I buy, sorry, I want to buy pound, right? But the rate is of dollar. So it's like I will sell dollar. Selling dollar, when I sell dollar, the rate is of also dollar. The other party buy at a bid rate, which is 0.9830 become applicable rate in the spot market today, right? That is today that's happening, because I have to invest the present value today at 333,659. I went to the market to do this. Quantity is pound, rate is dollar, dividing gives me 339,429 dollars required today to buy those pound. So let's borrow those dollars. I went to the US market to borrow it at the rate of 13%, right? Because I needed dollars to buy the pound. So when I borrow at the rate of 13% for 3 by 12 month, the ultimate repayment after 3 months is $354.60. So I knew that as an importer, ultimately from my pocket, my home currency dollar will go out. So in case of money market hedging, what went out is $354.60. In case of forward, 359 went out. So I will say lower is the money market, which is why it should be chosen. Do you people in the class, everyone, realize how simple execution is the step? How simple does the execution of money market hedging steps are? Which is exactly based on what you're learning here. Requesting your responses, people. So what you should be able to do is to identify the start point. In the start point, if you have to invest, let's buy it. In the start point, if you have to borrow, if you've borrowed, let's sell it, and automatically you get the next steps. This completes the discussion on the money market hedge, because there is no variation of questions in this. Yes. So with that, let me tell you, money market hedging also gets done. What's not done is the currency option and the fate of forward contract. This is something you will have to obviously cover in the priority of those 33 topics, right? And that's how we have to, people in the class, stop this marathon here. After this continuous efforts of around 8.5 hours, right, 8.5 hours, we have completed highly repetitive topics of difficult chapters of equity, business valuation, portfolio, derivative, and forex. If you need one more marathon for rest of the chapters, you will have to let me know in the comment box, right? You'll have to let me know. We can keep it on the day of FR exam, because now I think you'll be start to prepare FR. So rest of the chapters in around 6 hours. So if we start by say 7, then we'll be able to do it by 12 or 1 at night, covering these other chapters, right? Which are anyways the chapters you should read on the FR exam day, because a small easy topics we will cover on the FR exam day. So that difficult topics you can cover on the next day morning, which is one day before AFM exam. So that you will have to tell me in the comment box. And most importantly, live people must please, recorded people must please make sure you comment down and tell me how your experience was. Were my efforts worthful to you guys? Has it helped you anywhere? Plus, if you feel the video is really helpful, make sure you share it with your friends. It will be of great help to them as well. So that was all from my side on this particular marathon. Thank you so much everyone for watching up this up. Let's meet back again in the next marathon whenever you say. All right. I'll see you all. Bye bye. Thank you so much. So bye Miral. Thank you so much both of you. Bye Bia and everyone else who were there live. A special thanks to you all. Thank you so much guys. I'll see you all. Take care. Bye. Anything particularly that you want to ask? If no, we can call it a day. Yes. So bye guys. I will see you all. Yes, bye bye. Please make sure you comment down once the video ends. Yes, I'll see you guys. Bye, take care.